single hotel. That's how I differentiate from,
Well, no, actually, our hoteliers set their standards for the voting process, and we value their independence and their ability to set and establish our brand standards. So they actually do determine what those, I'll call it minimum standards are for things like breakfast and television size, in fact. They decide and manage, along with our board of directors and our leadership team, of course, what those brand standards should look like. But there's a balance there that's really unique to Best Western, where our hoteliers help us in establishing what those brand standards are.
so even in terms of cleanliness in bed sheets, so, or the bathroom, I mean, I've seen some weird things go on in some hotels where things don't get changed every day. Do you tell everybody that is a Best Western, they gotta adhere to certain standards?
Yep.
Yes, sir, we absolutely do. And we monitor that performance by inspecting our hotels, through regional service managers who visit our hotels, who closely monitor the comments that are provided to us by our guests, our survey system, a customer service system that we, of course, have for guests who we're not meeting their expectations. They can call us and let us know. You know, if it's not right, we want to know about it as soon as possible so that we can fix it, because that opportunity to fix it is tremendously important in terms of building brand loyalty. And we also recently implemented a system, a guest management system, where as soon as the guest checks in, of course, we try to get their mobile number so that we can interact with them immediately, and they can let us know if there's something that's not meeting their expectations so we can fix it during the stay. That's tremendously important to us, so that if it's not right, we make it right.
Right, okay. Those are a lot of user questions that I have for myself. Larry, it's good to have you on, and hope to see you, and good luck. Happy New Year.
Happy New Year to you as well. Thank you.
You're welcome.
Gotta have the waffle maker.
We're at, I'm not kidding, this is kind of schemy. We were at, it wasn't a Best Western. The trash can in the bathroom had stuff in it.
No.
Yeah. And I don't think it was maybe it was a one-off, or maybe they did, but you don't want someone's I don't just wait till it's full. Yeah. I don't remember what team that was, but it's like, wow, you really just.
If you skimp on the trash, what else is?
When were the sheets?
Right.
Things
you can't see.
When were the bed bugs changed?
Oof.
And don't bring a black light.
No. Hot tip. Coming on, digital currency shakeout. We'll take a closer look at the performance of crypto holding companies versus crypto miners. That's next. Well, now time now for a closer look at the winners and losers in the crypto trade. Mackenzie Segalos joins us now with that breakdown. Hey, Mac.
Hey, Leslie. So the crypto stock trade split into 3 camps this year, and it comes down to one question. Are you an operator or are you just holding coins? The operators won. Bitcoin miners that locked in multi-billion-dollar AI deals with Microsoft and Amazon are up 200 to 300%. Iris Energy, Cypher, Hut 8, these are infrastructure plays that no longer need Bitcoin at 100K to make money now that they have retrofitted for high-performance compute. The digital asset exchanges lost. Coinbase, eToro, bullish, all in the red. Robinhood's the outlier here, up 200% year to date, which is why you're seeing Coinbase follow the Hood playbook, pushing into equities, prediction markets, really trying to become the everything app. And then the hottest crypto trade of the summer, those digital asset treasuries where companies hold billions of a given coin on their books, they completely fell apart. Strategy down nearly 50%, Mara Holdings down 45%. Tom Lee's BitMine immersion, which claims to be the largest Ethereum treasury in the world, down 80% from its peak. Peter Thiel-backed ETHZilla plunged from over $100 to $5, and there's a huge overhang going into 2026. MSCI is deciding whether to reclassify crypto holding companies as investment funds and boot them from the index. If they do, massive index funds tracking the benchmark may be forced to sell, which is a real liquidity risk for the treasury names. Guys?
Mac, we saw some crypto companies and crypto tangential companies go public this year. Are there expectations for that next year, given kind of the bifurcation that we've seen in performance in 2025?
So we saw a lot of the digital asset exchanges join the public markets, bullish, eToro among them, also Circle, which is a US dollar pegged stablecoin that has a lot of regulatory approvals that others like Tether don't have in the US. And so that was the backlog, but you're starting to see this depression of the crypto trade, and so there's less of an incentive there. And then on the digital asset treasury side, the way that a lot of these companies were listing were through these reverse mergers, so essentially these shell companies trading on the NASDAQ that hadn't seen much action and had nothing to do with fintech or the crypto market, and they were used as a vehicle to take public to then custody a coin like Solana. Now there are other filings that show that there are additional public listings coming down the pike, but there's not as much of an incentive as what we saw earlier this year. And Leslie, you covered a lot of those IPOs for us.
Yeah, along with you, who helped explain exactly what they do and how they're different from one another. Always appreciate your insight, Mac. Thank you.
Coming up, policy priorities in Washington in the new year and what it will mean for your money. We'll dig into that next. Then, from D.C. to the West Coast, a closer look at the wealth tax debate in California that has exploded on social media in the last few days. D.C. investor Ben Narrison will join us in the next hour. Swap out.
almost 8 a.m. On the East Coast. You're watching Squawk Box on CNBC. I'm Joe Kernan along with Leslie Picker and Mike Santoli. Becky and Andrew are off today. Among some of the big stories we're following, Meta is buying AI agent developer Manus. The Wall Street Journal puts the purchase price at more than $2 billion. Manus emerged as a notable AI player after claiming its chatbot offered better performance than OpenAI's lead research agent. China firing rockets into the waters off northern and southern Taiwan, conducting war games around the island. They started less than 2 weeks after the U.S. announced a record arms package worth $11 billion for Taiwan. And President Trump says that the U.S. struck a dock facility in Venezuela where boats accused of carrying drugs load cargo. The operation was the first time the U.S. has struck land in Venezuela since President Trump began that pressure campaign against Venezuela.
All right, let's take a look at what the markets can expect from Capitol Hill and government policy in 2026. Joining us now is Tobin Marcus, Wolfe Research Head of U.S. Policy and Politics. Tobin, good to have you on. If you bundle together all of the policies that are kicking in, obviously some of the tax breaks, some of the CapEx expensing, along with, I guess, what's happening on the spending side of fiscal and deregulation, what do you think is the net effect for economic growth over this year?
Thanks for having me. So I think that at the highest level, we're pretty clearly heading into a stimulative environment in 2026, and the question is really just how stimulative. But, there's been a lot of debate over the course of the past few months about whether or not the economy is slowing down, whether or not the labor market's cracking. We've always thought through that whole debate that we really kind of just need to hold on until the spring when we have a lot of tax relief coming through on the individual side. The One Big Beautiful Bill included a lot of individual tax cuts, those tax on tips and overtime and a larger standard deduction and so forth. And importantly, those tax cuts cover the entire year of 2025, but largely weren't realized in 2025. So that's all going to show up in tax filing season. So that'll be a big shot of stimulus, probably the most important thing. Some debates about exactly how it looks on the individual or on the corporate side. Some questions about whether or not we get some additional forms of stimulus like tariff refunds ordered by the Supreme Court. But one way or another, we do see significant tailwinds for growth.
Yeah, I guess on the individual side, it's relatively straightforward to try and quantify it, and I think there are pretty good estimates of what that's going to mean in terms of cash in pockets for households. In terms of the corporate decision making relative to the CapEx tax breaks, obviously these are policies that are intended to kind of pull forward investment in some kind of productive assets. And I just wonder, given that we've already been in this CapEx boom that's been driven by this secular theme, what we're expecting incremental to that.
Yeah, so our view is more cautious on how much genuinely incremental CapEx is induced by these tax cuts. So again, the idea is, you put in your money, if you can expense it right away, get the cash tax benefit in year one, that's going to incentivize companies to do more CapEx. And we're somewhat skeptical that's going to really play out. As you mentioned, obviously we have one very, very hot sector for AI, or for CapEx, which is AI and data centers, but there are capacity constraints there, right? Every chip is being spoken for, every turbine spoken for several years out. And then when we look at the rest of the economy, we look at smaller manufacturers, for instance, which is really where this should make the most difference because they live in a non-GAAP world. The cash tax flows are what really matter. That's where companies have been more in a defensive crouch, and where uncertainty around policy, uncertainty around the direction of the economy seems to have been holding back investment, and we think that's probably going to continue to be the case. So, still a benefit for markets, still a sort of a boost for assets, but not necessarily translating into real economic activity.
So, Tobin, I'm trying to handicap the midterms, and with what you just said about a reacceleration with the economy, but not a boom. I don't know whether that's enough to change what the calculus looks like right now, and I'm not sure whether you agree with what the calculus is. I also don't know what to think of the Obamacare pandemic-era subsidies, and whether you are seeing some Republicans start to break off, and whether something's possible there, whether it's a 1 year or 2 year or something. And I don't know whether that would even help the Republicans in the midterm. So I guess
so on the latter question first, with ACA subsidies, I definitely do think that's still possible. I think what we need there, if that's going to get done, it's going to involve some leadership from President Trump. I think there's more than enough sympathy on the Republican side It's a divided party, but there are enough Republicans who want to get that done that if President Trump decides he wants to get it done, I think he can get it through Congress. But thus far, the White House hasn't really.
Would that help?
Sort of,
Can
I
they
think it
hold
would help
on?
somewhat.
Can they hold
Yeah,
on?
I mean, that's,
What do you think? They lose the House and keep the Senate, or?
yeah, that's certainly the base case. I think Democrats are clearly favored in the House. Republicans are strongly favored in the Senate. Democrats would need to flip Ohio and Iowa, or Ohio and one of the two, Iowa and Texas, to flip the Senate, in addition to doing everything else they need to do, which is very challenging. So, I mean, we're probably looking at a narrow Democratic House majority. And I think you would need to see a real big upside surprise on growth to change that outlook, because these.
But if it's so divided, and the filibuster stays, you don't see the Republicans getting rid of it, and you don't see the Democrats being able to do that after the midterms either, because I think they would.
Yeah, I think the filibuster is eventually going to go away when one party needs to get rid of it to do something they want to do, but I don't think we're there yet in 2027.
And then when it comes to just in general the policies that may feed into what we see in the midterms, growth is one thing, unemployment's still low, the affordability theme is basically got all the mind share, and what can be done along those lines? I mean, it's funny because economic narratives end up being kind of lagging, and this has been many cycles, and so you just wonder what can move things off this idea that people have that things simply are unaffordable.
Yeah, I mean, the numbers for the economy, I think, are going to look pretty good next year. We're going to have above trend growth. There's a question about how far above trend. We are continuing to get disinflation, even though we're still above target. And the unemployment rate, is not going to be rapidly rising. It might stabilize where it is now. So, I think an economist looks at that, and it looks like a pretty good year. But, of course, voter sentiment, consumer sentiment looks terrible. And I think it's a really stubborn problem. I mean, you do these focus groups of voters who ask them what they want to see on affordability, and they say, when are prices going to come back down? But that's just not a realistic goal. That's not a thing that's going to happen. Housing, in particular, is a big pain point that's really stubborn. I think the administration is going to take some swings there. President Trump indicated that in his primetime speech earlier this month. But, I don't think they have a silver bullet to sort of solve that problem overnight. So I think it's going to take time. I kind of think that people need to forget what things cost in 2019 and just sort of adapt to the higher level of prices that we've gotten.
Well, I guess that becomes easier the farther we get from 2019. We'll see how that evolves. Tobin, thank you very much.
Thanks for having me.
Let's take a look at the futures. Not too much action this morning. Implied to open slightly lower for the S&P and the Dow. The Nasdaq just flipped into the green, Dow too. But we'll keep an eye on it. Let's get to Frank Holland with a look at this morning's pre-market numbers. Frank.
Hey, good morning, Ann Leslie. We're going to start with the metals after a big pullback yesterday from all-time highs. Yesterday, we saw gold and copper fall more than 4.5%, silver slid by more than 8%, but you can see here, today, a lot of green on this board, all higher. Gold's up about 1.5%, silver, the best performer, up just evenly 8%, just around 8% right now. All right, these names have been on some huge runs and have surged into the end of the year, boosted by a weaker dollar and rising geopolitical tension. Gold this year up over 65%, silver up just about 160%. So huge runs for both of them tracking for their best performance since all the way back in 1979. All right, coming up next, we're looking at U.S. listed shares of Baidu climbing this morning, 5% even right now. This is following a Reuters report that China could require chip makers to use at least 50% domestically made equipment if they add new manufacturing capacity. The tech giant owns a chip design firm that can see a major boost from that news. Baidu shares, you can see right here, they've climbed more than 55% so far this year. All right, moving on, we're going to finish with South Korean listed shares of SK Hynix and Samsung, both of them closing higher following another Reuters report. The U.S. granted an annual license to these companies to bring their chip manufacturing equipment to their facilities in China. The move is temporary relief after the U.S. revoked license waivers earlier this year. You can see SK Hynix closing up about 1.75%, Samsung 1/3%. Leslie, back over to you.
All right, a trip around the world there, Frank. Thank you.
Coming up, the wealth tax battle could be playing in California. See whether it gets anywhere. We're going to dig into the debate. It's pitting wealthy tech execs against lawmakers. Squawk Box. Be right back.
let's take a look at the broader markets as we close out the final 2 trading days of the year. Joining us is Troy Gajewski, Chief Market Strategist and a Managing Director at Future Standard. Thank you for being here, Troy. So you actually think investors should be allocating more to the private markets. They are more expensive. They're higher fees, and a typical 60-40 portfolio is looking on pace to notch a 15% return, which is double the average from 2005 to 2024. So what do investors really get from allocating more to privates?
So that's our core focus: private markets, private equity, as well as private credit, private real estate. And when you look at the big picture here, Leslie, and you look at public markets, public markets, particularly the Russell 2000, traded very elevated multiples, roughly 19 times EV to EBITDA. In middle market private equity, it's roughly 11 times. Plus, you get much better growth. The core thesis for middle market private equity is growth at a reasonable price. You're getting 1.5 to 2.5 times nominal GDP revenue growth, and you're buying that at a roughly 60-80% discount to the Russell 2000. So we're not claiming that these asset classes are perfect. We're very confident we can at least compete with the S&P and the NASDAQ over time through a full market cycle, and do that with much less volatility, much less drawdown risk, and provide true diversification. Whereas on the bond side, it's been very hard to make meaningful returns for approximately 5 years now.
Now, why middle market in particular? Is it a kind of a second derivative play on what you're expecting in terms of the rate environment, the macro picture, or just essentially diversification?
Yeah, the big key with the middle market is it's one of the true growth engines of the U.S. economy. There's approximately 200,000 companies. Again, the asset class as a whole grows revenue 1.5 to 2.5 times nominal GDP growth, which is a very impressive number. So you have this vast opportunity. You've had all this wealth created over time, but it's been very difficult to access for investors until the rise of evergreen private equity. So vast asset class, tremendous growth, great way to get diversification and exposure to what I refer to as like boring is beautiful. Right? In the broader market, let's face it, so much of the outcome is going to be tied to whether there's an AI ROIC or not. So it's nice to be able to invest in companies like HVAC, paving, specialty foods, where you can get very attractive growth, not hyperscaler growth, but let's call it 10-15% revenue growth, and you're getting it at a very reasonable price. So that's a key part of generating that risk-adjusted return.
It's like a rocket surgeon, as you know. Chemical engineering, MIT.
Yes, thank you, Joe.
Is it you know too much to be good at this?
Well, that's a very kind thing to bring up. I really enjoyed the engineering background, but it's fascinating, the market opportunities.
I want to, leading into, so you have developed a thesis on how to explain the strength in nominal GDP and the strength in the labor markets. Is that true?
I don't know about any broader white papers or theses, but one of our core theses the past several years is that we're going to continue to have very strong nominal GDP.
Why?
Right. Well, because real GDP, as you know, is running very hot. Strong consumer, not as strong as 2 years ago, but still very strong. You have a situation where we're in the greatest business fixed investment boom of our lifetimes, tied to AI, but also broadening out. And all the drag that we thought we'd have from government spending is not playing out. So real GDP next year, roughly 2.5 to 3%. Then you put on another 2 to 2.5% at least on top of that from inflation, and that's what drives the strong nominal GDP growth. And the thing about that people always forget is nominal GDP drives revenue, whether it's for large cap listed companies or whether it's for middle market private equity or middle market private credit. It's nominal GDP that's important. Anytime you're long an asset that has economic risk, you want as strong a nominal GDP growth as possible without 9% CPI, of course.
Right.
And just one other, and I assume that this is all accurate for the notes, but you try to help people at your firm identify the Northwest Quadrant, the efficient frontier strategy. Does that mean low risk, high return in frontier?
That's 100% correct, Joe.
That's how it works?
So one of the keys to alternatives, and again, every alternative strategy isn't perfect, is you want to have as little risk of loss primarily as possible, with as attractive a return as possible. And you brought up 60-40 before, right? If you look at fixed income, let's face it, in 2021, fixed income was the definition of return free risk. You had very little return and a lot of risk. Now, it's not as bad as the situation today, but hard to get pulled up on the back end of the yield curve for a variety of reasons. So then if you look at alternatives, whether it's private equity, if you can make low teens returns, that should at least be competitive with listed equities going forward, should comfortably outperform international as well as small cap. And then in private credit, you're not getting quite as juicy of a return, but you have even less risk of loss because you're senior in the capital structure. So that Northwest quadrant is one of our key focuses. How do we help individual investors and institutions achieve that within their broader portfolios?
Are the structures for these evergreen?
We have a combination, both drawdown and evergreen. Like I always tell our various investment teams, whether it's a drawdown, evergreen, a secondary portfolio, a co-invest portfolio, or primary, it all starts with that growth at a reasonable price. So we have both evergreen offerings as well as drawdown offerings, depending upon the client appetite.
Middle market private equity was always viewed as this kind of, pool of inefficiency. Is that still the case, or is it more crowded?
Well, we have yet to see crowding. Look, it's very fragmented. There's approximately 250, 260 sponsors that play in the space. Remember, there's 200,000 companies. Not all of them are good, right? Our job is to make a good company and help it become great through operational improvement. When you look at the entry valuations, they're still very reasonable. You're roughly 11 to 12 times. Now, for our growthier positions, they may be 13 times EBITDA. But that paving example I gave you before, we got in at 5.5 times. So from a pricing standpoint, we don't see crowding. And given the fragmented nature, it's very difficult to build a platform where you can methodically access these investment opportunities. And then just as important is the exit, where we ultimately sell to a strategic acquirer or sell to a larger sponsor. Because let's face it, the vast majority of assets in private equity are in large and mega cap sponsors. So we're a much smaller niche within that $8 trillion industry.
I think if you can get out of MIT with a degree in chemical engineering, you can do anything. I do. And you didn't obviously do that. You did this, but you probably run circles around all the communication majors and the literature, English lit. I mean, that is we need more. That's what we're lacking in this country, and our kids that are willing to have no college life whatsoever to get a degree in engineering or math or physics.
It's very kind of you to say, Joe. I guess for me personally, one of the things that attracted me to this industry as opposed to staying in engineering,
The money.
PhD. Oh, that's hard. I grew up in Wilkes-Barre, Pennsylvania. My grandfather was a coal miner, so having the opportunity to make a healthy living and support the family. And then, a lot of engineering disciplines, you spend a lot of time in a lab or a fab. You do a lot of research that might not be applicable to everyday life. Here, if you're good analytically and you're also
That's what I'm saying. If you have those skills, they can definitely, you can flourish in this business.
You're my guy, Joe, God bless America.
Yeah.
Seriously.
Well, I went there for something totally different, but
Is that right?
yeah, in molecular biology. I was in Ames Street, Center for Cancer Research.
Wow,
Yeah.
it's incredible. All the
Yeah.
transformative technologies that we have.
But it helps. I think it helps to have a rigorous scientific background.
I'm a firm believer, and even though it looks like neither of our two boys will become engineering majors, it's a great way to
Make them.
It's a great way to set yourself up for success.
You want me to pay, you gotta do that. But then they won't, Monday through Friday, they gotta stay in. And at college, no one wants to do that.
That's true. They like to have fun, but bringing it back. I mean, look, we're all about that Northwest quadrant efficient here. Providing investors that growth at a reasonable price opportunity. In private credit, it's all about earning that excess yield and keeping the risk relatively low, and providing the diversification that bonds just don't provide anymore in client portfolios.
Some say equities too. Thank you, Troy. Appreciate
Great
it.
to be here. Happy holidays.
Happy holidays.
Coming up, we'll go inside the California wealth tax debate. Silicon Valley founders upset at local Congressman Ro Khanna over his stance. Much more after a break. And as we head to that break, here are the year-to-date winners in the Dow.
California's tech elite are angry over a potential wealth tax. In the Golden State, the heated debate played out largely on X, where some tech leaders have called out Silicon Valley Congressman Ro Khanna for supporting the idea. Y Combinator's Gary Tan has even called for a primary challenge for Ro Khanna. In a statement, Congressman Khanna's office said he has always supported a modest wealth tax on billionaires to deal with staggering inequality and to make sure people have health care, while also advocating for common sense workarounds. Joining us now, Ben Narrison, founder of Tenacity Venture Capital. This is just such a multifaceted discussion we can have. Ben, we've had Ro on many times. I don't think he always did support what he's now calling a moderate wealth tax. I think in the past, he's come down on the side of a lot of his constituents and not, and then I think about, does California need more money to waste? I mean, is that really the answer for how to deal with things out there?
It's pretty tough to be so, I don't know, proven to be poor at your job of spending money that isn't yours, and then to ask for more. You know, California's own accounting group said that they found $9.6 billion worth of waste and inappropriately spent capital and fiscal malfeasance. And, you know, we went from a surplus to a deficit, of course. But, you know, this is just the same as always. This is political pandering to the proletariat. It's a let's tax the rich and help you, little guy and gal. It has no basis in anything that works. There's no country in the world where a wealth tax has worked, with one exception, that's Switzerland, and they do it in an extremely logical and fair way. You know, it would take you 20 years of paying Swiss wealth taxes just to equal what you would have paid on a gain in the United States through capital gains. So, you know, this is a bunch of chest pounding. I really hope it doesn't pass. We had this conversation when Kamala was running. It's just an idiotic concept that is nothing more than political positioning. Having said that, Mandami won in the same way, so, you know, I'm worried about that.
Then there's two issues here, I think, if you boil it all the way down. And one is, if someone accrues a lot of wealth paying, and I see people say, I paid 53% to accrue all this wealth. Now I've got a private property. There's no way that you can just say, now I want some of it. That's confiscatory. You've already paid taxes on it. Then there's founder shares. The people that found a company, let's say it's at $1, and now it's at $1,000, and they borrow money against the gains to live off those. Then they die, and their heirs get it, and it's never taxed, basically. And I almost concede, and Bill Ackman's got a way that you could maybe address that. I don't know how much money it would raise. It's not going to solve California's problems. And so
don't forget the fact that there's well-documented cases where countries and states create wealth taxes, and you see massive fleeing of wealth.
You do.
For instance, 1989 lost, by their own numbers, 10 to 12,000 millionaires when millionaires mattered. You know, back in the 80s.
But it goes against everything we learned about property rights and John Locke and everything else over the years. It's basically confiscatory. And if you go down this slope, I don't know where it ends. But I do at least understand the notion that if you never sell anything and you're a founder and you're worth $20 billion and you just live off borrowed money like a billionaire, I can understand how the optics of that make it right for
this is the whole
trying to change something.
Buy, borrow, and die philosophy upsets a lot of people. It is a tiny fraction of the planet. To worry about something that impacts 1 or 2 fifths of the population, and by the way, these are exactly the people that have the flexibility to go wherever they want. So, you know, you've seen this when people change trust law, they move to another place. When people change corporate law, you know, you've seen all the things Elon Musk's been doing about anti-Delaware, now we've got to be in Texas. Money is fungible. People can move. You know, when you're at that level of wealth, you have an enormous amount of flexibility. I mean, I've heard so many tales, and I've seen people that have become or coming into the billionaire class that have almost immediately moved to a tax-free state. I mean, you just saw, I don't think it's because he's a billionaire, but George Clooney's now moving to France. So, you know, you're just making it really hard on people. And yes, it is confiscatory, because if you take out that tiny fraction, you know, drawing attention to the 1 in a million to try to make a case for something that might impact even 1% is totally unfair. And, you know, one of the things that on Twitter a lot of people talking about, I don't understand property taxes. I'm paying rent for the house that I own. You know, there's plenty of versions of wealth tax already. Property tax is a great example. When I moved to California, I paid cash for my house. Because having been an entrepreneur for 25 years, I worried that I might risk it all again, which I had done.
I think we lost, trying to get, we're working on that and trying to get that back. The other thing, I didn't want to get in necessarily into covering everyone for healthcare, but the California loophole essentially covers everybody out in a way. It's not specifically federal dollars, Medicaid dollars that cover these people, but when you get reimbursed, when you do something, you get reimbursed, not just the ER, everybody's covered. Everybody is covered, and it's fungible. They get other money that they use for what they would have been spending on other state needs. You get that from the federal government, and they're able to use, essentially it's fungible. They're able to use some of that money that accrues from healthcare to cover everyone. And that's what they want to do, and they want to build that ridiculous frame.
But on the revenue side, for a smaller group as it really applies to, in terms of this vast amount of untaxed wealth in perpetuity, it's not going to go away as a populist issue.
No.
And so, you know, to your point, if you started to go after a step-up basis, I mean, all these things that sort of allow at some point down the road, heirs or somebody to have a tax liability.
Oh, we got Ben back. I don't know whether you can hear any of that, Ben, but you can just weigh in on what Mike and I were talking about.
I got the tail end. I mean, look, it is really, really hard to address the sort of unrealized capital gains. First of all, everybody uses the example of the Bezoses of the world. You know, they're borrowing against their public stock, they're spending it, they'll eventually die, their heirs will get a step up. But what about the dry cleaner that opened one store, and then two, and then five, and then 10, and 100% of his or her net worth is in that asset? And now it's worth $50 million. You know, if you penalize one extreme, you're going to penalize the hardworking person that's sort of getting there. Switzerland has made it work because they take a small 10 basis points to 1% wealth tax every year, which is negotiated and generally relatively low. But keep in mind, they don't have capital gains, and their income tax is like 11.5%. So you can't stick it to us everywhere. I mean, you got to sort of pick your battles. Otherwise, it's just totally and completely unfair.
What do you think it means for entrepreneurship? Obviously, California and Silicon Valley, a lot of important companies were founded and still remain headquartered there. You know, I get the point about billionaires leaving if this does come to pass. Does it disincentivize people from starting companies, building companies before they get to that billionaire status?
Sure. I mean, you're already seeing a material amount of companies and certainly investors that have moved to, for a little while, Florida, Austin, Texas. Anybody with big dreams and aspirations usually is pretty long-sighted in terms of what they want to achieve. And so this could definitely impact that. You also have a pretty material, I've already seen big dog VCs leave the state. And so that impacts it as well, because all of a sudden if you have this diaspora of capital that goes out of Silicon Valley to all these little pockets, Austin, Miami, etc., then maybe it's just as easy for the entrepreneurs to raise there. You just don't really want to push your best and brightest out of the area. If you look at I think out of all the trillion-dollar companies on the planet, the only ones that aren't from Silicon Valley are Microsoft, Seattle, pretty darn close, tax-free by the way, and Saudi Aramco and TSMC. But the vast majority came from here. 11% of the jobs in the United States come from venture-backed businesses. It's just really, really tough to sort of like basically kill the golden goose. You want to make some goose fillets this year, it's not going to help you very much.
But Ben, California's never been the lowest tax place to start a business, and yet you just cited those numbers.
Yeah, but a lot of people have already left. I mean, it's been a growing level of issue. I remember I was having a conversation over dinner. I used to live in Incline Village, Nevada, for a period of time. I moved from New York City. New York City used to be the highest tax in the country. So I moved from there to Nevada, and then I moved on to California. you know, a lot of great things here. I mean, we have some of the most beautiful terrain in the world. It's just a wonderful, wonderful place to live if you look at the physical environment of what we have here, the natural resources. But it is extremely expensive. I know it's a horrific tax rate. And, you know, look, a lot of people are figuring out where they base their companies, whether it was a Delaware Corp or now, maybe if you've got it, instead of a Delaware Corp, you've got a Texas Corp, Austin becomes more appealing. I've had founders that started from day zero in Austin. But there is a special serendipity here you're not going to get anywhere else. You're not going to lose everybody. But on the edge, when what's more likely to happen is the companies will start here, but when they get to the level where if this were to pass, their line of sight to that billionaire status, they're going to move. And that's going to hurt us.
It's a one-time tax, right?
Well, when was the
So
last time
could
you
they
saw a
leave
temporary
and then
tax
just
in
come back?
any government ever be temporary? I mean, if they do it once, they're going to do it again. It's not obviously passed, and hopefully it won't be, and all this will just be a classic tempest in a teapot. Waste of time, and people will be trying to drum up the votes they need, and they'll move on.
All right, then we're going to continue to talk about it and watch it. Watch it play out. I don't think Newsom's not even for it, is he, at this point? Or?
It would be a little, I mean, in the past, he has gone against these sort of offerings.
Yeah.
I mean, you know, let's remember he was backed by and is in office because of one of the wealthiest people in the country. Getty, you know, is assumedly still a very close friend of his, and I think he's probably realistic enough about looking at those. Look, Gavin's got issues, but he's a relatively logical person, and this is not a logical thing to try and get done.
If you lose Gavin on this, I don't know, I'm not sure what that means. They picked up Roe.
Yeah.
Well, we were gonna be on a ticket together. I'm gonna have to tell him that that's not happening. Rojo ticket. Or Joe Roe. He wanted Joe Roe, but I don't want to be president. Vice president looks good to me. Not a lot right then, kind of.
I think you should go back to curing cancer. I thought that was pretty cool.
Yeah, exactly. Anyway, good to have you on. Thanks, man.
Coming up, a closer look at the U.S. economy and what it could mean for the markets in 2026. That's next. Welcome back to Squawk Box on CNBC. The futures at this hour, still not too much movement, hovering right around the flat line for the three major indexes. The NASDAQ implied to open about 27 points lower. The S&P looking to open about 3 points lower. Treasuries at this hour, again, thin trading. Holiday week, you got the 10-year right around 4.13%. The 2-year unchanged, and the 30 at 4.81 for the yields there. Let's take a look at crude oil at this hour. WTI up about 0.4%, ICE Brent up about 0.3%.
Well, tax cuts likely to provide a boost to growth in the new year. On the other hand, inflation and labor market risks are still hanging around. Joining us now on what we can expect for the economy in 2026, Daniel Horning. He's former Deputy Director of the National Economic Council under President Biden, and Doug Holtz-Eakin. He is American Action Forum President. Welcome to you both. So Doug, let's start with that setup. I mean, we have some tailwinds for demand, both on the consumer side through the tax policies as well as this corporate investment boom. I guess the question is, are we going to still see this disconnect between GDP and job growth as an initial question?
Yeah, that's a big mystery right now. The third quarter is all productivity. The labor input is flat. We haven't seen any growth in hours, and the top line numbers are big. So I don't see how that continues, to be honest. One of the things that hasn't been discussed as much about that report is the growth of real disposable income was zero. And so I don't see how we continue to get the consumer spending that we saw in the third quarter report through the fourth quarter and into next year. So I expect things to flatten out, quite frankly, in the fourth quarter. And then you're right, early next year we'll start to see the refund season, a lot of cash into the household sector, cash into the small business sector, which is really struggling as well. And I see, the second half of 2026 is going to be pretty strong. But between now and then, it's going to slow down a bit.
And then Daniel, on the inflation side, on one hand, inflation readings have been somewhat stubborn, a little closer to 3% than 2%. On the other, that's not that out of whack with the long-term history of how inflation runs. And markets themselves have shown very little concern about a longer-term inflation problem. So how do you think that plays next year?
Well, I think where we were at this time last year was forecasters broadly thought inflation was going to go back to around 2% by this point. Instead, I think when we get the data that's delayed due to the shutdown, we'll see it's, as you noted, probably closer to 3%. And the main reason for that is the tariff and good inflation issue. I think, again, forecasters looking at inflation to come down back to around 2% over the course of this year. My sense is that both because of the kind of delay of some tariff pass-through and because I think we're likely to see a continued kind of jumping around in that average effective tariff rate with litigation and the administration trying to build back that tariff wall, I think we might see a slower move to 2% than some are forecasting, but I think the direction of travel clearly is lower on inflation, and we could, over the course of this year, see both, I think, the American public, but the Federal Reserve, too, become more focused on some of what Doug was getting at, things like slowing real income growth, and then, of course, unemployment and the like.
What would that look like, Doug, in terms of getting more focused on that? I mean, obviously for the Fed, it would be a further easing bias, but are there levers to be pulled on the fiscal side?
Well, I think they've pulled the levers on the fiscal side, quite frankly, and what they ought to be thinking about is putting in place something that's more stable over the long term. As you know, we have enormous budget deficits, things that are 6% of GDP at full employment. It's really unwise and something that they're going to have to take care of. And we have a looming bankruptcy in Social Security, so there's a real reason to move on one of the big entitlement programs. So they ought to start, getting ready to take care of the fiscal outlook. That's the right thing to do for both the economy and for the budget. I think the spring's going to be a tough patch, to be honest. I'm less optimistic than others on the inflation coming down to 2 quickly. It's been pretty stubborn and was really headed north, not south at the end of this year. So the Fed's not going to have a big easing bias, and we're going to have a slowing economy, and it's going to be a sort of stagflation feel early in the year. That's never a good thing in an election year. So I'm a little worried about what the spring looks like.
Doug, that's like 180 degrees from where the optimists are right now, following that last GDP report. I know we had a former Biden guy, and I said, well, who are we gonna have to push back on the former Biden guy? And they said Doug, and I go, why do we have 2 Democrats on? Or two never
well, get
why
over
do we
it,
have
Joe.
2 never Trumpers on? Why have 2 never Trumpers on? What's the point? Then I gotta step up.
It's not about Biden or Trump. It's about the numbers, Joe. You know that. So
How about the
I
GDP
think
number?
there's some.
What we got? Really,
It's a
the
good number.
labor market doesn't look horrible. Inflation looks like it's kind of tethered, and we had a 4.3% GDP. We got $57 oil or $58 oil. We got all this stimulus, and you're like the Grinch who stole Christmas, and Christmas is over.
I also think, Joe,
Third quarter
that
was
things would be.
great. There's nothing wrong with the third quarter, Joe. Nothing wrong with the third quarter. Enjoy it. But it's over. So let's think about what 2026 is going to look
Well,
like.
you certainly didn't think it was coming in the third quarter either, Doug. So, I mean, you've been in a bad mood for the past year on the economy.
I don't think that's quite fair, but thanks for checking in. I don't think we talk that often.
Daniel, what were you going to say?
No, I mean, look, I don't think Doug is the only one who's, as you said, Joe, in a bad mood on the economy. I think part of the challenge that the administration faces right now is that we have, as you noted, a good third quarter GDP report, but the labor market appears to be showing some signs of strain. I think they are putting a lot of hope on the idea that tax refunds that are a couple $100s or several $100s higher on average than a typical refund season are going to really be an important boon for consumer sentiment. But I think that the challenge that they face is that we have a high price level, high long-term interest rates, and the perception out there is that many of their economic policies cut in the wrong direction on those key issues.
Doug, just to wrap it up, so I mean, what you've described, right, with good GDP but not good real disposable income growth, et cetera, you know, productivity growth, if that's what we're going to continue to see,
That's right.
as well as, you know, even higher inflation pushing up nominal GDP, that maybe diminishes the, you know, the relative debt burden over time if you're going to kind of grow nominally out of it. So that's just obviously the upbeat spin on it.
Yeah, no, I mean, there's no question. You know, it is Paul Krugman's line that in the long run, productivity isn't everything, but it's almost everything. And we should always be looking for good productivity growth. No question about that. Eases inflation pressures, and so I'd like to see that continue. There's no question about that. The other thing that I think people need to keep an eye on in 2026, which is one of the Trump successes in his first term and again this term, is the deregulation. I think it gets underappreciated what's going on out there in the regulatory state. They took hundreds of billions of dollars off the prospective costs last year. When that starts hitting the economy, that's a form of productivity growth. You're lowering your unit labor costs, and I hope that really kicks in a much bigger way next year.
Yeah, we'll see if we can see that flowing through to the numbers. Daniel, thank you very much. Doug, also appreciate you bringing up Paul Krugman and another of Joe's.
Yeah.
Thank you.
How did I know that if Doug brought up an economist, it'd be Paul Krugman? All right, thank you. When we come back, after a big run up, silver is coming off its worst one-day performance of 2021, bouncing back this morning. We're going to talk about the momentum in the metal trade next. Talk about something like that. That's all right. Silver, as you can see, a little bit off its high, but even, I say $80 in reference to silver, I can't even believe it. Before yesterday's fall. For more on the metals trade, Daniel Galley, TD Cowen, Commodities Strategy Director. And Daniel, can you tell me for sure that there's nothing technical or short covering or nothing like that going on with silver? All the conspiracy theorists think. I mean, it reminds me, I saw $50 silver 30, whenever it was. I can't even do the math, I'm so old, but you know, during the Hunt brothers. What was that, 1980 or 45 years?
Yeah, exactly.
And this reminds me of that. This is crazy, or is it worth 80? It was worth 80 all along.
Yeah, I mean, this is even more significant than that. This is the best performance in silver markets since 1979. Right, and you know, to answer your question, no, I can't tell you that there isn't anything technical. What's happening in silver markets is extremely technical. You know, roughly a year ago, we argued that the silver market was sleepwalking into a silver squeeze. So in our view, we were always going to end up in this moment in time where what we were expecting was physical market constraints to result in significantly higher prices. That happened. But this actually reached its climax over the course of October, and we've since rallied more than $25 an ounce, as wild as that is to say, since the October sell-off to date. What's actually driving things now is that we have transitioned away from a physical shortage to a liquidity shortage. And this is largely a function of the imminence of the Section 232 critical minerals investigation, which silver is now a part of, which has constrained the arbitrage that almost guarantees liquidity in precious metals markets and silver markets in this case. So with the arbitrage now constrained, retail flows are having a significant impact on prices. But so the way we're looking at this is before the lights come on, before that deadline for the Section 232 critical minerals investigation comes up, retail wants to dance. And as I mentioned, retail inflows are having an outsized impact on prices in the meantime. When the lights come on, yeah, please go ahead.
No, I was just saying, you know, gold I can almost make a case for that it makes sense with central banks and you know, for a long time it built a beautiful, you know, saucer bottom and everything else, and it was always probably, you know, headed to 4,000 or 5,000. But this is silver is almost separate from gold. It's not the same thing we're seeing, is it?
No, it's absolutely not the same thing, right? As you mentioned, central bank demand has been a really big driver for gold markets from 2022 to 2024 in particular. When we're looking at what happened in 2025, the story actually kind of changed in gold markets. It's transitioned away from Eastern buying activity to Western buying activity. Right, so you know, one anecdote that we can share on this is that the most popular gold ETF is now roughly 65% as popular or as widely held as the most popular ETF in history. And what that tells you is that the debasement trade has actually resulted in this kind of widespread accumulation of gold from institutional investors in the West. So what we need for gold markets to persist going forward is we actually need those position sizes to start increasing. And for that to happen, we probably need the administration to make a mistake on Fed credibility or otherwise.
It is something to behold, Danny. I wonder where silver finally settles. I wonder where it'll be like 6 months from now. You got any idea?
Yeah, absolutely. And that's what I was getting to earlier. When the lights come on, what we'll find out is that we have had substantial demand destruction at these prices. The physical shortages that actually created this fundamental drive higher in prices has largely resolved itself over the course of October to date. And instead, what we'll see is a shrinking supply-demand deficit, which now has more physical availability. So the timeline to depletion is substantially larger.
All right, time will tell. Thank you.
Thank you so much.
Okay.
Straight ahead, new rules for manufacturing in China. More Squawk Box in 2 minutes. Welcome back. Happening this morning on Squawk Box. Metals are higher this morning after yesterday's massive drop. Silver is leading the charge of 7%. Gold is up. Copper is up 3%. Platinum is up 5%. China reportedly bringing in a new rule to force Chinese chip makers to ensure that at least half of all new equipment is made in China. And Citigroup's board has approved the sale of its Russian unit to Renaissance Capital. Citi says it will take a pre-tax loss of $1.2 billion on that deal.
Get a final check on the markets in this last 30 seconds that we have right now. Nothing has changed.
It's impressive how static.
It is.
6909 on the S&P was the close on December 23rd. Anyone still cares about the Santa Claus rally? We're going to open right now.
And when was the all-time high on the S&P?
It was just the other day.
And we're off how much? I almost said that.
69.45.
Someone said that to Douglas Holtaken too, but I can't remember. Make sure you join us tomorrow on Streets Deck.
Good Tuesday morning. Welcome to Swap on the Street. I'm David Faber with Sarah Eisen. We're live from Post 9 at the New York Stock Exchange. Jim and Carl both have the morning off and the week off. And we'll look at futures, of course, as we get ready for trading 30 minutes from now. I don't know, what do you call that, Sarah? I don't know what you call it. Yeah, hunch. All right, I'll go with that, hunch. But we have a lot of exciting news for you. In fact, our roadmap begins with tech pressure threatening the so-called Santa Claus rally. The S&P is coming off back-to-back losses. This is investors turn the focus to Fed minutes later today.
Plus, the metals trade, we're watching it. Miners, Newmont, and Freeport among the top S&P pre-market performers here. Gold and silver seeing the best year since 1979. And Meta acquiring Singapore-based AI startup Manus in a deal reportedly worth more than $2 billion. What a good signal for the AI trends into the new year.
Start with the markets, of course, after what was a pullback yesterday, and not to mention, of course, some very exciting trading in some of the metals. Silver certainly plunging yesterday, still up enormously, even for the month, and of course coming back a bit this morning as well, Sarah.
Yeah, I mean, yesterday was crazy. It dropped 9%, biggest one-day decline since February 2021 after the CME raised margin requirements. But interestingly, a lot of people were pointing out that the silver ETF didn't see as sharp declines as the underlying commodity, maybe a signal that retail was buying on the dip, and now we're seeing a rebound to the tune of 8% today. So, I don't know, is silver in a bubble? That's what people are wondering. It's unclear that it's having any major ripple effects into other markets, like the stock market, beyond boosting some of the miners and hitting some of the miners yesterday. But overall, you do wonder why there is this mad dash into silver lately.
Yeah, well, you're in a better position to potentially answer that question than I am. This is something you certainly focus on currencies and/or some of these metals in terms of. We talked about the debasement of the currency yesterday.
It's been a big story this year. Dollar down 10%. It's having its worst year in several years. That's definitely part of it. But in December alone, I think silver is climbed more than 20%. So, seemingly out of nowhere. The one difference with gold, which is also having a tremendous year, and as part of that debasement trade, is that silver is useful. It's an industrial metal, and it's used in industrial production, which is why it's even caught the attention of Elon Musk. And look, there's a lot going on here when it comes to the precious metals. What's interesting to me is that Bitcoin has not been playing into the rally with precious metals. If that's considered also a debasement, an alternative to a fiat currency, it's not really acting that way, and that it's broadening here. We're starting to see it in copper, we're starting to see it in platinum as well. There's a lot of cross currents. The other thing that happened overnight, David, is that the Chinese yuan strengthened past 7 to the dollar for the first time in 2 years. What's the significance of that? It's just more weak dollar and stronger Chinese currency, which is just, all sorts of ramifications of that. But I think one of the surprises this year has been the strength of China's markets.
Yeah,
with all the tariffs.
Yes, in general. Well, obviously their exports are up substantially year over year, despite the fact that they are down substantially to the United States. So China's exports to the rest of the world have moved up appreciably over the course
And now they're
of the
doing
year,
military drills, right? And
Yeah, the journal focusing on some of the military drills around the, I guess, up north in the ice as well, what they're doing there, and then of course the drills around Taiwan, to your point. We talk a lot about China. We'll continue to, of course, the world's second largest economy, and obviously a very important one. Back to here, though, as we sort of wrap up the year, Sarah, you know, and particularly the Fed, something you focus on as well. We did get some thoughts from the president, which is not a rarity, of course, when he's talking about the Fed and/or his unhappiness, perhaps, to a certain extent with Powell, whose term is going to end fairly soon. What's he got, 3 more meetings?
He's got 3 more meetings. His term is up at the end of May. President Trump yesterday actually threatened to sue him. Did you hear that?
I did.
Listen.
We're thinking about bringing a suit against Powell for incompetence. There is nothing you can do about it. He's just a very incompetent man, but we're going to probably bring a lawsuit against him.
Announcement then on Powell's replacement.
January sometime.
And will you ask Jay Powell to resign from the board
entirely? I'll be a favor to the nation. But he's come close. I mean, we're getting pretty close. I would fire him. I'd love to fire him, but we're so close, you know, but maybe I still might.
He didn't say he'd fire him, which is, I think, all that matters to the markets right now. The suit, I don't know. I think he was referring to the construction that he's been critical of the Fed.
Yes, remember that was that famous back and forth with them both in hard hats, where Powell was disagreeing with him in terms of what he was saying was spent.
I think it would be a tough
on the new Fed building.
Right. He's laying the blame at Powell's feet for, I don't know, cost overruns or spending so much on this building. But I think, you know, the Fed is an institution that dots its I's and crosses its T's when it comes to paperwork and when it comes to things like this. I mean, this was a project whose budget was approved every single year by the Fed Board of Governors. So it's not exactly like Fed Chair Powell himself was in there with a hard hat, you know, ordering certain marble desks or anything like that. So whether any of this comes to fruition, I don't see a big concern in the bond market, for instance, on any of this. I mean, you'd really start to see if there were real concerns about Fed independence or firing Powell or anything like that, you'd see bond yields.
Right, well, we don't know the pick yet. We'll have to see, and obviously we'll be waiting to see what the leadership is like under whoever the new leader is.
Right, but the new leader, I mean, all 4 candidates who have been mentioned, I think are all credible in the eyes of the markets. Maybe they'd rather see Waller than Hassett. Maybe that would be seen as a little bit more independent or a little bit, you know, less loyalist to the Trump administration. But bottom line, it's 1 vote. Yes, it's the chair vote. It can swing it. And as I keep saying, the bond market is going to be the ultimate arbiter of whether, you know, the Fed is making a mistake. If they're easing interest rates too much into an inflationary period, you'll see that show up in the bond market, and it'll stop the Fed in its tracks pretty quickly.
Right.
That's one of the big questions next year, David. Less, you know,
and
who's going to be the Fed chair, but more what's going to happen with inflation.
And we have talked a lot about the diversion in terms of short versus long right now. The 10-year sort of hanging around there at 4.1 or so.
Yeah, we have a steepening yield curve going into the year. It is not the inversion that we have been seeing in the last few years. Look, the economic outlook next year, I think, is solid, but there are some risks to be aware of. Number 1, you know, inflation is weighing on consumer budgets. We're closer to 3 than 2. We're away from the Fed's target. We're not climbing like we were during the Biden years, but you know, it's still elevated, and that presents a risk. That's where the affordability challenges come in. Hiring has slowed to a stall speed, and now these AI fears are creating more worries about whether people will have jobs coming out of college, people will continue to have jobs and, you know, will be paid higher wages. So there are definitely risks to be aware of, but I can tell you on the plus side, there's a lot going for the economy too.
Yeah, without a doubt. And in part, a lot of that is tied to spending on AI, obviously, and the building of data centers and the compute that's needed to power so much of what is expected, at least, to generate significant returns at some point in the future. Sir, I did want to get to some news this morning in that world, because yesterday we were discussing SoftBank's acquisition of Digital Bridge, and I brought up OpenAI, of course, which we continue to focus on, which is in the market, it would seem, for raising as much as $100 billion. Perhaps at a valuation, according to reports, I haven't confirmed this, at $750 billion value for OpenAI, such an important company, but a private company, of course. Yesterday, I was sort of musing aloud, or at least questioning, saying, where was SoftBank in terms of the $40 billion last, let's call it March 31st, early April, when they said we're going to invest $40 billion in OpenAI. The pre-money valuation, $260 billion. And I cannot tell you, according to sources who are familiar with the situation, they funded the entire amount. $10 billion was syndicated, and then they had already invested another $8 billion or so. But my understanding now is about 22 or 22.5 billion was sent over last week, and so SoftBank has made good on its $40 billion commitment to OpenAI. Again, announced early last year, let's call it right at the beginning of the second quarter of last year, at a $260 billion value. By the way, the money looks pretty good right now. It's going to take SoftBank's ownership north of 10%. I don't have the exact numbers for you. To put it in perspective, of course, the initial benefactor of OpenAI, Microsoft, under their new cap structure, will own or still owns around 27% of the company. But SoftBank, a very significant owner of OpenAI, and again, has made good, I am told, by sources familiar, on that full $40 billion commitment, Sarah. And we talked about the fact that because OpenAI is not a public company, there are various ways to try to play it, so to speak, and SoftBank certainly has been one of them, given its the importance that company, that investment now has to SoftBank's future.
I think it just highlights just how much money and how much scrambling there's been to get the money to fund this very ambitious AI build-out of data centers. Just yesterday, we were reporting that SoftBank spending $4 billion
on Digital Bridge, on a data center company where leases are already in place, but conceivably will allow them to have future compute capacity as well. I know, I'm looking through my OpenAI file, which you were marking on before.
It's very large.
Yes, it is. It's only getting bigger.
We don't have that much news today.
No, but more and more things get put in here. The debt, obviously, OpenAI is using to help fund it. Their $1.4 trillion of compute costs, let's call it, over the next 8 years that they've committed to at OpenAI. This is the key, in many ways, in the market, really, in terms of, A, will they be able to raise it all, using other balance sheets, and clearly, because you need Oracle's balance sheet, you need Microsoft's balance sheet, you need so many to do that. Obviously, you've got the Stargate project, kind of separate but related, being built as well for a lot. It will go on and on.
$500 billion initiative by OpenAI, by SoftBank, by Oracle.
Oracle, and I think it's MGX or one of the,
Is this part of that?
This money went directly into OpenAI. This was direct to OpenAI, separate from Stargate. Let's stay on topic here, talk a bit more about semiconductors, of course, as well. The biggest gainers of the year, outperforming some of the hyperscalers, in fact, in the so-called AI trade. NVIDIA, Broadcom, AMD, Intel, all of them up more than 40% year to date. Joining us to talk about what we saw and really more what we can expect in 2026 is Stacy Raskin. He's Senior Semiconductor Analyst at Bernstein. Stacy, good to have you. Does it just keep going next year? The Journal writes a long story today, talking about the various gating issues, whether it's lack of transformers for the power or memory. How do you see things evolving next year?
Yeah, I think it probably still goes. It's funny, like our general call in 25, if I wanted to sum it up, was kind of own the high quality AI names, ignore most of the, I guess you could have owned the lower quality AI names too, but I mean AI was working pretty well, and I actually don't think it stops in 2026. You can look at the forecast that companies like NVIDIA or Broadcom have put out. You can look at where the current estimates are, and they're still way below that. I think there's still plenty of room for numbers to move higher. And even the valuations are not crazy for a lot of these names. NVIDIA, Broadcom. I mean, NVIDIA's in about the low 20s price forward earnings for amazing growth. I understand all the worries about like peak spending and digestion cycles and everything else, but I mean, look, people have been worried about that since this started. And kind of look at where things are going. That clearly wasn't a problem in 25. If you look at like the committed volumes that are already there, it's probably not an issue for 2026. And assuming OpenAI does execute on their commitments, and we'll see, but if that happens, it doesn't even start until the end of 26, that spending, so it may not even be 2027 either. I think this trade still has legs, I think so.
Yeah. So, all right, you and I maybe have the same conversation a year from now. I am curious though, because we are going to be discussing more, the competition to the extent that NVIDIA faces any at all. But whether it's Alphabet's TPU, which certainly we've been talking a lot about of late, whether it's Broadcom trying to help OpenAI design its own chip, because you got to get cost per token, per dollar, per watt down over there versus your competitor Gemini. How do you see that evolving in 26?
Yeah, so there's always competition. This is semiconductors, so it's on NVIDIA as well as on all these other players to make sure that they're moving their roadmaps along and keeping innovation going. And I've said this, I think, on the show in the past, but I still think right now it's sort of, I understand the nervousness, the narrative swings back and forth, GPU, TPU, and back again. It's one reason we've advocated owning both NVIDIA and Broadcom. Like, you never know which way it's going to swing in any given moment. I still think it's the wrong time to really worry about that in general. I think the right question asked today is still, is the opportunity in front of us still big or is it not? Like, rather than who's winning or losing, because presumably we're not in a mature, saturated market yet. If you think we are, like, there's a whole other set of questions you might want to ask. But in a world where things I think are still growing, like, massively, if the opportunity is still big, then everybody thrives. And if it's not big, then everybody's screwed. Right? So I don't think we're at the point yet where I necessarily, from a fundamental basis, have to worry about who's winning and losing. I would just own the space, frankly.
The other commitment being made, and this was really a surprise stock this year, was Intel. So NVIDIA closed the $5 billion purchase of Intel, that commitment that it had made to invest. Intel got a lot of investors this year, including the U.S. government. The stock up 90% this year. Does that momentum continue? Because that's been one of the best opportunities off one of the most beaten down names.
Yeah, and it's funny too, because it's not like the fundamentals have really gotten a lot better there. Right? This has been more, sentiment. And again, I said before, like, if Donald Trump wants the stock to go up, like that's a bull case of sorts. It's not necessarily my kind of bull case, but I guess that's a bull case of sorts. At the same time, I think the fundamentals are still, like, really challenged. So they don't really have much of an AI story to speak of at this point. I think on their core business, like PCs, for example, they've been very strong this year, like on the Windows end of life. Given some of the memory shortages and other things, I think PCs are going to be under pressure next year, and that probably impacts Intel more than anybody else. On the server side, we're in a server cycle right now, which I think is good, but at the same time, they're bleeding share to AMD and x86 servers, and x86 is losing share to ARM servers, and CPUs in general losing share to accelerators. So they have sort of like 3 stacked layers of share loss that I don't really have a great answer to for any of them. I think, and clearly the foundry is still bleeding, and so we'll see if they can attract customers and everything there. And I guess we'll know maybe this time next year, maybe we'll know a little more there. But I think the fundamentals are still very, very challenging. The stock is very expensive because they don't have any earnings still.
That can be an issue.
It's too hard to
capital.
Yeah. Hey, Stacy, on Christmas Eve at around 4 o'clock, we broke the story on Grok. I felt bad for everybody, including myself, by the way. But it was $20 million. Initially, I was like, well, they got to be buying the company. It ends up being this, what they call a non-exclusive licensing agreement, where they also basically take all the employees, including Jonathan Ross. But I wanted to get a chance to just ask you what you think, because, as I reported, NVIDIA moved very quickly here. They negotiated this deal very quickly. A lot of the money's already been wired. Why do you think they were moving so quickly? What are they getting here?
Yeah, so I know it was a license. It's basically an acquisition. We've seen other deals like this in the past. It's to try to, like, sort of get the workaround on antitrust and to get the deal done quickly. It's basically done. Right? I think the employees have moved and the cash is transferred.
Totally, they're working for NVIDIA now. Yeah.
And brother, I think it was Christmas Eve. We actually put out a note on Christmas Eve and on this, and I thought it was funny though that NVIDIA now is so big that they can do a $20 billion deal on Christmas Eve with no press release. And everybody just kind of shrugs and goes back to their daily process, right? I mean, it wasn't a big deal for them, given, at a $4 or $5 trillion market cap, $20 billion is just not very
Nothing. Although it's a third of their cash, to be fair. It's a lot. You may want to let your shareholders know at least what you're thinking, what they're doing with their money.
True, but it's like, at this point, the way things are going, it's probably like 1 quarter's worth of free cash flow, right? The way that they're generating. So and I'll give Jensen the benefit of the doubt, right? And look, you're getting a lot of talent here. Grok has kind of an interesting architecture. very useful for like very high bandwidth, low latency inference, which is something the GPUs are a little less useful for. So, Jensen's building out his stack and building out his offerings. And I'm giving the benefit of the doubt at this level. I don't know why they felt the need to get it done as quickly as they did, frankly, but like I said, I'll give him the benefit of the doubt. His instincts have generally been pretty good, and at least I can see how it fits into the portfolio pretty well. Is it worth $20 billion? I don't know, but I mean, it's fine. It's fine for them.
Interesting times for sure.
Yeah.
Stacy, thank you. If we don't see you, Happy New Year, and we'll certainly see you in the New Year as well. Appreciate it.
Yeah, you bet.
Coming up on the show, the road ahead for commercial real estate in 2026. Diana Olick covering all the bases. Morning, Diana.
Good morning, Sarah. Yeah, we'll look at all the sectors everyone's watching, from office to data centers, and tell you what investors in the space are thinking for the year ahead. That's this week's Property Play, coming up next on Swap on the Street.
Welcome back. Real estate is this year's biggest laggard among the S&P 500 sectors. It's only about 0.5%. Diana Olick taking a look in this week's Property Play of what lies ahead for commercial real estate in 2026. Any relief, Diana?
Well, unfortunately, Sarah, CRE leaders are slightly less optimistic than they were ahead of 2025. That, according to a Deloitte survey, 83% of respondents said they expect their revenues to improve by the end of 2026. That's compared with 88% last year. Fewer respondents said they plan to increase spending, while more expect to keep spending flat. 68% said they anticipate higher expenses overall next year. Sentiment is down from last year, but well above that of 2023. Okay, so let's drill down on specific sectors, starting with office, which seems to have bottomed. Vacancy rates are expected to drop below 18% as more tenants return to the market. That according to Colliers. There will continue to be a flight to quality as Class A buildings in many markets are now almost fully occupied. Office construction is also at its lowest level in over 3 decades, according to Yardi. Now, in multifamily, rents are starting to ease as a record level of new supply continues to make it through the pipeline. Multifamily has led investment sales volume since 2015, and there are no signs of this changing, but its share of total volume is expected to ease somewhat as investors allocate more capital to things like office, data centers, and retail, according to Colliers. Speaking of data centers, the darling of 2025, with demand significantly outpacing supply, Deloitte called the sector a clear bright spot in the U.S. commercial real estate landscape. It pointed to 9 major global markets where 100% of the new construction pipeline is already fully pre-leased. Data centers, however, do face some headwinds in financing, grid capacity, which we talk about a lot, zoning, and even local politics. Now for the outlook on more sectors as well as property technology, PropTech, make sure you're signed up for the CNBC Property Play newsletter. That's cnbc.com/Property Play. It's out, guys.
I mean, it's a reminder, Diana, that a lot of these real estate companies are now entwined with the AI trade. And if there is a sort of bubble that bursts or a boom that busts, they're going down with it.
Yeah, absolutely. It's amazing how much, we have a section called Prop Tech Talk in the newsletter, and the number of pitches I get for that specific section is just off the charts. Property technology, as well as the data just informing investors about commercial real estate, has really just gone kind of, as I said, off the charts with AI. And it is going to be reliant on that. It's not just data centers, it's operations facilities with every type of building out there. And again, the capital coming into real estate, that it's being told what to do by AI.
Diana, thank you. Diana Olick. The opening bell, less than 5 minutes away. Don't go anywhere. Welcome back. About a minute and a half before we get started with trading here at the New York Stock Exchange. Let's bring in senior markets commentator Mike Santoli, find out what he's thinking about this morning. Mike.
Yeah, David, obviously a pretty steady open, and I think steadiness is something that's defined this market for a little while right now. Yesterday, you saw a really distinct action that was really just kind of portfolio pruning, right? Leaders for year-to-date basis got sold a little bit. It seems like tax loss selling is pretty much through, so a lot of laggard groups did get picked up. But in general, we're kind of going sideways from levels first reached 2 months ago, and it's not a high momentum bull market, but it's a rotational one. So whether this means the market's kind of refreshed itself, or is in fact just kind of stalling out and showing that a lot of people don't really need to ramp exposure, I think that's one of the questions going into next year, as is, of course, whether I think collectively investors are going to have enough of an appetite to consume all the new capital that the AI community is going to try to consume when it, try to issue when it comes to IPOs, debt, and all the rest of it. So maybe that's tomorrow's question, but I think it's a relevant one.
Yeah. Money just keeps flowing, of course, as we reported earlier. SoftBank making good on the rest of its commitment to OpenAI. $40 billion agreed to last March 31st. Mike's going to stick around, by the way. Let's get the opening bell. Take a look at the real-time exchange as we get started with trading. Non-profit still rising. Welcome to the first we're doing on this. We're celebrating their merger over the NASDAQ 40. Celebrating the launch of the founder-led ETF.
You know, a stat that stood out to me, it was another tough year, I know you follow this too, for active managers. So around $1 trillion was pulled from active equity mutual funds over the year. 11th year in a row, we have seen net outflows, while no surprise, passive investing, ETFs, $600 billion went into there. It just shows how hard it is for these active mutual fund managers to keep up with the indexes with such concentration high around some of these big names.
Without a doubt. Mike, when it comes to active management, where are we on actively managed ETFs? Is that compared to actively managed mutual funds? I'm just it's not an area I focus that much on, so I don't know the performance metrics.
It's been a booming area because basically every traditional long-only manager with active funds has at least tried to create, or most of them have tried to create, just an ETF structure, which really doesn't solve the stock picking problem, but it does make for a more tax-efficient, lower-cost way of accessing that stock-picking expertise such as it is. But just to Sarah's point about how tough it's been to find stocks that can outperform this market, I looked yesterday, the median stock in the S&P 500 is up like 7% year-to-date. Okay, the S&P 500 itself is up 17% year-to-date, and even the equal-weighted S&P 500 is up 10%. So there's all these different ways of just kind of more or less doing a kind of buy-the-market philosophy and approach that doesn't involve trying to find individual securities that win. Now, of course, we could always pick the big winners of the year. You look at all the memory stocks, you look at Robinhood, something like that, and it says, wow, you really had a chance to hit home runs. But obviously that gets kind of pretty much low probabilities as you spread that around different ideas. So at some point, I do think that the concentration of the market will ease, but it'll probably be in the context of either a bear market or a severe correction. I will point out that in 2022, we did have that 9-month bear market. The NASDAQ underperformed, the Mag 7 underperformed the S&P, and you did have things like quality and equal weight do a little bit better.
But it has been rare, those moments when active management certainly has outperformed, Sarah. Yeah, we talk about it almost year after year. To your point, the money continues to move towards
ETFs, passive.
Yep, or being indexed to the broader market.
It's working. S&P is up, 17% this year. Just want to point out that some of the action in commodities, we talked about some of the precious metals, but oil is also firmer, and energy stocks are getting a bid. They're at the top of the market again today, so they've a little bit of a comeback, still only up about 5.5%, so they've really underperformed this year. Just in terms of fundamental news flow, yes, maybe there was some expectation more would come out of the meetings with the discussions with President Trump, with President Putin, and Zelensky, not a big imminent resolution there. Also, I think importantly, President Trump stood hand in hand with Prime Minister Netanyahu yesterday in Mar-a-Lago and threatened Iran. that they would face strikes if they seek to replenish their ballistic missiles or their nuclear arms program. So just, few geopolitical risks to put front and center into next year. It's hard to extrapolate necessarily what those mean for the markets, but we watch them, and we watch things like rising gold prices and wonder if it's a hedge against the geopolitical risk. Not to mention what's happening in Venezuela right now, in China, I told you, doing military drills. I mean, we're watching all of this going into next year. A lot of simmering pots here.
As we should. Although, Mike, it seems rare that geopolitics truly seems to stop the momentum of the market one way or the other for a particularly long period of time.
No, for sure. I mean, every 5-year chart right now, whether it's commodities or stocks, does have that, quick shock, kind of interruption in the invasion of Russia by Russia of Ukraine, and then it was almost completely undone in a hurry. And whether that was currencies or commodities or equity, so it does show you the market has the calluses built up against a lot of that, especially when you consider that usually those things would get conveyed into the risk financial markets through the price of oil. And now we have such an oversupplied world when it comes to oil, and it's not any longer, kind of supply being controlled in a narrow fashion by a handful of countries. I think there's a lot more ease about that. And so, yeah, Sarah's right. We have seen this firming up of usable commodities in addition to things like gold. And it's part of this general, hey, maybe there's a reflation trade happening, reflation before inflation, rest of the world running pretty heavy on the fiscal sort of spigots are open, things like that. I don't know if it's really a trend change, but it shows you as you get to year end, I think investors look at outliers to the downside and make a case that you can get a little bit of a mean reversion move. That's sometimes a January activity, and all of those seasonal effects, I think, kind of get anticipated by the market.
I mean, part of it just might be lower rates, finds its way, easy money, right? And I mentioned the Fed. It will be in focus today because we'll get minutes at 2 p.m. and that's the notes from the last Fed meeting. And the intrigue here is around the dissents because it was highly unusual to get 3 dissents. We know Myron wants lower rates, but I'll be looking for the comments around Goolsbee and Schmidt, who were dissenters who wanted to hold, and what that debate looked like, and whether we get more clarity as to just how divided the committee was and how much sympathy there was for the idea of holding. So right now, Mike, the market is expecting, 2 rate cuts next year. The dot plot, which is the Fed's own forecast, I think the median projection is 1 rate cut next year, but there are a lot of wild cards, like who's going to be the Fed chair, like what's going to happen with inflation, and ultimately what's going to happen with jobs.
For sure, and I think that you don't necessarily have to be an alarmist about inflation to feel as if there's no hurry to cut, at least there wasn't in December, when you are that much closer to whatever the neutral rate is. We've cut by 175 basis points in 15 months. There's a feeling out there, not only that inflation has been sticky, but that literally everybody is expecting a little bit of a fiscal boost into next year with the tax refunds and the CapEx expensing. Whether we get it or not, that's what's anticipated. So it's kind of like, what's our hurry to get rates even lower? Now, the real question is the disconnect between GDP and jobs, because the Fed's mandate on the employment side, on the growth side, is for jobs. And so that's the thing that is going to be fascinating to monitor in the months ahead.
Yeah. A little bit of news this morning. We shared, of course, already that news, according to sources, that SoftBank has completed its $40 billion worth of investment in OpenAI. $10 billion of it was syndicated, but the $30 billion from SoftBank to OpenAI, that has been completed with what I'm told is a $22.5 billion investment last week or in the last week or so, completing its full commitment. It announced it March 31st of last year. It was a post-money value of $300 billion. SoftBank now owns north of 10%, let's call it, of OpenAI. Not its largest shareholder. That continues to be Microsoft, for example, at roughly 27%. Or so. But it is interesting to note shares of Oracle are up this morning. Anytime OpenAI takes in more money, you can see Oracle potentially be a beneficiary, given the huge commitment that OpenAI has to Oracle in terms of paying it some $300 billion over the next 5 years to build and outfit data centers for the enormous amounts of compute, of course, that OpenAI needs and is continuing to seek money from and or building from so many around the world, whether they be the hyperscalers or even sovereigns as well, who are part of the investments and others. but did want to note that. And then when it comes to AI this morning, Sarah, we do have this Meta purchase. It's small, $2 billion, or more than is what the journal is citing. This is their story. It's a Singapore-based company, and they previewed an AI agent last March, apparently, that was capable of producing detailed research reports and building custom websites using other AI models that were developed by the likes of Anthropic or China's Alibaba. We've talked often about Meta spending, which is virtually at a par with some of the hyperscalers such as Microsoft and Alphabet or Amazon. They all have cloud businesses. Meta does not, and yet this would seem to indicate their focus perhaps on really trying to compete in terms of AI agents and how important that's going to be as 2026 gets started.
A really fast-growing company. In December, apparently it had crossed $100 million in annual recurring revenue 8 months after it had launched. I think the other interesting fact here is that it has Chinese founders, right? So is it part of the Chinese AI ecosystem or the US ecosystem? I know it's a Singapore-based company, but I noted that because typically you don't see US companies acquiring Chinese-founded companies on AI.
No, you don't.
I wonder if that raises any alarm.
I know, it is interesting. Meta says it plans to continue to operate and sell their services integrated into a suite of social media products and scale the service to many more businesses. That was Meta's announcement as well when they confirmed the transaction. You can see the stock, of course, has underperformed during the course of the year. It took that enormous hit when, after last earnings, when they came out with numbers in terms of CapEx certainly that were quite high and perhaps concerning to some who continue to wonder
what's the payoff?
Yeah, what's the payoff?
They don't have the enterprise business, they don't have the cloud business, but what they do have, unlike some of the others, is that they are able to monetize a lot of the AI in terms of their advertising business. They're just getting a lot more bang for their buck when it comes to advertising using AI. I guess the question is long term, if they're spending, what, $70 billion a year on the build out, how do you compete with the Google, how do you compete with the Microsoft, because they have the big enterprise business.
Yeah. Not to mention, of course, the metaverse and how much they spent there, Reality Labs, so much spending at Meta, and yet ultimately shareholders always come back to them and reward them, given the incredible margins and earnings growth of that company. Sarah, permit me for a minute to diverge back to my favorite situation, of course, the fight for Warner Brothers, if we can this morning. We haven't heard the response yet from Warner Brothers to what was that revised proposal from Paramount last week, where they tidied up the equity financing, if we can call it that, saying it's an irrevocable guarantee from Larry Ellison for $40.4 billion in equity. Is that going to be enough to move Warner Brothers' board to Paramount's deal and say to Netflix, we now view that as superior to your own bid and you have to come back? No. People are close to the situation fully expect that. When we do get the response, I'm not sure if it's going to be tomorrow, kind of a weird shortened day, or whether it will be Friday, but we are going to get it soon, and it will be not a surprise at all, saying no thank you. What are they going to rely on? I am curious still to see whether they're going to give us more explanation of their view and valuation around the global networks piece of the business that will trade publicly, given the Netflix deal is only for the streaming and studio part of Warner Brothers. But what they're also going to talk about apparently is, we still wonder whether we will be able to refinance a bridge for global networks of $1.5 billion. Essentially want Paramount to walk in or move into the merger agreement and all the terms thereof that's already been signed by Netflix. And there's been some expression of disillusionment to me as to, well, they don't seem to want to do that, or why haven't they done that yet? We'll see. And then another question is around, I pointed out that the $30 a share from Paramount does not include the payment of $2.8 billion breakup fee to Netflix, were they, Warner Brothers, to accept that. It would become a liability of Paramount's, but Warner Brothers is saying, yeah, if it's a liability and then your deal doesn't go through, and then you have to pay us a reverse break fee of $5.8 billion, but we've got this liability of $2.8 billion, we're only getting $3 billion. This gives you some sense, at least in terms of some of the objections that may be made when we do hear officially from Warner Brothers.
I just think it's going to be an antitrust
Nightmare. By the way, it could be on both sides. You still have the possibility nobody gets this deal done.
Right, is the highest probability.
And in Europe, too.
Never closes. Is that?
I don't know if it's the highest probability, and certainly Paramount could say we have the easier way to completion, but these are unknowns. And don't forget Europe. It's very important both for Netflix and for Paramount.
I mean, I think Netflix was the only thing that didn't have antitrust scrutiny. And now, this is a whole new world
Without
of
doubt.
regulatory
They
uncertainty.
have put themselves squarely under that scrutiny.
All right. Mike, thank you for joining us. Mike Santoli. By the way, don't miss closing bell today, 3 p.m. Eastern. Mike is bringing the famed mystery broker. He's finally going to reveal his identity. This is someone, if you've read Mike Santoli.
Why are you doing that, Mike? It's not me doing it. It's him doing it. Yeah.
What, he wants to come public?
Yeah, he's decided it's time. So,
You better
we'll
be
see.
good. There's a high expectation here.
Yeah, I know the pressure is on. I kind of will be glad once we're through it and we can dispense with it. But it's been a fun gimmick for 16 years now, actually. And a lot of people have followed his calls over the years, many good ones.
All right, can't wait, Mike. See you at 3 p.m. Mike Santoli and the mystery broker. We'll be right back here on Squawk on the Street.
Welcome back to Squawk on the Street. Rick Santoli here live at San Diego with the breaking news of the morning. Our December read on Chicago PMI expecting the number around 40. Much better, 43.5. That would be the best read since October, and last month's 36.3, well, that was the lowest level going back to May of 24, so a decent rebound. It is the 24th consecutive month in contraction territory. We haven't been above 50 going all the way back to November of 2023. You want to pay particularly close attention to the foreign exchange market today, especially the dollar versus the Chinese currency. It's at a 2.5-year extreme. And Squawk on the Street will return after a short break.
As we take a look towards 2026, media investors weighing streaming margins, content discipline, and whether consolidation can drive better returns. Joining us now to frame the outlook for the sector, Barton Crockett, Rosenblatt Securities Senior Internet Media Research Analyst. Barton, on that note, let me start with Netflix, because it's been a question to me, of course. They have a merger agreement to buy Warner Brothers, or at least the streaming and studio of Warner Brothers. How do you view Netflix as it heads into next year? Obviously, it will not close the deal for quite some period of time, if at all. But how do you view it from a multiple perspective, from what that says about the company's business, and how you view the stock?
Yeah, look, we moved to a neutral rating on Netflix around this deal. We do think that this is going to stretch out. We think it could potentially become a competitive bidding situation. And we think it raises some questions about Netflix's capital kind of allocation priorities. And, for those reasons, we had formerly thought that Netflix could trade at a premium to its growth rate. Now we think it gets less of a premium. So we've got a $105 price target. Still a great company, but I think it's going to be hard for the stock to really work as we digest what in the world is going to be the outcome here. And clearly, two very different outcomes if they win or if they lose. I suspect at the end of the day, they're not going to walk away with this because I think, the party on the other side, the Ellisons, can just write a bigger check, and I think ultimately that's what it comes down to.
It could, although Larry Ellison didn't become one of the world's wealthiest men by making poor economic decisions. That said, either way, let's say Netflix just remains obviously in contract to purchase streaming and studio of Warner Brothers. They're not going to get the deal done next year. So is the stock just dead money as it waits for the regulatory approvals to potentially come in?
Yeah, I think it's hard for the stock to work when there's concern about them having to raise their bid. And I think that's really kind of the biggest overhang. And then, in terms of like the core business, I do think that, one of the questions that comes up with this deal that they've entered into, this agreement that they've entered into is this really the right place to put this much capital at this point? Netflix has clearly done great with scripted content and TV and movies on their own. Do they need to put all this money to get, more kind of scripted content, great scripted content, but more content from Warner Brothers? Or would they be better off moving in a different direction, where there's more user growth right now in places like user-generated short-form content, or lean deeper into the free ad-supported television areas? Both of those seem to be much stronger areas of consumer interest right now, and I think we have some concern that perhaps they're overly distracted by what's been their strength, which is scripted, and missing the change in what's happening in the market right now, which is these other formats.
I wanted to ask you about this Meta deal today. So it's buying Manus, which at one point it's an AI agent company, right? At one point was hailed by Chinese state media as the next DeepSeek. What do you make of this deal?
Look, I think that this is potentially a great deal for Meta. It's a deal that time will tell, but it has the markings of what could become something that we look back on years later and think, geez, this is not too dissimilar to the home run they had with their acquisitions of Instagram and WhatsApp. And what I think you get with this deal is you get just a rocket ship growth story in agentic AI that fits really beautifully into all of the things that Meta's been leaning into SMBs, services internationally through WhatsApp, what are kind of, over 10 billion kind of revenue run rate growing rapidly, businesses within Meta. This provides a whole new kind of product suite that's kind of clearly demonstrated a great product market fit with what they've done thus far, and could really be kind of supercharged underneath Meta. So we think this sounds great. We think the Chinese tie, is a question, but the company has moved really aggressively to distance itself from China, laying off its Chinese employees, moving to Singapore, not really doing business in China. And from what we're reading, it looks like the deal is completed. So, this could be really, we think, great for Meta.
Is it an enterprise product more, or is it a consumer product?
Look, I think it's an enterprise product for SMBs. People who are trying to get a lot done with a small employee base. You can script an agent to help you do things like research your competition, build your website, satisfy kind of customer kind of demands, and do some customer kind of analysis. It makes SMBs more powerful, and in that way fits great within WhatsApp. But it's also a capability that they could transform to pursue this vision that Mark has of personal AI, which is an AI that serves people's needs, and in that way it goes beyond SMBs, but it could be something that undergirds kind of new AI capabilities that provide to their over 3 billion daily users globally. So this could be a very fundamental kind of capability for Meta as we go forward.
Interesting. All right, keep a close eye on that. Barton, thank you. Appreciate it as always.
Thank you.
When we come back, we're going to have more on this Meta deal to acquire AI startup Manus. Another hour of Squawk on the Street. Straight ahead. morning. Welcome to Squawk on the Street. I'm Sarah Eisen here with David Faber. We are live from Post 9 of the New York Stock Exchange. Carl Quintanilla has the week off. It's the second to last trading day of the year, and after solid gains in 2025, one market expert says there are 3 reasons to remain bullish. That's coming up in a moment. Plus, Meta making a deeper push into AI agents with an acquisition reportedly worth billions. But will it move the needle in the AI horse race in 2026? And China reportedly cracking down on foreign chip makers, requiring firms to rely more on domestic suppliers. We'll talk to an analyst who says the rule could change the impact to NVIDIA in the country. But first, David, we always start with the big macro stories.
Yes, we do, Sarah.
And since it's a little light,
favorite part of my day.
This morning we're going to do the big macro charts that defined 2025 today and tomorrow. So here's 3 that I think really tell the story of what happened in the economy. The first one, it's tariff revenues. April 2nd, Liberation Day. Some of it was walked back, but you know what? A lot of tariffs went into place. If you take this chart back a few years, there was barely any tariff revenue collected. In the last few months, we're talking about $30 billion a month collected. So we're up almost $200 billion in tariff revenues. What's going to happen with that money? The president has floated all sorts of things, like giving it to Americans and checks, getting rid of the income tax. It's clearly not going to do that.
Military, $1,776.
But it is money coming into U.S. coffers that was not doing that. And also, there's some uncertainty around this money in the Supreme Court decision. What happens with reciprocal tariffs, IEEPA tariffs? We're expecting a decision there. If the court finds it unconstitutional or illegal that the president went through with this, I think the question is how fast they could get other structures up and running, because what we've heard from the administration is tariffs are here to stay. And I think another question is, if we get a Democratic administration coming next, do they continue to rely? I mean, it's a lot of money now
It's a
coming
lot
in.
of money, and it helps certainly for the deficit. That said, a year ago, and certainly for months following this period of time last year, we talked about who's going to pay it. And the drag it would have on the economy and the inflationary impact. And here we are. And so my question to you is, who did end up paying this? Where did all this money come from?
3 places. It was a sort of a third is what the best estimate of economists are. Some of it borne by the consumers, but definitely not the kind of inflationary spike that was initially expected. And remember, people were talking about recession when this was announced. And that's not happening. So some of it borne by consumers, you do see that in places like video games, some of the electronics, where we just don't make that stuff here, and the manufacturer has to pass it on. But some of it, borne by the companies themselves, and they're able to offset that maybe with, AI productivity gains, and that's why we haven't seen a bigger hit to margins. But I follow the retailers, David. They talk about the billions of dollars that are, eating in from tariffs.
Yeah, Nike, for example, which you follow
Good
closely.
poster child for that.
Yes.
All the retailers are paying up for this.
Sure.
And then some of it is being borne by the foreign suppliers who are, competing to maintain their market share with U.S. manufacturers and U.S. retailers to sell into the U.S. consumer, which is what the Trump administration wanted. So the best guess is that it's a mixture of all of that, and that's why we haven't seen it all go up into consumer prices. So it's been a better than expected news story, I would say. Another chart of the year. Electricity prices. So we talk about how inflation's been tamer, but not so much on your electric bills. This is what's happened in 2025. Yes, data centers, the build-out gets some of the blame here, but when it comes to affordability problems from consumers on their monthly bills, this one's front
And
and
then
center.
there is that looming question as well, given all of the needs of the data centers that are both in existence and coming into existence over the next, let's call it 5 years, as to whether that is going to also end up taking rates even higher, given capacity constraints and the like. Even if you're building your own power plants, and it still is an open question as to what the impact will be.
It's just supply and demand, and it makes it harder to fight on the inflationary front for the Fed or even the federal government when there's just so much need. And that brings us to the last chart of the year, which is the Fed funds rate. This is just what the Fed has done, and you can see the 3 steps down. They've cut rates 3 times. Now, it's interesting that the president has ramped up his criticism again yesterday on Fed Chair Powell, calling him incompetent when he's actually doing what the president wanted. There's a live debate about whether the Fed needs to be cutting rates right now, and they are cutting rates. They're more worried about the jobs market than they are the inflationary picture. But I think, as you'll see in the minutes today, there's still some worries about the inflationary picture. So we got 3 rate cuts, which was maybe more than a lot of people expected going into this year, certainly after the tariffs.
Well, it would appear that affordability, despite the fact that the president may call it a hoax, is going to continue to be a key issue in 2026.
Yes, and with the midterms, and we'll see what we get. And that's one reason actually that it's an upside case on the markets, which is the president and the administration is squarely focused on affordability going into the midterms. The effects of the One Big Beautiful Bill should help. I mean, the CBO estimates it will add 0.9% to GDP next year. Higher tax refunds, the expensing rules for businesses when it comes to equipment, that sort of thing. That should help, but look, if we're paying more for electricity, that's a hard one. We're paying more for healthcare, for insurance.
Health insurance and every other kind of insurance.
And a lot of health services as well. Some at the grocery store, but it's hard to figure out exactly which ones are controllable and what the federal government can do about it. Do they send checks, to make things feel more easy? That's been floated.
Yeah, although is that inflationary? I mean, everybody talks about Biden sending everybody checks and what that did. Back to tariff revenue. I mean, where are we though? Even despite this influx of significant amounts of money, the deficit is going to end the year at what?
$1.8
trillion. And the national
So
debt now approaching, we're 38?
We're almost $40 billion, yeah. And
so interest costs right around.
Actually, the deficit has been a better than expected story
As a
this
percent,
year.
at least, of
As a
overall.
percent of GDP. We've had more, it helps, for instance, that the stock market has done really well. That brings in a little bit more revenue. People's incomes have gone up. That brings in a little bit more tax revenue. But the good news not necessarily is set to last, because I think the effect of the One Big Beautiful Bill starting next year will ultimately weigh a little bit more on the deficit. But the tariffs, they're helpful, but they're not, they're not a game changer for our fiscal picture. We'll turn now, with that in mind, to the broader markets on the second to last trading day of the year. Joining us is Dan Greenhouse, Chief Strategist and Managing Director at Solus Alternative Asset Management. How are you feeling, Dan, going into next year after we've chalked up another double-digit gain for the market this year?
I still feel pretty good. I keep talking about, yes, the calendar has turned, but what are the themes still at work? And the AI theme is still driving markets top to bottom. And we're talking about the SoftBank deal today. It's hard to imagine that this theme ends when you keep getting headlines like this, of this size. And so I know everyone's worried about all the worries that we've expressed day after day, week after week. But at the end of the day, that theme still seems relatively in place for me. And with it, it probably continues to drive markets higher.
Which is just the sheer spend on AI?
It's the fact that we haven't fully adopted it yet. Companies are only beginning to sort of implement it in a meaningful way and get the productivity and efficiencies that are going to help support margins. But yes, the amount of spend and every single conference call that we listen to, every conference that these guys appear at, they all keep telling us demand is greater than supply. And at a minimum, you want to see, for this to end, you want to see that slow down. And I haven't seen any evidence of that.
There's been no let-up. Obviously, we're just through the last quarter in terms of all the hyperscalers and everybody else reaffirming or increasing their CapEx plans. That said, the bigger question, I don't know, are we going to get an answer in 26, which is, what's the return going to look like on all that invested capital?
I know everyone keeps talking about this, that this is the year where we're going to have to see the return. I don't know that that's the case. I mean, it could just be another year where we spend $1 trillion. Obviously, there's some differences because now we're tapping the debt markets to a greater degree than before. But as you know, all these companies have basically their leverage is basically half a turn.
Many of them, not Oracle.
Oracle's the exception at the 3 or 4 times debt to EBITDA. But the Meta and the rest of them are calling half a turn of leverage, so they're not particularly leveraged. So they can, and we know the IG market is 10 trillion in size, give or take. So there's ample room for this to continue. But I know, again, the main point is people keep saying we need to see, we need to see, we need to see. It seems like, to me, like a nice thing to say something different, but I don't know that that's rooted in any...
So we're just going to sit here next year, have the same conversation that we're having right now?
Why not? I mean, listen,
and what does that mean for the S&P?
Well, listen, this is the argument that as long as these companies are as large as they are, you need to continue to be, if this is what you do, it's not what Solus does, but if this is what one does, you need to continue to be exposed to those names because you're just going to underperform. But at the same time, we've seen, as everyone has noted, some change in allocation here. Some of those larger names have sold off. even some of the derivative names like Eaton and Vistra and Vertiv have sold off, and other names have picked up the slack, healthcare, financials, some materials names. So you're starting to see a rotation. So that's really the question, I think, going into next year. Not whether the AI story is going to blow up, but rather whether you want to continue to be exposed to the largest, most obvious names rather than something else.
Are you paying attention to valuations?
Well, of course. But
They're high, aren't they?
valuations is the same conversation. Valuations, as any strategist will tell you, is not a market timing tool. It's completely useless in determining 6, 12-month forward returns. But the market has been, we've been talking about the market being expensive
You're a liar.
for, I don't know, 10 years now, and there's been very brief moments where someone hasn't been willing to come on CNBC and say, it's too expensive, earnings growth is going to do the work next year. What has that done for me? Again, what is driving the market? It's this AI story, at least for now. And to be clear, before I make that point, excuse me, I was up late last night, everybody. I apologize.
You have to run because he's a liar.
What is this? I gotta tell you. So,
With my husband on fish
I saw that.
really?
We weren't together, but we were together.
Everyone there.
I like music, sure.
When you go multiple nights for fishes.
Well, they all do. All the fish people. They go, and it's nice.
People do it for Pearl Jam also, but I want to make this point. Getting back to the markets, which is what we care about.
We got plenty of time. You want to talk fish? You can talk.
You
want to talk goose?
We have nothing to talk about. Slow down.
I don't know. You've been to the Grateful
We
Dead.
haven't gotten to Warner Brothers yet, and that's we got a lot to talk about there. But this idea that it's all AI, I don't mean to make this point.
We're at support.
493 or the 490, if you will. It's only this is total nonsense. The other names
We're really
are
at support.
15%. Year to date, you've got worries about the consumer, you've got Expedia, you've got Booking at high. Obviously, some of the retail names are doing poorly, but look at the chart of Dillard, Ralph Lauren. There's plenty of companies in the rest of the market that are doing fine. There's plenty of themes you can be exposed to. And obviously you've got, as I just mentioned, to pull David in here, the M&A story. Obviously deal count is roughly flat year over year, but you do have very large deals like Warner Brothers, Netflix, et cetera, that's helping drive sentiment in the space.
Meaning, it's all a bullish setup and it's not just AI.
Yeah, I know. It's not just it's all bullish. I mean, there's people who come on and talk about things that I don't think are accurate, like the consumer
Exactly.
rolling over for 2 years now. And I keep hearing from
2 years.
time and time again, yeah, we had to raise prices a little bit. We saw no pushback. Yeah, we raised prices a little bit. No, across income cohorts, everything's fine. Look at the charts of Visa and MasterCard. I mean, that catches everything, restaurants and retail.
I hate to say it, but I agree.
Et cetera. Yeah, there's pockets of weakness, Mondelez, consumer packaged goods.
I agree.
Yeah,
Okay.
there's a weakness, obviously, but on balance, I think the economy's doing fine. I think the market's doing fine. And until something happens to tell me otherwise, I don't know why you would be bearish. And I haven't heard that as of yet.
Exactly.
Feel better about the world already. Thank you, Dan.
I feel like that was too short a segment. I think we need a
Well, you
segment.
can come back.
Prepare ye in the name of the Lord.
Every Thursday, Wednesday, whatever.
I live very close. Paul's not here.
Come back on Thursday.
You got a million jokes too.
I have nothing but jokes.
Yeah, nothing.
That's not true. I have scintillating insights.
None of them are any good. Yeah.
You're going fishing again tonight?
I am.
Tonight and tomorrow night, probably.
No, I don't go on New Year's. I have a family.
Okay.
I have to see them eventually.
I don't know. Fish people.
These fish people.
All right, Dan Greenhouse, thanks. We're 30 minutes into the trading session. Here are 3 individual stocks we're watching. Applied Digital shares are rising after proposing plans to spin off its cloud business and combine it with Exobionics, a company that builds exoskeletal robotics to form a new AI compute company called
Spy at the double bottom orb.
Chairman and CEO Wes Cummins will join us exclusively tomorrow on the show to talk all about it.
Sorry, honey, but I cut you off years ago. Goodbye.
Half an hour ago, you say the S&P is trading a bit.
And what the hell? There's no cleavage. It's not what I ordered this morning. Maybe a couple turtlenecks to go, please. We still in? I'm here. I think we're going to reverse here. Riding deep. Double bottom on the orb on the SPY. Booyah. Don't ask me why. Check this out. Prepare ye in the name of the Lord. Prepare ye. Prepare ye in the name of the Lord. I'm liking the 687s. Or the 688s. We'll buy them here. There's not much they can do about it. Prepare ye. These are the lottos with an inverted hammer at the orb. We've been sitting down here for 4 minutes now. These are the 687s, the calls. I'll be buying 10 contracts. There's not much you can do about it. The 687s. You'll speak when I get ready for you to speak. The video is down. Tesla broke below my support level and bounced right back up to it. That's where it is right now, for now. Now this is, I think it's going to move around on us a little bit until I can say, okay, well this is, I like it here again, we're here again, we're here again. We have a little controversy with that eccentricity from PLTR. Google's kind of looking nice, but I don't know. Kind of. Crowd's going wild. Well, SPY just went down to a new low right there. 79 cents. It's 687s. I haven't jumped in them yet, but now they're at 80. So I'm going to have to make a business decision. Ladies and gentlemen, we will now be boarding dock number strike 8687 on the SPY. And that'll be dock 687 on the SPY for a lotto play. Tip, most lotto plays are finished with a SPY by noon. Then we move on to the next day. Do you understand? Everybody understands. You understand, Randy? Never could get Sue to understand. Oh, I did? Yeah, I had to deal with the IRS. You better have to deal with the IRS. They didn't have water for half a day. But the government employees were about to die. I have no coffee. Might as well run up here and get me some. Because I need my coffee. These were at 80 cents a bit ago. The 687s. Now this has been good 9-10 minutes now. We've tested this support level. So I'm going to predict, Nancy, do you think I should go ahead and buy into these right now? Yes, Jim. Only if you do me a favor tonight, honey. And what would that be, Nancy? Cook dinner. Or you can order it in from Grubhub or whatever you want to call that place. $687.91. Come on now. We would like to see a reversal here on the 687s to the upside. I don't want to hear no arguing about it. Spy calls. Well, we're at 94. Chalk another winner for me. These are called spies. These are option trades, spy calls. You put a capital CALLS. And scalping means that you'll be taking that day trade within less than 30 minutes, or it becomes a day trade itself. And lotto means it'll be done within that same day. So the strike, in this case, we're at 106, was 687. Now, I gave you plenty of warm-up into the trade. And I mean, you're a fool if you don't take profit at 106. Come on, man. Come on, shit. Woo! Right to the 63, Maine. But now we're at 82 cents. 90 cents from 82. Let's see if we can hold the 50 SMA and keep this thing bullish and run back up to the 63. We got a special guest coming up. He used to be one of my mentors when I first started trading here with a sneaky snake trading strategy. And some of you might not remember him, and Some of you might not. But we've been through some levels, that's for sure. Ladies and gentlemen, I want to introduce you to somebody that's been on my side for the last 3 years. He's supposed to show up. Where is he? This could get bad if you don't show up, man. We're at 83 cents. Damn. Let's just do that. Ladies and gentlemen, high level. I want to introduce my buddy, Higher Level. Him and I wrote this song years ago. At a higher level, please. Boeing had another pop. We're in spies here, looking for a higher level. Waiting. Might not get it. Higher level. Oak. No. It's starting to push its luck. Pushing its luck. What did I do? Oh, I was looking at the wrong thing here. Was I? How did I get... What? Oh. Oh, God. Man. Hope I ain't getting nothing bad. Let's see. Really nothing to hold this up. It's kind of open. Don't give up yet. Two. Hello? What's up? OCG's having a OCG day. And Open's still at support. Open will be a long, for 2026. I'm pretty motivated about keeping open mind on open. Open mind on open. Shit. Woo! $0.77. I'm in the SPYs. If you're curious, 687 strikes at 80 cents, and they're now at 70. We're 77. Yo. Don't hold it against me. I have a feeling I'll get out of these okay. Can't take much more of a beating. I'm going to break the 21 on the SPX. Same as the SPY. Looks like we had some effort here on the DDD. And the IWM, same genre there, it has to break the 21. EMA on the 1 minute. We'll be docking down in approximately a half hour for some salad. Today we'll be serving Cobb salad with fresh bacon. Oh, Cobb salad? Are you serious? I can't wait. Woo! Oh, Jim's having Cobb salad. Oh gosh, come on now. SPY's not working too well here. This is not working. You're down $120. Have you ever just thought about doubling down here? Yes, I have. Yes, I have. Because you have your little support level right here. Right there, that's it. I mean, it has to hold. Jim will buy some. God.
There's a view out there in the market right now that this could be a milestone for Asian companies to boost up valuations. Chinese and South Korean companies also getting a lift after a separate report that the US government will allow Samsung and SK Hynix to import chip manufacturing equipment into their China facilities next year. Samsung and SK Hynix are major memory chip makers manufacturing NAND and DRAM chips which are used in AI data center servers and phones. The latest move now gives them some relief from US export controls at a time when there's so much demand and tight supply. At the same time, though, there are new manufacturing rules over in China. According to Reuters, China is going to make chip makers use at least 50% domestically made equipment to add to capacity. The report says chip makers looking to expand their plants must prove at least half their equipment is made in China as it looks to reduce its reliance on foreign technology. But the policy is already apparently yielding results, with domestic companies in the business of etching tools benefiting from that requirement. Etching tools have been mostly supplied in China by companies like Lam Research and Tokyo Electron. So there's going to be winners and losers here. Coming up, it's time for Inside Out, and we'll take a closer look at Meta after that latest AI acquisition and bring you an example trade for that name when Morning Trade Live returns.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
We're back on Morning Trade Live. Meta is continuing its year of AI spending as the company says it will acquire a Singapore-based AI agent developer Manus. Meta said in a statement that the acquisition was aimed at accelerating AI innovation for businesses and integrating advanced automation into its consumer and enterprise products, including its Meta AI assistant. Terms of the deal were not disclosed, but the Wall Street Journal reporting that the deal closed for just over $2 billion. So joining us now to talk about this is Ed Patowski, Managing Partner at Chatwood Investments. What do you make of this deal, Ed? Good morning to you.
Well, I'll tell you, there's so many deals being made, and such small companies. It's really hard to keep track. It's happening at such a fast
I agree
pace.
with you.
Like nobody ever heard of Manus before, and now all of a sudden it's in the headlines. And I think that it's a brilliant move because it's going to increase the AI agent and expand that quite a bit. So I think it's a very, very smart move, and Wall Street likes it a lot.
Yeah, it certainly does. It's
Oh, which
been
one?
reported today. I mean, Meta is the outperformer as far as the Max 7 is concerned, and it really needs a strong sort of AI narrative right now, given the year that it's had. I'm just wondering, as far as Manus is concerned, you're right. I mean, not many people have heard of it unless you've been, sitting in Asia and understanding these companies. But apparently, it's been capable of producing detailed research reports, building custom websites using AI models
there we
developed
go.
by companies like
That's what I wanted.
and China's Alibaba. Now, this is a company with Chinese founders, not to mention this avocado that Meta is reportedly using to actually train.
Now you're selling the breakout.
Sort of raises a lot of
We hit the
questions about
63.
involvement and work they're doing with the Chinese. Do you read into that at all?
Yeah, I read into some of it, baby.
Well, I'll tell you, they moved to Singapore for a reason, and that was to get away from the Chinese government and rules and regulations there. But
That's
there's
bullshit.
certainly still some ties to Alibaba and other Chinese companies, which are robust and which they're.
I don't know if that's a good idea.
A business around. So I do believe that the ties to China are going to be scrutinized as we go forward.
88 cents.
Yeah, I thought that might be the case. We'll just have to wait and see, how
Yeah,
that plays out. But,
yeah, I think
for
that's
now,
right.
Obviously, as you say, the street likes the news. Talk to us about, the $2 billion. There's been a lot of attention on Meta
Yeah, question why
specifically
you
with
even bring it
regards
up.
to how much it is spending on AI. And there seemed to be, you could call it a bit of capex indigestion off the back of its latest earnings report, and the stock got punished. What do you make of this?
As long as they take money away from the metaverse, because I thought that was the most ridiculous investment of all time. And if they're just taking $2 billion to buy Manus, I think that really doesn't carve a negative thing into their earnings reports because they've already obligated themselves to so much money in other areas. But the AI is definitely, the future. The algorithms for AI fueled a 26% year-over-year.
I think I made my point clear.
And a robust 40% operating margin. So they're definitely doing stuff correctly, and they're getting more money for their advertising because their AI is that much stronger. So I would say just keep doing it and stay away from the metaverse.
92.
Yeah.
Oh, God.
So there was a thinking that, maybe the Googles of the world were a little bit more well-positioned, particularly when you look at the AI story versus what Meta is doing here. I'm just wondering, now with this news and some of the spending that it's been, throwing a lot of money at, as far as, building up teams, etc. Do you think, the valuation right here is justifying?
Well, yeah, in fact, I think that the valuation, the company should be selling at 25% higher. Target prices are $837.
We're not sure how you do it, James, but you do it.
But I think when their next earnings report comes out, it's going to show how nimble they've been and how smart they've been with revenue growth using AI as a catalyst to make that happen.
Thank you.
And just lastly, and obviously it's been a big year.
I've been told that I'm an AI.
Throwing a lot of sort of those eye-water figures out there, trying to attract talent from other companies to bring onto its team to really work and push ahead with its AI ambitions. There's been a lot of question marks around exactly what some of these people are going to do. Do you think there's still more questions that need to be answered here when it comes to Meta and what they're doing here?
Meta.
Specifically artificial intelligence?
Meta.
I'll tell you, the talent pool out there is tremendous. And every company, it could be Google, Apple, Facebook, Amazon, are all trying to get the smartest and best people. And so there's a race for that. Sam Altman yesterday just announced a special position that he's paying $550,000 for. I can't remember what the position was.
Don't worry about it.
The people are what make this happen. It's not so much anything else. It's the brains of the people.
Thank you.
If you can get the smartest people, they're going to give you a leg up. So I think
I'm going to give you a leg up right now.
Effort to draw in really talented.
Well, we just hit the 200. SMA. On the 1 minute time frame. Open up your eyes. Realize we just hit Washboardjim's resistance. It's the sneaky snake trading strategy. Caught it from the bottom, you see. Whoa, there you go, Joe.
I looked at a strategy. They report earnings on the 28th of January, so I want to avoid that earnings event. But maybe if you're bullish on it, you can take advantage of potential gains into that report while avoiding the event risk on that.
And you're at the bottom.
In the January 23rd weekly cycle, so about 3.5 weeks until expiration on this one. Where I'm going to buy an at-the-money call.
You're one of the first ones in the trade. People are looking at you. Who's that guy? He's the Washboardjim. We started trading back there in 2004 with Martha. Little Martha would make me a cake. And she always put something kind of funny in it. It seems like I'd always want to wake up in the middle of the night and go skinny dip. Well, we respect the 200 SMA. this stock running up the rest of the day. I'd call this thing a head and shoulders. Okay. Spike calls, I got out. Left $220 on the table, that ain't no doubt. Whoa.
Trading 360 coming up next with Jenny Horn, and I'll catch you later.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing with one convenient location. Moving funds between your accounts is easy.
Yeah, he's watching
Cash
it
moved to your
again.
brokerage account is available in seconds.
Now
That
he's
means
going
you
to be
can stop
looking at
waiting
the
and start investing in stocks,
same calls.
bonds,
These are
money
going to be
market
the
funds, and more. Get more
687s.
with Schwab Bank Investor Checking, the checking account built for investors.
We didn't quite get up there. Uh-oh. This could be the first candle of respect.
Real-time market coverage meets
It
expert
is.
strategy. From the opening bell to the closing
These
bell.
are the 687s. We're above the pivot point of the 200 SMA. We haven't finished the candle yet, but this is the first candle showing respect. 687 strikes at 98 cents.
I think one of the most important things is you're making a play for risk-defying the way you're going into earnings. So that would be a further downside area to watch.
Mom, when my grandparents moved here, did they know what our
Here's the 200 right there, and then you got the EMA, and you got this trend line I have on here, which was, I think, to that, kind of like a pivot point.
Has been with us for almost 25 years through
Oh,
purchasing of
we're at
houses, opening
$1.09.
up our business, having children.
Damn, Jim.
They've always been there for
You're up.
us.
I want to invest with.
Jim, you're up $110.
Give my family a happy financial
$120. You ever thought? $130. You ever thought about selling?
Stay connected to what moves
Yeah, I
markets.
did.
Download the Schwab Network app and get live coverage wherever you are.
I need to make sure I can pick up a quarter. Take my lady down to the local bar. Say, bartender, may I have a Bud Light on tap, please? She'll look up at me and says, but mister, you just put your last dime on a call on the SPY. Called a lotto. Yeah, I did. I had a chance to sell it there for $130. I held on. I'm back at 106. No. I'm up $120 right here. Are we going to have new highs, or are we going to just go ahead and break out? Because right now it's at 10 o'clock. Hey Nancy, get in the refrigerator. Give me a shot of vodka. And that new volume you got there from Lily. We're at 110. We're at 113 now. I'm in the 117. Oh. Now we're getting serious. So if you got in these calls a little under $1, you've got a little twitchy finger going on right now. I'd sell it because your body's telling you something anyhow. I'm going to give it just a little bit more of a chance. You're up. You're up. My boy, you're up. Can't believe you're up. It's at 1:16:18. You can get out of it real easy right here. You are one hell of a trading machine. Whoa!
I'd like to welcome in now my co-host of Next Gen Investing, Alex Coffey.
Who's this?
And so Alex, really want to get your first thoughts on these markets here. Another day of some weakness.
Did I say you could talk?
Yesterday.
Miss Horny? How dare you interrupt my broadcast? Dan, let's have a little talk with us here, Jenny Horny.
It's in the equity markets, but anything's possible. We've seen it before, so we're almost to that finish line, Jenny. There'll be that break on Thursday. We'll get back on the horse on Friday, but all in all, another really, really strong year. It seems that we're going to
Santa Claus
here in 2025.
Okay, something that's kept us busy for the end of this year, so we've joked we're relatively news light right now, but what's been busy has been some of the consolidation we've seen from major tech names. I mean, NVIDIA, Grok, as well as now Meta paying more than $2 billion to acquire Manus for the Wall Street Journal. So walk us through that headline.
Yes, this is a Singapore-based artificial intelligence agent company, and again, it's just another example of sort of this land grab and technology grab that we're seeing within this AI trend as these major hyperscalers continue to make moves. And so Meta acquiring this Manus company in a deal that's valuing at around $2 billion, perhaps more than $2 billion, and it also marks a rare U.S. acquisition of an Asian tech company, Jenny, so that's something to watch as well. Meta intends to continue operating and selling this service while integrating the technology into its own products. The existing investors in that startup have been bought out in this takeover, and there is not expected to be any ongoing or continuing Chinese ownership in the interest of this AI firm following the transaction. Now, not a lot of analysts have weighed in just yet, but I did see that Rosenblatt has, and they say that it's a rocket ship grower in small and medium business-focused agentic AI. They think it's a natural fit to Meta's fast-growing WhatsApp small business footprint, with extensions into Mark Zuckerberg's agentic-rich vision of personal
We're 117. I mean, gee, it's hard to.
Potential to stand with Meta's acquisitions of Instagram in 2012 2014 as a potentially transformative acquisition and deal for Meta as a company. So
Alex, sorry. Sorry, Alex. We have a problem here. Not really a problem, but ladies and gentlemen, these are 687s. Was alerted on the pullback of that red candle right there, and oh my gosh.
Does put into context $2 billion feels relatively small, which is ridiculous in its
Angel,
own right. But appreciate that for all the commentary on Meta and these overall markets. Alex Coffey,
Angel,
co-host every day
get the
on
milk out.
Investing. But now to get some insights on the news that are shaping these markets, and for that we have a special guest joining us in studio today, John Nargerian, the co-owner of Market Rebellion.
Get the milk out, baby.
And taking time out of a very busy holiday couple of weeks, as I know there's a lot going on right now, but wanted to get your takeaways on really.
You're going to get that gallon of milk you've always been and wanted all your life.
Resilience.
Resilience is what I say, because obviously
I said, Angel. One of my goals, if you say yes, is to buy you a gallon of milk without no stress. I've been buying you quarts and pints, and even some powdered milk every once in a while. But right now, baby, I got you a gallon of milk paid for 45.
Resilience across the board. The U.S. consumer has also been shown surprising resiliency for some of the economic conditions that we've been working through. But recently, what's come to play has been all things metals. And so I wanted to hear your thoughts on like silver hit record highs. We saw
It was like back when we got our first color TV. Everybody else was laughing at you and me. And then same thing happened with the flat screen. We were the funniest people on the scene. But I got you Lamborghini on spy call. 1, 2, 3. Whoa! And one, two bits, and a freebie. Boom!
Prices go up. It doesn't matter what that particular asset class is. And I thought this
so we're back to 117.
Now the third biggest asset class in the world. Silver is. The biggest, of course, is NVIDIA. But then
I need to record some of these hit records.
Top 10, you've got the likes of Google and Apple and Meta and all these other companies, including Bitcoin, by the way, as far as an individual asset. But silver, to be a top 3 asset in the whole world is pretty amazing. And that's the performance that silver has put up this year. And I think people will
it's a do or die situation right here. Needs to hold.
Whether we call it a precious metal, I do, or whether or not it's just gold
if you want to take a bigger.
And this and that. Yeah, those are big numbers attached to gold at $4,300, $4,400 to the ounce. But silver, on the move that it's made this year from under 30 all the way through.
Let's say I am in the trade. Let's say I think it's going to run more, and I wanted to get in and add more on the pullback. So what we had here was an interesting idea that Washboardjim called out at $1.12, and that's off the 9 with this inverted here hammer. Then we have a tweezer bottom now. We moved on to the next candle. We're at 117, but they're at 112.
Like the crazy outperformance we've seen.
Yeah.
I didn't add on, but that's where I would have.
So if you have more demand and then you've got light liquidity going into the end of the year, whoever has big gains in silver, do they want to take them now or would they rather push that off until next year, which would mean, of course, they don't have to pay taxes until 2027. So I think
I should be selling any time.
Hit both stocks and precious metals or futures this time of year. And I would think that a lot of people would be focused in on the things that silver contributes to, like I say, solar, because you named data centers. You're absolutely right. Data centers are huge, but
Seems
what
like
powers
it's
data centers? Well,
people are getting a little bit tired.
Natural gas, solar, which is a big part of the demand for silver this year, nuclear, coal, and so forth. So silver is a really valuable material right now, and it's not just the so-called rare earth minerals and things like that, or rare earth metals like lithium and cobalt and all the rest, nickel and so forth. It is silver, and silver is where people, I think just a week or 10 days ago, there was a stock that went up almost 100% in a single day, and it was $1 billion company. It went up so big because they found a bigger vein of the metal underground.
That was the first sign of bearishness.
As they started to explore what that would mean for the value of that company, the stock doubled.
Still a bullishness, but it's definitely went below support.
Asset in anybody's portfolio. Unusual option activity. We've seen it across.
But not completely yet, because that candle's not finished. This one right here.
So whether it's an ETF that carries silver in it,
see, now it is. So you kind of
stocks, people want to have this in their portfolio right now.
I use the 9.
Just such a significant outperformance, even as we've seen. I mean, some areas of weakness, like in tech, for example.
So I got in at 98 cents.
With everything we saw from the consumer this year. So what stuck out to you really as far as like consumer discretionary spend? Because again, I think that has been something that has been rotational, yes, but I mean fairly strong throughout last year and of course this year.
I think a lot of stories were written and or talked about on streaming media or television about the consumer and, oh, they're so strapped. You know, when you look at, there's only maybe 5% of vehicles are electric right now in our country. Most vehicles are running on diesel or gasoline. And the prices for that input went down significantly. So that hits the consumer in a good way because, you know, with 33 states, I think, right now, below $3 a gallon. It's dramatically cheaper. And if you're buying 600 gallons, is what the average American buys every year in terms of per car or per truck, 600 gallons of gasoline. So if it goes down $1, as it has, that's an extra $600 in people's pockets. The more they drive, again, that 600 gallons is average. If you drive more than that because you live further out in the suburbs or your job requires you to travel a lot, you're saving even more. So I think the consumer spend is not as surprising, to me anyway, when you've got inputs going down like that. Inflation pressures are significantly lower than they were 2 years ago or even 12 months ago. So I think the consumer spend is not as surprising to me as it is to some. I think it'll continue to be strong. And I think, unfortunately, though, a lot of consumers have cut back from certain retail outlets and gravitated more towards others. It's been great for Walmart. It's been great for Kohl's. It's been great for TJ Maxx.
Dollar General.
Dollar General, yep. All of those have benefited from the consumer being smarter, if not more frugal.
Yeah, I totally agree. It's that reallocation of spending. It's not like we're seeing a significant pullback in spend by any means, because I mean, all these companies in their recent earnings really have illustrated this. But before we let you go, wanted to get your thoughts on some of the weakness we've seen though in tech, because that's also been driving these AI bubble fears. I mean, what are your thoughts there?
Well, Michael Burry was, of course,
I don't know if it full max today or not.
The Big Short, which Andrew Ross Sorkin did such a great job with his version prior to the Michael Lewis version of The Big Short, when they were talking about bubbles and things like that. Well, Michael Burry said AI seems like a bubble to him. He called out Palantir and NVIDIA in particular. He was early, but it ended up playing out pretty well, and a lot of smart people paying attention to the good doctor said, maybe it is time for me to lighten up. And so they did. And that caused that waterfall effect. When people are all running to one side of the boat can tip over. It didn't tip over, but it certainly tipped pretty far. And I think when you look at Oracle, which was up and briefly made Larry Ellison the richest man in the world, it was up 35% right after their August earnings report. Then a little more reality and perhaps logic set in as far as how long will it take Oracle to recognize all of the backlog of business that they have? Years. So are we pricing it as if those years have already passed? In many cases, people said yes. So Oracle, NVIDIA, Palantir, many of them, even though they're great companies, and I wouldn't short them, I would trade them from the short side using puts occasionally, but I think those are all going to be building blocks for the future. So I'm somebody that loves Micron, I love AMD, and of course those three that I've already named, but I don't want to forget about Meta and Microsoft, because those two are basically battling it out for the data center side along with Google.
And spending big money.
Spending big money restarting 3 Mile Island. I mean, it doesn't get much bigger than that, and that's Microsoft. What they're doing right now is going to Constellation Energy and saying, hey, we need more power than we can find anywhere else in the U.S. You've got to restart that, and if you do, we'll put a data center right there in Pennsylvania. That's huge for Constellation Energy, but again, it plays right into, we need nuclear, we need coal, we need nat gas, we need solar, we need wind, we need everything. And ultimately, Elon Musk benefits because a lot of those data centers are going to be in space because you don't have to worry about cooling them in space. And that's where a lot of the power goes from data centers. It's not just the calculation, it's the cooling that it takes to make those computers run at their optimum.
It all comes back to silver then.
It does. It does.
It's just a full circle conversation, but appreciate it so much. Really
Thank
great
you.
takeaways on the year that was. When we look back, it's like, you know, so much happened this past year, but we appreciate it. John Nigerian, co-owner of Market Rebellion, thanks so much for joining us today in studio. Now, plenty more to come today on Trading 360. We'll discuss the big three stocks and 3 charts, and Rick Ducat will go through the technicals for Johnson & Johnson, SanDisk, and Twilio. That's next on Trading 360.
They're now at $1.22, and I think we're going to go higher. These are the 687 strikes from 98 cents. They were called at 75 if you got in early with Washboardjim, the thinking strategist behind the sneaky snake trading strategy, where I talk about chart patterns, moving averages, and being in the know. Let's go. Break it.
From the most iconic trading floor in the
No
world,
fail.
this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right where it counts.
No fail.
Believe me, when it
These are now at $1.25, and anybody in their right mind would not prosecute this woman. I mean,
Is it? At Schwab, how I choose to invest is up to me.
Exactly.
think twice about not selling.
Yes, and I let them
And
manage
takes
the
profit.
investments for me too.
Let's move on, shall we? No can do.
I'll get out there.
Where are you going?
Schwab.
It's quite impressive, James.
Wealth management.
How you held on to that thing.
360, I'm Jenny Horn, and it's now time for the big
Well, it never
three.
was green,
Stocks
never
and
was
three
red on
charts,
it,
and
was
Rick
I?
Ducat will take us through the charts.
No,
And Rick,
you
let's start off
you
with
were
the
not.
technical landscape that we are seeing in
Maybe your
Johnson
initial
&
entry,
Johnson,
but-
which actually has been a quiet, real winner of this year. We're up 44% in 2025.
Yeah, price target bump today, looking for it to go toward 217 once again here. The highs that we saw recently were around 215, so a marginal increase over those prior levels here.
We
But
can break
what we've
it.
seen in this healthcare name is that we have been
I still think we can go
in an
higher.
upward channel here between our two blue lines, our conventional trend line going across these
There's
lows,
something that I'm
ending
not
subsequent
catching.
lows here, but a bit of a breakdown here.
It's going to
so
allow
far.
me to
But
stay
then
in these
just
trades
duplicated
next
it.
year.
You could put it across the highs. Happened
Really,
to match up
really
fairly well with where we topped out.
quadruple.
But now, though, we are traveling somewhat below this level. We have failed to recapture this level near 207.
Maybe
Old
2.5
highs
million
here,
in profit
breakdown
next
point,
year.
And most recently, it's been a
Yeah.
ceiling after it became the floor for our
Woo!
small gap up right there. So now
Uh-oh, here we go.
207 is a short-term mark to be.
Uh-oh, 131.
Travel above there. Our best close, not the intraday high, but the best close was 214.14. To the downside, relative lows come in here near 200.
Here we go.
Notable old high point here near 194. When we look at our
So Washboardjim's
averages that
thinking
we
about
follow,
selling. What are you
we
going to
can
do?
see that our short-term, weekly, and
Jim, we're
monthly,
closing in on
real
resistance level.
exponential moving averages here, they converge quite
Washboardjim,
closely around,
I wanted to call you and tell you I'm going to get out of my calls here because we're up here at the resistance level that we had this morning, most of the morning, and I'm afraid, I'm scared. Randy.
In a triangular shape right here. We are above the 50 midline, but kind of not really showing any strong directionality here. Look for price to break down and RSI to break down at the same time for further directional cues. Finally,
tried to
we've
tell
looked
him.
at our volume
Nobody
profile
listened.
study here to see that our heavy trading concentration areas are right about here near 205. This
Oh
this
my
node
God.
right here, and you can also see right here between 190 to 195 also stands out. But really, the heavy concentrations are much lower.
Is that a beauty
in
or
this
what?
name here. The point of control all the way down here near 155.
I'm impressed.
So, I mean, this has been, again, a pretty solid performer. I know we've seen some mixed feedback from the sell side as far as the forward expectations on a lot of these names exposed to health. Patents will be expiring in the coming years. But
Okay.
we're seeing a pretty decent year and modestly lower today. As we do, assess now our next
Let's get rid of you.
SanDisk, which is the
Goodbye.
name we have seen, I mean, significant outperformance in. And
remove.
this overall has been one of our real standouts of the year. Just to illustrate, we
Well,
went
these
from
are at 165. I'm up almost 100% on these.
to then just over $284
We're
a
at
share.
$1.71.
So we pulled back, yes, but I mean, it's been a pretty phenomenal year for this.
Push the market
Right,
sell
you
if
can
you're going to get out of
easily
them.
see the vast outperformance here in this particular name, and this memory and storage space has really been the strongest of these
Okay.
groups here. You can see some of these other names here are being far outpaced. Anyway, though, when we start to look here at our week,
Someone said be careful here.
we can see that we could make the argument that you had this trend line going across the lows here. That
The
we
evil
saw
laugh
after
sell is
our,
on.
Gap to the upside. And
Jesse
then
knows
the
it.
subsequent lows. We had an earnings breakout to the upside after we established these initial highs, but then we kind of stayed.
I mean, look at the look at the
So
candles.
These things can be kind of messy. These aren't exactly.
All of a sudden,
cut
you know,
and
you're
dry,
starting
very
to climb,
subjective
and then
here.
you consolidate.
That can be bothersome or
Then-
difficult for some people to work with.
You
here.
get too out of the
You're just looking for
ordinary.
general areas and general boundaries that seem to be
Big
holding out
engulfing
here. So
candles here,
now,
which means,
this
okay,
slide to the
man.
upside, does give us some
The race is
important levels to
on.
follow as well. Also, a good reminder too that after a price shock event, things can
But
very
people will be
quickly
buying the dip
retreat
like
to
we
where
did
they
here
were
earlier.
before, carrying on and continuing the uptrend.
So are you ready?
Here. But we can see red line right here was a
Look at that.
notable high point near 240, topped out there a couple more times.
You nailed
Then
that wedge, Jim.
283.10 was our best close. So now you could say that we are on the verge of breaking through our downward sloping trend line in blue here. So that could be what
My
controls
wife
the,
wants to ask you
lookout for
what is
in
when you
this
say
series.
wedgie, what do you
A
mean?
little bit, but still a very strong performer. We can also see
ma'am.
averages right here, 218 to 226 or so. Give us a confluence to the downside.
Give any children around? If you do, please put them in a different room. Or a wedgie is when you have
Or would you say that there's
lower highs and lower lows.
tools like standard deviation and trying to assess
can make it a triangle,
which I guess is the $1 million job.
which
But as far as
you'll get a squeeze out of it.
these big of moves, how do you assess things going forward?
Right, that can be quite difficult here. One way to
It's
do
called a
this is
wedgie,
use
baby.
volume profile here to see where the heavy trading accumulation areas were. You can see, for example, this point right around here near 200 to 220 or so is the heavy concentration. This is where the most trading volume took place. So this would be another way to look for notable supportive areas. The other thing you could consider too is if you were to include standard deviation channels. We have our linear regression line here, this white
wedge
line
on the
here.
/ ES.
One channel, one standard deviation to the upside from that move comes in right around 268. So that is another point you could consider for upside resistance in this notable name here.
Okay, and so now shifting gears to our next name, we are looking at Twilio. We did see that Citizens actually had some optimism on this stock today, raising its price target to 185 from 165 with an outperform rating due to some recent.
You have kind of a wedge right there.
They did highlight a few negatives, but saying that overall AI is going to be a continual complementary aspect of this company, and that they continue to see, I mean, that driving a huge portion of their AI voice business, which is frankly really interesting. I mean, big growth metrics mentioned, but as far as this stock's performance, as we assess things technically, what do you watch?
Based on my experience with AI voice agents so far, that makes me very
1025.
dismayed, I guess I would say. But who knows? Maybe they'll get better. Maybe we're the guinea pigs that they're testing them on. But anyway, when we look here, though, we can see if we were to backtrack 133, our green line here, this is around where we hit a notable low point. This is around where we opened up again. High point here, high point here. Again, you're kind of just looking for these general areas that seem to be important here. Breakout point once again. 143 then was where our gap began all the way back there. You can see that was this red line here that proved to be resistance, but now we've broken to the upside. We're looking for that to see if that would remain supportive here as we go into the end of the year. Our price activity, kind of like our last chart, most of it fits within the boundaries of this channel. We had an earnings event that gave us some rather large upside, but as you can see, kind of the same way, it quickly filled the gap and we resumed our prior trajectory here. So our moving averages, we can look here and see that we are above our very short-term weekly EMA here. That comes in around 142. Our monthly EMA comes in near 136. Meanwhile, our teal line, RSI making new relative highs and pushing into the overbought area.
Oh, yeah?
Really regarded as a sign of strength in a trending market here, especially considering prices also making new highs in tandem. Finally, we can look at our volume study and see that the notable trading activity areas here, we're entering one right now near about 147 or so. That's right around those old highs. So we'll see if the bulls can manage a breakout here. But also right here,
they could
be supportive near about 140. Finally, things start to pick up again near 130.
Who doubting us there, Rick?
Also having a pretty strong session today, as we're up about 2.7%. So enthusiasm is outperforming the overall market. But last but not least, with this
megaphone.
overall pretty bullish as far as technical indicators. Does anything give you any pause we could be nearing any lines of or signals of overbought territory, or perhaps approaching some more short-term resistance?
Well, we could see our +2 standard deviation channel coming in here.
That's a good question.
Pretty closely with those old highs, that would be around 150 versus 150.
Good job, Jenny. I like that question.
That high close. So that would be an area many bulls might be anxious to cross.
We do.
Here. Meanwhile, our +1
I'm impressed.
lines up pretty close to our green line, a series of old highs as well, now acting as support, also near our monthly EMA.
Okay, and Twilio, a good name to close out this year, as we're seeing a pretty nice session, again, all things considered, with the overall weakness in today's market. But appreciate it, too, Rick Ducat, for all of the technical help today. Coming up next, though, we're going to spotlight the pressures that are facing banks as well as the overall payment industry now as we enter 2026.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge.
That's a good point, baby.
Features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your street. Morning Trade Live, where the markets meet the macro.
Well, I guess they have to know the resistance. New one will have to be right here at 688.52.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
I think if you had a way to occupy yourself and you just waited for like this one trader every day, that's probably what a lot of these things do. Wait for that one trade and finally to get it. All the signals are there. And and they make their money, and then they go home. They get their little commission.
Big shift in the payments industry coming up. Certainly, much more complexity and increasing disruption going forward. There's many more new payment types that are coming about. Certainly, stablecoin and digital assets are driving new change and disruption. And then AI in terms of what it's doing for fraud prevention, digital identity, reconciliation, just right through the payments value chain. It's creating substantial disruption.
Yep.
Okay, you forecasted now this new wave of M&A coming. What do you see really driving this trend, and who do you believe to be leading to that charge?
Good point.
So I think the potential M&A is coming in two areas. One in the banking industry, and just that banks need to be able to modernize and invest to go forward and compete with the tech companies. And there's only in the U.S. 20% of banks that have a price-to-book ratio greater than 1, and so 80% of the industry is expected to destroy value going forward. The requirements for investment are, I think Gartner puts out $700 globally in tech spend, growing at 8 to 9%, and the only banks growing at 8 to 9% today are the leaders in the industry that have the ability to invest at those levels. And so I think we're going to see more consolidation in the banking industry. There's hopefully a more permissive regulatory environment to do so, and that's not just in the U.S. but globally. And then I think we're going to see in the non-bank payment sector increasing consolidation as well as some divestitures as many firms focus on their core.
Okay, so within that industry, this theme of consolidation, do you see this hitting the regionals and some of these smaller, let's say like maybe third, fourth tier banks, and really then a name like JP Morgan, the traditional institutions grow even larger?
Yeah, I think some of those mega institutions may not be able to do too much there. Certainly in the regionals and super regionals, and then I would say in the tier 3 segment as well. We're going to see consolidation there. And I think it's going to come in areas where they want to bulk up in businesses that they find attractive, so wealth management, cards, and the like. And then also to get into new geographies where organic growth would be much slower.
Okay, now to shift gears a bit here, but stablecoin and tokenized deposits we have seen really gaining traction. But what role do you see them continuing to play now, and again, a hopefully more easy regulatory environment?
Yeah, so we call this a three-horse race, and we look at stablecoin, tokenized deposits, and also instant payments, and that they're going to start to evolve where they're going to take more share based upon the use cases that we would find. So certainly stablecoin and cross-border transactions, particularly in thinly traded currencies or unstable currencies, have an advantage. The tokenized deposits, given that it is a digital representation of an existing deposit at an institution where it creates, it's still under the existing regulatory environment. And then instant payments where you can move money and have access to it in existing accounts. All of that is going to increase over the next year. And so that's what we call the three-horse race.
Okay, and we know that there's a very clear rising complexity within the payment space, as we just discussed, in all these various ways that now you're able to frankly pay. But how do you see now ACI giving this clear competitive edge going forward?
Yeah, so for ACI, this year we've launched our cloud-native payments hub that has the ability to move transactions for account-to-account transactions, so wire, instant payments, and then also it has the ability to handle card transactions as well. And so ACI, we're in 90 different countries. We have position where we touch 2/3 of all wire transactions in our software in the U.S., nearly 20% of all card transactions globally. So our access to data and information to train our models, we think is a significant competitive advantage.
Yeah, and it's been a very fun and definitely, I'd say, fluid space to follow over the past year, and I'm sure we'll see that growth and the evolution continue. But we so appreciate your time today, Philip Bruno, Chief Strategy and Growth Officer at ACI Worldwide. Thank you so much. Now, coming up next, the disruptors, as we will highlight Applied Digital and the recent business move, as well as just the name's crazy volatility.
No pullback.
2025.
Here we go. You're gonna get that first one. Washboardjim, prepare ye in the name of the Lord. We're watching the top of the orb at the 63. Six 90504. Ooh, yeah.
Stay connected to the markets in the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Jenny Horn here in our Chicago headquarters, but let's now head out to the New York Stock Exchange for a check on the overall markets. And I'd like to welcome in Nicole Pavlidis, host of the Opening Bell and the Watch List.
Yes.
So Nicole, we are of course 2 hours into the trading day, and I know that you are very Fed focused right now. I heard you chatting with Kevin Hicks earlier today, so wanted to get your thoughts on this market and some of the expectations for the Fed.
Yeah, absolutely. We have a lot going on here, and while the market may
Yeah, we
just
do.
be a tenth of percent away from the unchanged line, and there's no Santa Claus rally just yet, waiting for Santa's jingling bells to come by. In the meantime, so we've had down arrows on Friday, Monday, and today. We did hit a record on Friday, but for today, the things that are catching my eye, first is metals. Metals getting a bid after selling off yesterday. For example, silver was down 7%. It was the worst sell-off that we had seen in years, but now they're buying it back. I mean, metals have had the most incredible year this year for gold, silver, copper, palladium, platinum, all hit
Silver and gold.
Gold, for example, up over 50%. Haven't seen that since
Silver and
3 years. I think it was
gold.
73, 74, and 79. So gold's best performance in 79. I mean, the other thing, so metals are getting a bid. The Fed Open Market Committee minutes today will be something we want to hear more about, because you
Slide back to the 200.
What are they thinking about inflation versus labor? Most people don't think they're going to do anything in January.
Jimmy Carr resistance.
Just bits and pieces. You had a Tesla with a nice price target. We had Boeing with some positive news, a defense contract that we talked about, Lululemon, maybe some rejiggering going on there, and the big Meta acquiring Manus, the AI agent, which you and I spoke about earlier, comes on the heels of NVIDIA and Grok deal, so there's more going on in that. So those are some of the things that I'm focused on, but definitely can't wait for those Fed minutes at 2 o'clock.
I
That will definitely be, I think, a huge catalyst because right now we are relatively news light, it does feel. We are very much in these holiday, several last days of trading for the year. But to focus on a specific name here, you mentioned some of the hopeful turnaround we're expecting from actually Lululemon, but another retailer that has taken it on the chin a bit this year has been Deckers Outdoor, which is down now 49% year to date. But we are still seeing some enthusiasm tied to the Hoka brand. So walk us through that note.
Look, as you noted, I mean, when this stock's down nearly 50% on a year we're up for the third year in a row, double-digit gains, I mean, the shareholders must be so extremely frustrated. But when we think about this name, I mean, the Hoka brand is certainly front and center. I mean, they also have Teva, and I think the Ugg brand used to be under here too. Yeah, Ugg. But it's really the Hoka story that UBS is counting on because they did their 11th global survey and awareness of the Hoka brand. Now, if you've been looking around the gym the last few years, you didn't see it, and then you saw it everywhere. And that's sort of what they're betting on in the future internationally, because they said, according to their survey, only 20% of awareness globally, and so that leaves a lot of room to grow. In comparison, I mean,
always clean this
Under
gym.
Armour has 53% awareness. Nike has 91% awareness. So anybody who wanted Nike already got it, right?
Yep.
And so that's their plan. And so they put a buy rating. They put a 157 target. It's trading at 104. They think that 2026 will bring on more strong sales. That the company will have earnings beats. And that's the big picture here. Really, just after their global survey, they really think there's a lot of potential for the Hoka momentum.
Really?
From, for example, on the sneakers, you know, the SoundCloud sneakers, and they didn't want to discount over the holidays. They were trying to play tough with their brand. So it's certainly a battle of the brands, but nice words from UBS about Hoka and Deckers, the parent.
Especially when you assess, the entire space, as you mentioned, the stiff competition, but also the tariff impact that they haven't really been able to shake off. I mean, Nike, Lululemon, On Running, as well as Deckers, all underperforming this year. So hopefully we see some nice trend improvement as we approach 2026. But it's so appreciated, Nicole Padalides, for that breakdown. But now it's time for the disruptors, and George Tillis, Senior Markets Correspondent, is here with us today to discuss Applied Digital. Now, this is a name that's up 214%, George. We know they're entering into a non-binding term sheet to spin out their cloud computing business. So what can you tell us about today's move?
Well, I think, in the context of what's going on, there's actually a big move in the Corridor Company Expo today, but it looks like Applied Digital,
George.
we talked about before, as one of these companies that started off as really a Bitcoin mining company that is increasing the yield of their technologies to essentially move into high performance computing, data center as a service, or GPU as a service. Companies like CoreWeave and Applied Digital have a partnership. We look at the price action this year on Applied Digital, it's been pretty good, 200% plus, and remarkable over the last few years, up thousands of percent. So there's obviously a story behind Applied Digital, but there's also another story that sort of manifested as of today, where the company itself, which does have a cloud computing division, is actually looking to spin that portion of their business off and combine it with a company called Exo, which is essentially a company in the healthcare equipment space. Small cap company, based on yesterday's close. Exo was about $18 million in terms of market cap. So the news is really pushing that stock higher. But in essence, what this is going to do is create a company called Protoscale, which again is going to be a combined cloud computing business that will help Applied Digital leverage its AI factory campuses, as well as reduce execution risk across its verticals. And this is a name that's been pretty popular this last year, again combining the Bitcoin mining technologies with high performance computing. And the deal is expected to be more scalable for Applied Digital in the long term. And this is why Citizens still came out with and they declared a $40 price target and maintain an outperform rating on the name.
Okay, we talk a lot about the AI bubble narrative and everything surrounding that. I mean, some of this, I think at this point, broader tech concerns as we approach the new year. But I mean, a name like Applied Digital, do you think it's going to be difficult to continue to grow at this pace just based off, again, 215% gain in 2025?
So that's a great question, and that's why I'm structuring this trade in terms of that in mind. If you look at Applied Digital, I mean, it's down since its high. It was around $40 going back to, mid-October. So it's pulled back with the rest of the technology stack. I mean, if you look at crypto, it's been down. Even Broadcom, NVIDIA, two of the major players in GPU and chipset technology has been down. So I think there's some weakness overall, which is adding to Applied Digital's pullback. But if you do look at the rising 100-day moving average for Applied Digital, it seems to be trading above that. But in the short term, using a 20-day moving average, the stock is trading below that. So there's not necessarily momentum to push it right now through that. So what I'm going to do is I'm going to structure a bullish to neutral trade with those levels in mind, that 20-period moving average above and the 100-day moving average below. And I'm basically going to look out to January with 17 days and sell a cash secured put, because we're going to harvest some additional theta decay in terms of the market being closed this week. And the expiration cycle is very tight. And I'm going to sell the $23 put, and you can earn about $1.50 in credit or $150 a contract in credit. So essentially, the premise behind the trade is to hold the $23 area between now and expiration, and that $150 credit will erode to zero the next 17 days under assumption. Now, you do start this trade, you have to be willing and able to take ownership of the stock. If it does fall to 23 or below, you can sign shares, but your cost base is 21.5.
Yeah, and I mean, it's actually outperforming the overall market today, and amazingly so, still off of its highs for the year by about 37.5%, but also, a whopping 660% from the lows that we saw back in April. So a really just volatile year, but all things considered a big winner when you assess the entirety of 2025. So we appreciate that. George Tillis, Senior Markets Correspondent for the network. Now coming up next, it's time for our 360 round, and we will be diving into the IPO market and where we can expect that to go now into 2026. For readiness and as well as not timing to celebrate some of the winners as mega deals do continue to crowd the window and leave no room for mistakes.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Hoppy.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock. And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. We really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every sector.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Spy back to the VWAP.
360. I'm Jenny Horn, and it's now time for the 360 round.
Jenny, spies back to the VWAP, honey.
So we're seeing the IPO now readiness really in this multi-year discipline. But what does it really look like as far as these companies that are aiming to go public, of course, in 2026?
They have to have very, very tight stories, tight metrics,
and key growth levers, especially in those they can capitalize quarter after quarter, not only in 2026, but beyond.
So as far as now some of these mega IPOs that we're expecting, like say SpaceX, OpenAI, those could dominate the markets. But as far as now positioning yourself to be prepared, I mean, right now, where do you think the focus is drawing a ton of attention to?
Not going to talk about IPOs in 2026 without talking about the mega IPOs. Those ones are going to take up a lot of oxygen and a lot of attention. So I think every organization's got to look internally and say, hey, how are we going to stack up? What is the story we're going to tell, and what do our numbers really say? If we get this capital, what's going to happen?
So as far as that capital allocation tightening, I mean, what strategies right now are companies utilizing to differentiate beyond valuation, beyond some of the tech trade that is so right now, I think, heavily or pretty loftily valued?
That's right. You're always going to look at people, process, and technology. These organizations today, they're not looking at the IPO as a finish line. They're looking at it as the start of the race. They're looking at it as, we're going to build the enterprise value over time. We're going to get these dollars. We know what we're going to do with these dollars. And most importantly, we're going to execute. Every organization that can execute, watch their IPO, and eventually their stock price, it's all going to go crazy.
Okay, so when it comes to that execution, of course, you mentioned that is a huge portion of this narrative, but what operational proof points now really have drawn investors in what could be a pretty busy IPO market?
Yeah, you've got to have strong growth. You've got to have path to profitability, and you know what you've also got to have? You've got to have efficiency. You've got to be able to show that you're incorporating AI into your business and that you're really a forward mover in your market.
So as far as some of these, if these mega IPOs do fail to materialize, I mean, I'm talking like worst case scenario, but how should overall companies really reposition, or how should we continue to stay competitive if we don't see some of these mega deals actually go through?
You know, I think what we have to think about there is 2025 was the rebound. And I think that 2026 could really be the breakout, especially if these mega deals happen. Now, if they don't happen, I think you still have a whole lot of companies, and we're talking to them here at Armanino, that are accelerating their IPOs, and they want to take advantage of what was set in 2025. There's so many companies that say, hey, now's our opportunity. We like our numbers. We like our growth story. We like our trajectory. We can go make it happen with or without the mega IPOs.
Okay, so as far as some of the IPOs and the general interest we saw in 2025, what themes really stuck out to you? Like, what worked, what didn't?
When you think about what worked, it just all comes back to the fundamentals, right? They had great numbers. They showed year-over-year growth. They showed customer sentiment. They showed where they're.
You can't get it out of him.
Maybe they said, hey, today, this is what our revenue looks like. We're going to be able to invest and grow even more. We have a very tight segment, and we think we can dominate it. It's ripe for disruption. Those are all areas that worked really well in 25.
Okay, so then on the other side of the coin, what did not work so well, perhaps, and what gives you maybe more caution or pause going into the new year?
Yeah.
You know, what you have there is you have the stories that maybe they went IPO and the numbers were good, but they weren't great, and then they deteriorated rapidly. And if you have that, you know, your stock price is going to take a hit. So as we always say at Armanino, it's not, IPO is not your finish line. It's the beginning of the race. And we really want you to be successful quarter after quarter. Those companies that do that are investing in people, process, and technology to be successful for the long haul.
Okay, and how much of this process do you see tied to the current administration? I know we've been expecting, what feels like for the last 12 months, to see a more improved and easier environment for them, this IPO market to continue to boom, but hasn't really played out as the same pace, I think, that many of the bulls were hoping. So how much of this is tied to some of the administration and the policy that could come, of course, in a new year?
Right, I think, we're going to get a new Fed chair. You're going to see potentially more rate
I'd be excited about that.
Does make for a easier IPO environment. Additionally, it seems that this administration is very tech forward or tech favorable. So we'll see what happens. I think that everybody's hoping for that breakout year 2026 IPOs, especially in the tech sector.
Okay, so it does sound like you're very enthusiastic about the overall tech sector as well as, of course, just the IPO market. What are you watching? What is your key standout that you're watching for in 2026? What excites you the most about these markets heading into, of course, a reset?
Yeah, baby.
I do think that, based off what we're building off of 2025, 2026 is going to be that breakout year. You have a lot of companies that are pulling forward. That's really what it is. Every management team that we're talking to, they're talking about the IPO. They're talking about how they can control their numbers. They're talking about their metrics and how they can best position themselves to win in the future. And that positive and energy and momentum is really going to get taken advantage of. And then, like we talked about earlier, they're going to execute and they're going to make it happen in 26 and beyond.
So as far as any then risks to, what has been a really strong narrative that's held up these markets all year long, do you see like geopolitical tensions any further? Fed, say, sort of, not underperformance, but say an uncharted Fed is the better way to put it. Do you see any of these risks weighing on any of the sentiment, or are you full speed ahead, bullish into 2026?
Risks are always going to be there. There's going to be so many things that people can't control. We saw all of that in 2025. You're going to have so many risks that every organization can't control. I think the best organizations, when they set themselves up, they control everything they can internally. And that means their numbers are good and the market would receive them well.
Yeah, and I think that that's a great place to leave it. And I love your optimism as we do approach a new year. I love to hear all the bullish expectations for the setup for 2026. So appreciate it for your time today. That is Dean Cuyambo, partner at Amarino. Now, thank you so much for joining us on Trading 360 on this Tuesday. I'm Jenny Horn. Thanks for tuning in. Fast Market is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be further downside areas to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Pop. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize what can I pick up from my dad. He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Market. We are live here on Schwab Network. I'm Nicole Petalides. It's noontime here at the New York Stock Exchange on the corner of Wall and Broad. I'm in for my friend Diane King Hall. So glad you are all with us. Here's a quick look at the markets. What's Santa Claus rally? You know, it's supposed to be the last 5 trading days of this year and the 2 first trading days of the new year. Hasn't happened yet. Friday, Monday, Tuesday, down arrows. S&P right now, after hitting a record intraday on Friday, is at 68.99, down 6 points. The Dow Jones Industrial Average down 0.25%, and the Nasdaq right now is down 18 points. And we are seeing healthcare and financials and tech all to the downside here. The Russell, the small caps are down 0.25%. Some bright spots would include energy, utilities, and communication services. Oil and gold have been mixed. Gold's been gaining. The metals are bouncing back, and that's a big deal, while oil selling off is down at a level of about $58, and the 10-year bond yield is at 4.12. Here's the roadmap for today's show. We'll take a look at some example option strategies for Tesla, which hit a new all-time high last week. It's got some new price target hikes, so a lot about Tesla for you. And the team from Likefolio will take a look at the latest sentiment data for Alphabet, one of the big winners of 2025. And we'll break down Micron. George Stills will take a look at that one after its 200+% rally this year, looking at all of those important stories and more. In the meantime, we have all the trading action. The roadmap for you here is ready to go, and I bring in my co-hosts, Tom White in our Chicago studio, and Kevin Hanks joining us live from the CBOE. It's great to see you both once again. And Tom, there in the Chicago studio, we think about some of the action. I mean, of course, we're waiting for the Federal Open Market Committee minutes, which will be out at 2 p.m. Eastern Time. I'm super excited for them. I mean, these are my moments that I love to comb through and see how the markets might react, or if there's anything that we didn't quite get in the meeting. Your thoughts?
Yeah, Kevin, you know, when you look at markets right now,
Oh, here we
they're
go.
relatively flat. We've been consolidating a little bit.
Here we go, here we go.
Weakness. Santa Claus rally might not come. Just
Hello, always clean. This is Jim.
Office.
Excuse me again?
The Claremont office, you were going to meet me today at 11 to
Yeah.
Give me that spare key?
Yeah.
Okay, are you...
Yeah, I got the spare key sitting up front as you go into the IRS building with the security guard.
Oh, you left it in the IRS side?
Yeah, he's going to give it to you. He's
Okay,
got it in
perfect.
his front desk.
Perfect.
I didn't know.
Walk in there now then.
Huh?
I said, perfect, I'll walk in there now then. I wasn't sure if you were running a few minutes. Just
Oh
waiting
no.
on you.
I'm glad you called. But I didn't know exactly how to work that combination lock.
What's that?
I didn't know exactly how to work that combination lock, put that key in.
Oh, okay. Yeah, no big deal at all. I appreciate you dropping it off. I'll walk in here now and get the key from, you said, the security guard.
Yeah, he has it in the front desk as you go into the left.
Perfect. I will get it from there.
Okay.
Thank you, Jim. Have a great day.
Yes, sir. You gonna go ahead and hold on to that key, or put it back, or try
I'll
to?
just put it back in that lockbox.
Okay. How does that work?
It's just got a little, it's got a 4-number dial that you twist. Hey, there's a gentleman that left the key for next door here with the security. All right, thank you, sir. You go. Appreciate it. You too. All right, I got it. But yeah, I'll just put the key in the lockbox. It just has a little black plastic sleeve that you kind of slide and pull down.
You guys saw that?
And then it has like 4 little silver number dials, and then you just twist those up to put in the code, and then there's a little lever on the side that you pop, and once you have the code in and all the numbers have landed on the notches, then it just pops. So you just pop that little latch and it opens right up for you.
Okay, I'll give it another shot.
Okay. Well, I will. I'll leave this key in the lockbox there when I get done taking some photos.
Okay.
All right. Thank you, Jim. Have a great day.
Yes, sir. Lock her up when you leave.
Will do.
Yep.
in some of Brian Moynihan's comments pertaining to the Fed and tariffs and being positive on the economy and how it's being powered overall. The head of Bank of America, the CEO of Bank of America, he seems a little less worried about the tariff story. A lot of folks thinking the tariff story is somewhat stabilized, but also saying that the economy is much bigger than the Fed and there's too much fascination on the Fed.
Here we go.
The Fed will cut 25 basis points, noting that it's really private equity and the private sector strength that's really driving everything, and people shouldn't focus so much on the Fed the way we do this, and that the Fed's role is really during crises or, at that point, a lender of last resort to stabilize markets that maybe we're a little too fascinated with the Fed.
Exactly.
Was his 2 cents on all of that. We could turn our attention over
I agree
to
with
what's
her.
going on with Boeing. Yesterday, we had Tigris come out with a buy rating.
Smooch.
At a 275 target, and today we get a defense contract. Tom?
Uh-huh.
Yeah, 25 F-15 jets that Israel is going to order here, and then the option for another 25. So this is kind of reflective of what we've seen in the markets here. Remember, this is only about 17% of the revenue from Boeing. This is kind of that maybe forgotten about part of their revenue streams at this point. Some of their competitors maybe beating them to the punch, but this is definitely a benefit for the stock. It's up 17% so far in the month of December. Remember, just over a month ago, we were below the $180 a share level. We're back above 221 at this point, so it's had a good run recently. That's even with the announcement that Boeing's or its competitor, Etsy, over there in Europe, just got orders for 60 jets out of China. Option for 30 more over there as far as Airbus goes, so that's a positive for them. But I think this is probably a benefit for the new CEO. If you start taking a look at the amount of deliveries, the free cash flow that they need, that investors want, that's coming to fruition. Maybe slower than the market wanted and anticipated. And that's why we saw that drawdown in the month of November. But starting to see a resurgence here. And then don't ever forget that the fact that the European Union and other countries around the globe, part of NATO, they're actually pumping up their defense spending at this point at their behest of what our administration wanted. So maybe that's more orders down the line. But this is definitely one of those outside better bets for Boeing to help support the stock until they can get at full production and get those deliveries up where they want them. There was some speculation after Airbus lowered their expectations for deliveries for the year that Boeing might overtake them for the first time in a couple of years. But yeah, the turnaround story at Boeing, I don't think that's done by any stretch of the imagination here.
Yeah, it's pretty amazing because last November, Israel did in fact sign a $5.2 billion deal for 25 F-15 A1As, and so those were supplied in batches of 4 to 6 per year, starting in 2031. And then the deal that we've seen now adds to this, bringing the total number to 50. It's just amazing how this is the way it's going for Boeing. Great news for Boeing overall. Kevin, some of your thoughts?
Yeah, I think this is good news. It's a good story. Boeing is starting to pile up good stories now. Kelly Ortberg seems to have this company on track for positive cash flow in 2026. Remember, the reason they sold off after earnings was the charge they took and the delaying of the Dreamliner. So their goal for 2026, remember they pushed that back to 2027. They got to get that Dreamliner in the air. The 737 MAX is going to be their big seller, right? It's the quietest and most fuel-efficient plane going to be in the air, and probably, frankly, the most scrutinized. But with the evolution of air carriers right now, international premium planes, these jumbo airliners, they have to get them in the air as soon as possible. But Kelly Ortberg's on the right track. He's got an engineering background. He moved to Seattle to be closer to the plant. I mean, this turnaround that took a little break when they had their last earnings report is back on track here now.
What's interesting is these F-15s have been used extensively over the past couple of years for Israel and the operations that were targeting Iran.
Well, when I mentioned
Hezbollah in
OCG,
Lebanon,
it's
and
pulled back
we don't
big
know what
time.
happens next. Are we going to be supplying Turkey and also Saudi Arabia? I saw some notes on that there were considerations to send F-35s jets to Turkey and also stealth fighters to Saudi
I mean,
Arabia.
I saw a bounce on IWM when I mentioned it on the third dip, and it pulled back.
About Meta, because just when we finished talking about Grok and NVIDIA, the AI agent with inference skills, now we have something new here with Meta and Manus. All right, Tom, your thoughts?
Yeah.
Hey, Nicole, tell these two bald-headed eagles that the SPX on the 1 minute is at the 21 EMA right now, squeezing between the 9. Yeah. SPX, yep. Squeeze right here.
Meta Platforms is spending on trying to be a dominant player in the AI space. Mark Zuckerberg has been pretty astute as far as the investments that they've made over there. And this is about those AI agents and the ability for this company integrating its technology into those products. Tencent, some others in that area. And if you look at what they're doing as far as partnerships go with China Tech at this point, that's maybe the reason that this deal only took about a week and a half to kind of get completed at this point, because maybe Meta Platforms realizes how important it is to get a foothold maybe in that market over there. Over 3.5 billion daily active users across all their platforms, and this is going to add to it. I'm not sure if investors are going to like it, just because they're putting more CapEx spend out there. But if it's monetizable, like their 3.5 billion daily active users, that's going to be a benefit as this AI in the agents get built out a little bit. But yeah, not surprising that we're seeing more spending here from Meta Platforms. There was a positive note on it almost immediately out of one of the analyst firms that said that this would be a good acquisition for Meta Platforms moving forward.
Right, understood. What do you think, Kevin? What are your thoughts here when we think about this Max 7 name?
I think this is a great story, and here's why. Imagine a small company in Singapore going into a funding round, right? That's what they were doing. They gave themselves a $2 billion valuation going into the funding round, and Meta buys them for $2 billion. That's a great story, but it's amazing that people are really excited about this deal buying Manus. It sounds like people are comparing it to when they spent $1 billion on Instagram. That it could be a game changer for them and a company that will really accelerate some of their things going forward. So it's a pretty interesting deal, and the fact that the stock has rallied with everything going on, with think about Salesforce, and think about all these companies that are buying companies and the stock is selling off hard. Meta rallied on this. I think that's a pretty good signal that the street likes this acquisition, Nicole.
Yeah, and to your point, it was Rosenblatt that put that buy rating out and talking about when they made these acquisitions to the likes of Instagram in 2012 and WhatsApp in 2014, that this really could really be and propel them into the next level. That this has a lot of potential, so they seemed very positive on that as well. So that was the buy rating there from Rosenblatt. Last but not least, we take a look here at Wolf Research with an underperform rating on Target. What is Target missing? Why are some retailers doing better than others? $81 Target on Target. Tom?
Yeah, I think if you look at it, it's been over a 4-year slide for Target shares. This misexecution, I think, at this point, because coming out of the pandemic, they were, thought to be the big competitor.
Might go get some coffee.
Executing well. They're starting to invest maybe in some of their stores to try to clean those up a little bit. They've had, they'll call it something else, but it's that played a major part in some of their margin compression at this point. Discretionary items was a big winner for them at the start of the pandemic, but that's tailed off. They didn't pivot to grocery quickly enough, but this Wolf research note comes after they lowered their estimates due to the fact that they
man,
had
look at that knife there.
During the holiday shopping season also. But this is about execution.
She's calling me at the Orb again. The SPX. Where's it? Where's it? Where's it? Where's it? Okay. Hmm. 69 tens. $175. So we're at the Orb here, and we've got the Head and Shoulders. We're at 195 right now with 69 tens. $175, give it to me. The 69 tens. Could grab 3 here and call it my early entry. Yeah, around 190, 195. You ain't gonna get it if you don't chase me. Okay.
Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
right here on Schwab Network. We're taking a look at Tesla. Baird remains bullish on this name heading into 2026. In fact, Baird reiterates its outperform rating and puts a $548 price target. Today, Tesla's trading at $462. That shows some real upside potential. And since broader robo-taxi rollout, the SpaceX IPO, and an Optimus robot commercialization are why they view this stock as a core holding. Dan Ives was talking about the robo-taxi that we saw and the success in
That's
Austin
right.
and how it's going into 30 more cities, more than 30 cities. So there has been a lot of optimism surrounding this name. Let's bring in our co-hosts here back again, Tom White and Kevin Hinks. We take a look here at Tesla, which of course is looking at deliveries, and they sort of forewarned us this year that this quarter will be a tough one, that we're probably going to see down arrows again here and see slipping of sales from 1.8 million in 2023 to 1.79 million in 2024 and down to 1.64 million this year. So that's not the best part of the Tesla story. There's so much to it. Kevin?
Listen, when I think of Tesla, if I
No.
was writing a paper on Tesla, the topic would be the future is here, right? And that's why Tesla stock has been so strong despite EV sales that have been underwhelming, frankly, because it's not about EVs anymore. It's about robo-taxis. It's about full self-driving. It's about Optimus robots. It's about SpaceX. It's about all these other things that could affect Tesla in one way or another. So I think there's so many things going on. 2026 could be the year that Elon Musk catapults himself again to a higher level. So I think cars, though significant, and though they're the engine that got Elon Musk here, the future is a bunch of other things, Nicole. And I think 2026 is going to be a massive year for Elon Musk. And just buckle up and hold on tight, because I think it might be volatile, because the street tends to get their expectations really high and disappoint, and then they get better. But all things considered, I think 2026 is going to be a pretty amazing year for Tesla.
Yeah, and the analyst is Ben Callow over at Baird, and he was saying that they continue to view Tesla as a core holding, as I mentioned, going into the new year. Some of the
That's exciting to know.
rollout of the robo-taxis, as
Pretty
well as
badass.
product launches, incremental details on the commercialization of Optimus humanoid robots. I mean, it's almost like we're all going to have them everywhere. And the initial public offering for SpaceX maybe could just be an Elon Musk boost, right? Tom, what do you think about this? Does this work? I mean, what do you, also this price target here, much higher than our current level?
Yeah, I think Kevin put it right. It's about this, it's about that, it's about goals. And
About
whether it's
this.
to roll out a robo-taxi to different cities, they're supposed to be in 30 different cities in
Okay.
2026 with the autonomous vehicles, and then full self-driving rollout to create maybe any Tesla that could be a robo-taxi. Those goals start in April, right? And then the Optimus robot. Beijing's going full in on robots as far as in manufacturing, industrial settings, in other areas. That's probably where Elon Musk will probably build, the first deliveries for the Optimus robots. But there's a lot of optimism in this stock, and there always is, just because Elon Musk runs it. And, it's the future, just as Kevin said, the future is here, right? Well, he's set goals in the past, and those always haven't come to fruition. And then you throw in what basically funds all this, and that's EV sales. And we've just seen a bunch of analysts cut their estimates from over 450,000 for the quarter. Now we're down at 415,000. So those estimates continue to deteriorate, but that's not how Tesla's priced. Tesla's priced on all those things that Kevin and you talked about.
He said they're real
I thought
nice.
It was interesting, this Baird analyst that came out with the note called it a core holding. I don't think there's a lot of people out there that call it a core holding.
Deteriorate.
It's a tradable type of stock, but a lot of what the price of the stock has built into it is about optimism that these goals are going to come to fruition and they're going to be monetizable, and it's got to start quick, right?
And folks sort of missed if they were doing Mag 7 or Mag 6 to the minus Tesla. There was a time that people were sort of out on Tesla. They would have missed this run from $214 up to nearly $500. Let's get, I mean, that brings us to the chart. That's a good segue there. So let's see some example trades. Kevin, I believe you're going to start us off here.
Yeah, well, looking at the note that was put out this morning, looking for next year, what I wanted to give myself is duration. I wanted to give myself a chance for a win in the future. And so I set up a paper money trade that reflects a bullish narrative in Tesla, much like we've been talking about. If you think that's right, what I gave myself is 38 days, Nicole and Tom, went out to the February 6th expiration, bought the 460 call right at the money, but because I've given myself so much time, the expected move after February 6th, $67 is the expected move. Now that's up or down. So what I did, bought the 460, sold 2 of the 520s, right, $60 higher than where we're at right now, and then I bought 1 of the 530 calls, so an unbalanced call butterfly that buys a $60 call vertical and then sells a $10 call vertical. The debit was about $18. It's trading pretty close to $18 right now, Nicole and Tom. So this one gives you a lot of upside, but as you know, Tesla options, they're not cheap. You got to pay about $18 with the max gain, you know, of about almost $4,200, Tom.
Yep, yeah, let's break this one down. Going into the February 6th weekly cycle, so Kevin's given himself some duration here. You do have an earnings event on the 28th, is what it's pegged for right now of this January. So you're going to capture an earnings event with this type of position. But let's break it down. Buying 1 of the 460 strike calls slightly in the money, sell 2 of those 520 calls. That's where you want the stock to go. And then buy 1 of the 530 calls. So in essence, you're buying on this trade a $60 wide bullish call vertical, offsetting some of the cost by selling a $10 wide call vertical with that same common strike that you sold 2 options at the 520 strike. $18 debit, there's your risk, $1,800 per spread. As Kevin mentioned, this can expand to $4,200 and max potential for profitability on this. But even if we do continue to move higher, gets above that 530 strike, it's definitely more than a double in profitability on this trade. So while you lose some profitability, you don't lose that much. Your break even on this one, if you pay that $18 debit, it's going to be $478 to the upside on this one. So you're going to need a percentage move, a small percentage move to get above that break even on this one. But it's directionally bullish. You're offsetting some of the costs on this trade. But the expectations are that we're going to continue to grind higher. Max profit at 520, but anything above 530 is still profitability on this. But you do need to get above that break even of 478 on this trade to start seeing some profits on it. But as Kevin mentioned, giving yourself duration on this one, 38 days on this one. So I looked at something on the flip side. So the Kevin's is not aggressively bullish, but bullish on a percentage basis. You don't need that big of a move. I looked at something a little bit more passive and a little shorter duration also.
You do.
Avoids that earnings event here.
I wouldn't do that.
In the January 23rd
little boy.
weekly option series that expires.
I wouldn't do that, little boy.
Looking at selling an out of the money call, the 490 strike call, and then against it, buy the 500 strike call. So bearish, neutral to bearish, $10 wide short call vertical. You're collecting roughly about a 230 credit. About trading just a little bit higher than that right now.
I don't think you'd do good in prison.
What you make on it. So $230 is your potential profitability on this, with $770 in risk on it, and that's above the 500 level on this trade. Your break even on this one, 490, 230 to the upside, but this is a higher probability trade where I'm risking more to make less, but I've given myself better probabilities on this neutral to bearish short call vertical.
Yeah, 71% chance that the 490 call will finish out of the money, Tom. So this is a high probability, short vertical, this time the call side, which is risk defined, right? $10 wide. The risk is $10 minus whatever credit you take in, and you're collecting theta. So if you have other long deltas in Tesla or a long Tesla stock, this is a way to hedge and take the other side of that. It's only short term. It's only 24 days, a little over 3 weeks, and there's some downtime in between there. But this one bets that Tesla, which has a expected move around $44 during that period, won't get to 490. That's about $28, Tom.
Yep, so a little bit more aggressive. Avoids earnings on this one as opposed to Kevin's bullish call butterfly that actually captures that earnings event. So there's your bull bear debate, Nicole. And actually, if you think about it, if this thing stays below 490 into expiration over the next 3 weeks, this could be profitable. And then maybe an earnings event causes the stock to go higher. So they could actually both be profitable, just different durations on these.
That's what makes it so exciting. And I was looking here on also on Benzinga, they were talking about a little bit of a bearish tendency today, December 30th, when they were looking at some of the options trades and saying that they found that 38% of the traders were bullish, 41%, just slightly more, showed some bearish tendencies, and they spotted 205 with puts, 173 were calls. Though the call value is a little bit higher, so it does look like this could go either way. So I'm glad we had this as our bull bear debate today. Thank you both for that. And keep it here and stick around, gentlemen. Cash Tags is next, and we'll have the team from Washfolio to
There it is, to the 200. Uh-oh.
On Alphabet School, which has
255. Yeah.
this year and hitting some new highs. What's next? Fast Market. We'll be right back.
$69.10s to the 200. You lucky guy. Oh shit. You ruined that.
Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment.
How could you do that to that girl?
Stream Schwab Network at schwabnetwork.com.
Trading with Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live
There it goes.
or on demand. Head over to schwab.com/coaching
285.
and start learning today.
690444444444 4444.
No politics, no spin, just the market from opening close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market, live on the floor of the New York Stock Exchange. I'm Nicole Petalides. This is Schwab Network, and joining me once again alongside me,
I love you.
He's here for a special look here at Cash Tags, and for that we bring in Landon Swan, co-founder of Washfolio, and we're taking a look at Alphabet. Now this has been a big winner. We look at these Mag 7, particularly even in the fourth quarter, it has moved to new highs of 320.
285, 290.
Year to date, it's up over 65%. So let's get this going here, and we'll start it off here. Tom, when you think about this, your first thoughts?
Me? I'll take it, yeah. So, Google, and if you look at where they've gone, in the last year, yeah, it's up significantly.
Landon, wake up.
Back to April, it gets even better. I mean, they were 140 in April, they're 314, now it's about 124%. And I think it's basically mirrored.
Might fire your ass.
It's gone from an AI is going to maybe beat up this company, and I'll be the first to admit I was saying that a year ago. AI is a threat to Google, now it's AI. They might be
threat to Google.
They might leverage this like nobody else, and all of their other business units are doing really well. So that doesn't hurt.
What?
I think AI has kind of moved from this giant threat to this giant opportunity. And that's a huge move for investors, and it's reflected in the stock price. So just when you look at how well Gemini has done, I mean, they're
We've done well, but
the monthly active users are up 7x on a year-over-year basis. And when you look at the number of people going to Google Gemini versus GPT, it's up 300% versus
690444444 with some kind of resistance.
This is growth, right? So GPT is still much larger. I think they're 80-85% of the AI chat share. But Gemini,
275.
Grok's doing well, Perplexity's doing well. They're all kind of coming after GPT, who was the early dominant leader and still is.
Well, Lynch is out of the way.
Big strides towards that, and
Maybe.
to the point where now daily active users of Gemini are putting in about 4.
No, we're not.
Per day, whereas GPT is almost double that at 7.5 queries per day. The interesting thing though is that if you look at the monthly active users of Gemini, only about 10% of them are daily active users.
6'9". Excuse me, prison guy. I was here first. 6904.44444444. 4444444444444. 4444444444444. Resistance to break. Again, I'll repeat that. $6,904.44. 4 cents. Do you like it when I do that? Someone say yes. That or you'll listen to the prison guy. Randy says yes. Okay.
You do an AI deeper dive, and it's right there. So
It's
doesn't
not.
that just make sense if you're going to be, if you're going to choose one of these AI agents moving forward in the future, that hey, why not just stick with what you know, and if it's a great product. Are you guys still seeing that where, hey,
Nope.
they're going to continue to dig in?
The market will change.
Share just because it's maybe easier than because of what people used prior to this.
Yeah, absolutely. I mean, they, not being the leader was a huge disadvantage. GPT jumped out, and everyone who wanted to try AI chat jumped on in. They were the ones to use. But now it's in your face. Google.
I don't know about these guys.
Search engine for everyone, and now you've got Gemini in your face, and it's giving you the AI overview.
I am not.
Exactly what they need to do. The revenue from that actually is very close to search.
Nobody's face.
So that is, that's their way of catching up. And so we often talk about the value of user bases. I talked about it with Meta, and Google's got one of the largest user bases in the world. And so they have the ability to roll things out and catch up very quickly. But that doesn't necessarily mean they're going to win. I mean, you can take a look at Apple Music versus Spotify, right? I mean, everybody has an iPhone, and you open it up, and Apple Music is the app to go to. But Spotify beat them because they built a better mousetrap. Now, which one's better? I think depends on the month that you talk about, and it depends on who you're talking about, what the use case is.
Oh, low blow.
The difference between Spotify and Apple Music is much greater than the difference between GPT and Gemini or Grok or Perplexity. So I think they're all kind of vying for the lead in usability.
Well, he's ahead of me on that one.
Obviously, Google's going to win there. And then when you look at some of the other segments, I mean, you just talked about their cloud. They're crushing it on cloud. Revenues up.
You're crushing it there, Army military prison guy.
Showed about a plus 28% move, so it's right in line with their revenue. And they are the ones that are increasing on a year-over-year basis. The other two big ones that we look at, Microsoft and Amazon.
We just now might break resistance.
Versus Google Cloud. So doing very well there. And then, of course, streaming. YouTube is the #1 streamer. They get about 13% of TV time in the U.S. Netflix, for reference, is second.
Very nice. I'll be right back.
Tons and tons of eyeballs, tons and tons of users. They're continuing to expand their lead. Netflix is kind of going sideways, and we talked about this. The competition is unbelievable for them. Whereas, YouTube, they are a content machine because you got so many users making content for you. Netflix doesn't have that advantage. They have to constantly chase, either license new stuff or create new stuff. Whereas YouTube's just like, here, build it, and we'll share some revenue with you. It's an incredible platform, and they're really dominating. So, every major component of Google is doing extremely well. You can also throw Waymo in there. I think that Tesla's going to beat them, but they're also giving it a shot. We'll see. That's kind of the moonshot play for them. Maybe it works out, maybe it doesn't. It's a huge business division, but for Google, it's a footnote, and rightfully so, just because of how large they are. But overall, again, this is just a move from AI is going to kill this company to I think this company can really leverage AI, and that's what they're starting to do.
And Landon, I'll just add that AI certainly seems to be driving not only the last few years, but also going forward. It doesn't seem to be stopping at any point. I mean, there's still such a fascination and CapEx spend and circular funding. And, for example, the DeepMind chief, Dennis Hassett, has had The Thinking Game, the documentary on YouTube, and already surpassed 200 million views on YouTube just in 1 month alone. And it's about his AI lab. I also think that Mark Benioff really flagged the difference between Gemini 3 and ChatGPT, because he had said he was using ChatGPT for 3 years. Once he used Gemini 3, he said, that's it, I'm switching, and he gave a whole list of reasons why he thought it was the better choice. So maybe ChatGPT is more mainstream, like you're saying, but I'm very curious in a year or two, what will we be saying then? A great conversation, both of you, Tom and Landon. Thank you both. What a great conversation there. Landon Swan, co-founder of Likefolio. So let's bring Kevin Higgs back in here. We want to hear what you have to say about Alphabet, please.
This is the story, I think, of the tortoise and the hare when it comes to AI. So many of these firms jumped out in front of Gemini, and Gemini struggled, and all of a sudden here they come, and now everyone favors Gemini. I think the term Google it may turn into the term Gemini it when this is all said and done. So I think they do everything well. Right? It doesn't mean that the stock is going up or down, but they do everything well, Nicole. So when I looked at a trade for them to do, Tom and Nicole, I looked at something that just simply trades on, remember, one last thing about Google. They own the entire stack. That's one of their positives. They own everything in the chain from start to finish in AI. So when I looked at something is, number one, this has also got a very low 16% current IV percentile. So that also affected the strategy I would do. And so I looked at something in the diagonal family, but what I did was I extended duration on the calls. I went out all the way to January 30th on calls. I gave myself 31 days, a full month, until this long call expired. I bought the 315, and then I sold next week's January 9th, 325 call.
Good setup. There it is, starting
which
again.
seems a little pricey for a $10 diagonal, but remember, you can extend duration on this into the January 16th, and then the January 23rd, and then all into the January 3rd. So you're going to get a chance to extend duration and really chip away at that net debit of $9. Tom, this is a trade that gives you deltas. It's in the calendar spread family, so it's got positive or slightly positive theta right now, but it'll get more theta as you get closer to expiration. And this gives you a target of about $10 higher on the stock, Tom.
Yeah, let's break this one down, Kev. Bullish call diagonal here. Going up to the January 30th weekly cycle, I think one item of note here, they report earnings that first week of February, so you avoid earnings, but maybe take advantage of any potential upside into that event risk. So keep that in mind. January 30th, by the 315 strike call, just about $1 out of the money to the upside of the current share price, about 314. And then in the near term, January 9th, weekly options that expire in 10 days, sell the 325 call, bullish $10 wide call diagonal, paying roughly about a $9 debit. It's a little bit less than that, maybe $8.70 right now, so you can get it a little bit cheaper, but it is less than the width of the call diagonal. So anything above about the 319, 320 level is going to be potential profitability on this trade. So on a percentage basis, you need less than 2% move to the upside to start getting into that window of profitability on this. Now, you can see here from the risk profile, over the next 10 days, you want it to go up and near 325, that where you can get the most credit for those potential rolls or adjustments on that short strike as it gets closer to expiration, creating credits. That lowers your risk, that lowers your break even, increases potential profitability on this type of trade. So some trade management might be warranted on this as you get closer to expiration, but it is a bullish look. You do need the stock to move a little bit higher back towards those all-time highs that we recently hit on this one. But this takes advantage of duration, avoids that earnings event, Nicole, but gives you upside exposure in Google Alphabet and sets up well with all the positive data that Likefolio had on this stock.
Without doubt. All right. Well, thank you both for the charts, the trades, the look there at Alphabet, which is at 313.76 right now. And coming up next, we're going to take a look at Micron. Now, this has been an incredible stock. It's near $300. Has run up to new highs recently. Year to date, up over 250%. It's amazing. Fast Market will be right back.
Stay connected to the markets with the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of the platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
All right, time to check out Micron. This stock has hit a new all-time intraday high in the session, 298. That's right, and it has rallied over 230% in 2025. One of the best performing stocks in the S&P 500 this year, and the rally has been fueled by a super cycle in the AI memory market. We bring in Senior Markets correspondent George Sillis to break this all down, and you sort of take us inside what folks have been saying and what fueled the rally of Micron this year, and I guess the group too probably got a nice boost too.
Yeah, this is a special situation. I mean, if you look at Micron, which is, a U.S.-based DRAM and NAND flash memory manufacturer, out of the three major global suppliers, SK Hynix and Samsung are the other two. It's been a remarkable story, both on a cyclical basis, but also on a secular basis. And we know the secular trends for artificial intelligence are growing, everything from CPUs and GPUs, as well as XPUs, which are basically combined CPU and GPU technologies. All the periphery semiconductors, including DRAM and memory, for edge cloud computing, and all the outputs needed to store the short-term memory standpoint of artificial intelligence publications and data inference. These companies like Micron and Samsung and SK Hynix can't keep up. And that's really the story behind the tremendous move this year for Micron. It really comes down to the demand now for the servers, data centers, even PCs from a cyclical standpoint need more RAM. Prices have been increasing substantially. And the demands for their technologies have been growing substantially as well. And the story for Micron, too, is not just price. You look at the price and say that this is an exceptional price move, which it is, but you can also make the case that it could be justifiably moving higher because the earnings estimates just continue to inch higher. Just to give you some context, Nicole, if you look at the EPS estimates for 2026, just going back a couple of quarters ago, the numbers are around $18 a share. Right now, they've been adjusted to $38 a share, so more than double. And so the price action really speaks to growing earnings, growing revenues, but also growing profitability, considering right now gross margins, too, for the business, 45%. Historically, they're around 27%, so almost 20% higher, and then net income margins, too, up 20%. Compared to where they were just on their 5-year averages. So the profitability has been improving for Micron. The earnings estimates continue to rise. Price continues to move higher. And even as price keeps moving higher, the stock's even cheaper on an earnings multiple basis because right now, just based on next year's earnings, it's only trading around 8 times next year's earnings. So there's a lot riding on Micron's progress going forward. This is really a story where there's just not enough supply and prices are moving higher. The market is fulfilling the needs for DRAM technologies that Micron provides.
Yeah, and look, I mean, when I look at this, I can't get over the move that we've seen. And when you're talking about the value, how it's priced so inexpensively to a certain extent, it really is amazing. Thank you so much for that. George Zillis, good to see you, and a nice look there at Micron. Let's bring back Tom and Kevin here, because we want to take a look at an example trade. I mean, when you see this name here at these intraday records, Tom, take us through your example trade here.
Yeah, this isn't necessarily just a Micron story. This is a memory chip story, hard disk drive stock story, because if you look at the gainers in the S&P 500 this year, it's SanDisk, it's Western Digital, it's Micron, it's Seagate Technologies. So they've all done pretty well, and George mentioned it. The pricing's gotten better for their legacy parts of their business, and then Micron, throw it on top there, they're gaining market share in the high bandwidth memory. That's a higher margin portion of their business. As AI infrastructure gets built out, these high-end chips are in demand, and they're sold out through 2026, the CEO said, already in their HBM market. So positives going in here, but the stock has moved up. I remember Kevin and I talking about this stock, and it was single-digit PEs, and we always scratched our head because it's such a cyclical business as far as pricing and demand goes. But it's been on a roll, up 250% so far this year. So I looked at a strategy it's neutral to bearish, but even if the stock moves higher and you're wrong and it goes up a little bit, you can still profit on this type of trade. I looked at an unbalanced or broken wing call butterfly where I'm actually going to take in a credit on this. So out in the January 16th monthly options that expire in just about 2.5 weeks, buy one of the January 300 strike calls, sell 2 of the 305 strike calls, and then buy 1 of the 330 strike calls. You're going to collect a credit on this unbalanced or broken wing call butterfly of about $4. So that's what you can make if the stock remains below 300. You just get to keep that credit that you collected of $400 per spread. Now, it takes your break even to the upside at 314 to the upside. That's over 6% above the current share price in there. So you have a nice cushion, and you get that little kicker at that short strike of the 305 line where you're short 2 options there. Now, where's the downside? The downside is all the way up above 330. That's max loss on that one. It's going to be about $1,600 in risk on total on this trade, but that's above the 330 level. Kevin, unbalanced where, hey, I can be wrong and this stock goes higher and I can still profit, but it'd be fresh all-time highs if it continues to move to the upside.
Yeah, this is a call butterfly that peaks out on the upside, but actually is short deltas. You're short 2 of the 305s, that's where you want it to go. But like I said, you don't break even, you don't start losing money until 314. So this is one that you're perfectly fine if it sits right here. A question we ask all the time, what happens if nothing happens? This trade is profitable if nothing happens, Tom.
Yep, 3 out of 4 scenarios profitable. The stock goes lower, stays where it is, goes a little bit higher, but remains below 314. Potential profitability on this Micron trade, Nicole.
Well, I was just peeking to see if the S&P would go green before the end of the show. I know we've had some back and forth, and right now it's just down about a point. But thank you both so much. There's great trades, good looks at charts, and a lot of content this hour here on Fast Market. Tom White, Kevin Hanks, thank you both. Thank you, friends, for being with me here. I'm Nicole Pedalides. Let's meet up at 2 o'clock for the watch list.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside areas to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, I had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
and Investing. I'm Jenny Horn alongside Alex Coffey, and we are seeing another day of pressure as we check in on markets here at the noon Central Hour in Chicago. But modestly, yesterday we talked about a bit more of a weak footing to start off this week. Alex, today we are just, drifting lower, and that's even, I would say, overstating this. You can see we're basically unchanged now in the NASDAQ as well as the S&Ps, and the Dow and Russell throughout today's session have seen some weakness, but again, modest. We're down 0.3% in the Russell to 2,000.
Yeah, you can see the finish line now. Like you're on that long race, you've been racing for hours. And you almost get like a jolt of energy, even though it's no different. And it just kind of feels like we're there now, where the story is pretty much written. But how many days has there even been a close above 6,900 in the S&P 500? I mean, it can't be more than 5. So when we talk about this market like it's crumbling, basically like within a percent and a half of like the highest levels ever. 7,000 seems like it's almost inevitable at this point. It's just a matter of when. And then it's the march to 8,000. As we know, in time, at least it has been the case of the S&P 500. It's designed to go up over time. Now, does it beat inflation? Is it the best place to park? Those are all questions for each individual to decide. But the stock market was designed to create value, to create wealth, and it has.
It has, and this year has been no exception to that. I know that the focus has been on the absence of the Santa Claus rally, which of course occurs from basically like now, through a few days into the new year.
Basically next week.
Yes, but I know that the concern is that it hasn't tended to repeat itself. Like we did not see the Santa Claus rally come to fruition last year. Now the market concern is, it's absent this year. But also, very different years. I have a hard time even comparing the price performance of last year because last year was an election year.
Well, and take all that out. What was the performance of last year? Over 20%, right? We're basically at that this year. Like, does it matter when it happens? If you're just invested and you're performing alongside the market, these lines in the sand, these things that we try to find to compare from year to year, month to month, week to week. The reality is if you're invested and you have exposure to risk assets, you just need them to perform. When they perform, that's more of a tactical, active manager conversation. And if your 2025 strategy was wait until the Santa Claus rally, well, there was nothing that could have saved you from your underperformance.
Yeah, I would say I would not tend to want to focus on just these last several sessions of the year when it's been characterized by so many other moves and so many other major developments and interesting trends have emerged, like of course the K-shaped economy as well as the resiliency, frankly, of the memory space within AI. So wide variety of things that were definite winners throughout the year. But as always on the show, we'll focus on more of these individual equity movers. We'll kick things off here with a really interesting note we got from Wedbush's Dan Ives on his top picks in tech now into the new year. We'll also dive into the charts and trades of Target versus Walmart, the winners and the losers of big box retail. We'll also be discussing some further consolidation as well as deal making we're seeing across tech right now as Meta did announce this deal, $2 billion, so not, massive by any means, but for Manus. And so it's definitely showing its footing in AI, as well as we'll discuss more on that Grok and NVIDIA deal. Of course, the various licensing agreements, not an acquisition, as well as Applied Digital spinning out its cloud business and now combining with another company. So various moves are being made right now in big tech. I know we keep saying it's news light, but there have been some interesting pieces of headline that have emerged from the tech trade over the last several days.
Yeah, no doubt. You want to get into this Dan Ives note a little bit because what I noticed was two things. One, we're going to cover 4 of the names. There was a 5th, and that was Tesla. That's not on our list here. But you'll notice there's a name that we've talked about a lot over the last several years that's not on this top 5, and that's NVIDIA. So let's go through and start with Microsoft. What about these companies has made, I would say Wall Street's most notorious bullish analyst like them even more than he normally does?
Yeah, so I think it's interesting, as he did say, there were, undeniably so, that AI was once again the stock market leader in 2025. Now in 2026, he highlights there could be some new big winners in the space as a result of just the overall tech landscape. Now, to Alex's point, the one that was conspicuously absent was NVIDIA, but that he did note that he's still bullish on NVIDIA despite it being excluded from this list. But Microsoft is where we'll start here, as he did point out the upside to Azure specifically, writing that right now the street is underestimating the business's growth potential, and with stock up, I mean, roughly 15% now year to date. We know that this has been a really dominant force of AI infrastructure spend, with roughly an investment of $56 billion in this broader global AI projects, and about $80 billion in CapEx now projected for their fiscal 2025. So building the sovereign cloud regions and the supercomputing hubs, and also fighting for that coveted market share of the global cloud dominance. As we know, it still does trail AWS, but Azure is at least starting to close that gap ever so slightly. Now, we also know with their integrated AI stack, they're driving enterprise adoption. Azure bookings, to speak to Dan's points, are up 112%, with a $392 billion backlog, which again reinforces some pricing power, but also the strong financials of this company, I think, are astounding. I mean, 49% operating margin, a company that has seen sustained profitability for years, and right now 56 of the 61 analysts do have a buy or buy equivalent rating on Microsoft.
You know what's fascinating to me? I'm looking at the screen of a bunch of the analysts, sorting by price targets, highest to lowest. Mr. Ives at 625 would be the 39th highest.
That's ridiculous.
Price target. We just called him one of the most notorious bulls, kind of steps out on a limb sometimes, gives some really aggressive price targets. Not even close to the highest. I'm seeing Wells Fargo has a 700. I'm seeing a 730 out there. Citi at 690. He doesn't even make the first page when it comes to Microsoft. So it just goes to show the levels of optimism for this company going forward. Wasn't even the highest, in terms of where it would be in the last couple of weeks. I see a 650 from Scotiabank just today from Microsoft. So a lot of optimism in Microsoft. We'll compare and contrast in Apple now, because that's another one that made this top 5.
So he did say that this company may be accelerating its AI efforts. He didn't use the word may, he didn't say with certainty,
Triple
but
top.
if that happens,
Quad.
the AI monetization price could add roughly $75 to $100 per share to the Apple story over the coming few years.
So she might bite your finger off.
Not as strong of a performer as Microsoft this year, about 9-10%. And I think that this is an interesting call, because as we know from looking at Apple, I mean, it has these strong services and broader ecosystem. I mean, that's all 13% year-over-year growth, over $1 billion in paid subscriptions, expanding now into AI, health, as well as finance and media. And it's a financial fortress. I mean, it has $35 billion in net cash and $100 billion in annual free cash flow, consistent dividend boosts, and a balance sheet that continues to support, lofty spending. As far as companies with cash on hand, Apple is one of the names that really tops the list. So that, I think, can be understood, but also the strength of Apple can also be its weakness. We know that it's seeing a more maturing core product. The iPhone growth has been relatively stagnant. I know we've seen some encouraging overall metrics from its iPhone 17, but we know that that's also a lot of hope and optimism. The numbers we haven't seen yet from the full quarter report of the iPhone 17 sales. It also has seen an innovation gap where really it's struggled in AI, and it's faced setbacks in some of its long-term projects, like we've seen with the Vision, just various things. Vision Pro has not been fully scaled. Siri has been delayed. That's been one where I've been harping on it, because basically it feels like that technology is 5 years old, but yet they can't seem to re-release a new updated version. All that to be said, could see some possible further margin drag, but I did like the way he framed it, more of a long-term outlook on Apple.
Well, that $75 to $100 is like $1 to $1.5 trillion worth of opportunity potentially for Apple, but highest price target I see, $350. So really exciting that he sees all that optimism for Apple. When you talk about Siri, like the first thing I do when I get on an Apple device is disable that, because I'm just not interested in it. But I can't imagine one that has more reach, or already has kind of consumer penetration, in the sense that Siri is in every device that Apple has, And Apple has so many devices in America, so really, you know, a lot of opportunity if they get it right. And we know they're not always first, but they tend to, when they get it right, really take advantage of their opportunities.
Yeah, that's sort of their wheelhouse, right? It's like they're not first to the party, but they will tend to duplicate the success and then, you know, take the party elsewhere. And they've done a good job at that. I know that they've been criticized for their lack of AI innovation, but I do tend to trust that Apple could have some exciting things coming, and maybe that's the Apple loyalist in me, because I am deep into the ecosystem, unfortunately so. But our next thing today is Palantir, and this has been a really interesting one because there's a lot of varying opinions. I will say if you were taking a stance against Palantir this year, you would have been just blatantly incorrect based on the stock's outperformance. I mean, this name has risen now 137% this year, and I mean, still pulled back on 12% from its recent highs, which we haven't seen since its last earnings report back in early November. So, of all today, we love to talk about this stock because it tends to always have news, and a huge part of that has been some of their development with government contracts and this massive defense spend that has gone hugely in Palantir's favor. But so I'm saying with the company now making these strategic moves to remain at the forefront of AI, they believe that Palantir has a golden path to become a $1 trillion market cap company. Palantir has been the best performing of his list of top picks with, again, an 143% gain this year. So Alex Carr, you have to commend them. This was a one-time coin to meme stock, and it is so far distanced itself from that with signs of, I mean, again, major contracts, major push into AI. Fear, though, is its valuation.
Yeah, I think there was like a Venn diagram of like the same kind of, you know, Wall Street bettors that were interested in Palantir and the meme stocks, but it was always different because it was future technology, it was potential, where it might have been expensive, there might have been short squeeze aspects, but like GameStop and AMC were revolutionizing, you know, how we digest data or consume things and AI and all that stuff. So, yeah, I think that there was like a blending of those, but it's hard to ever have said it was like a meme stock in the sense of what AMC and GME were. But 230 price target for Mr. Ives would rank, you know, in the top 3 or so. I see it 235, but for the most part, 230 is way up there. And he's been a believer all along this journey, so you got to tip your cap where it's due, and definitely one of the best performing stocks of not only his bunch, but really of his coverage, because he's been a bull this whole run.
He has, and I will say his call on Palantir was also early. I mean, it was well before we saw a lot of this, I mean, really phenomenal price activity. Palantir has been definitely, I think, a surprise to those that were critical of its valuation. I mean, it's been nothing but an outperformer this year. Have been some pullbacks, hasn't been a straight shot to the upside, and we're obviously lower today, but still a really strong player in the AI space. Now, the last name today is CrowdStrike. And now CrowdStrike could write a masterclass truly on the recovery of your public perception after that mass outage. I mean, it cost them billions. They also then continued to mention the added costs on every earnings call since, really saying that, yes, to really retain a lot of these major enterprise accounts, we had to shell out good amounts of money. We had to make right with some of these customers, which I think has been to their own success, frankly. Now, Dan Ives saying that they believe that increased market and mind share is happening right now for CrowdStrike among new and existing customers as the company's product suite continues to really expand across enterprise landscapes over the next 12 to 18 months. So did point out shares gained almost 40% this year. And in the broader cybersecurity space, I mean, it's becoming more and more, it used to be so fragmented, like we've seen this trend of platformization where we're seeing consolidation companies want to become the one-stop shop for security offerings. I will say that Palo Alto Networks, CrowdStrike are really leading that charge as far as their recent deals, platform expansion, and I mean, like CrowdStrike, for example, their Falcon Flex renewals are up 50% with this platform expansion, to speak to some of the optimism that Ives didn't point out.
He's been a believer in this company through and through as well. It's been a nice performer this year. $600 price target for Wedbush on CrowdStrike, which has a lot of upside. I mean, we're talking, you know, over 25% of upside. So if it were to do that again, you do have to start asking the question, in some sort of way, despite all the outlaid costs and potential lost business, did they actually gain more in brand power through that negative story and all the things that happened?
Another good question.
Is CrowdStrike more known because of that? Maybe. And all, I mean, objectively, I think yes, because of the impact, but also the fact that some of these companies didn't flee and didn't replace it, I think showed the difficulty in that. It's not as simple as just unplugging from CrowdStrike and plugging into one of the competitors. You start building the architecture around these services. We use the word resiliency a lot. I don't know that there's that. It's almost like there's a loyalty to these brands, not because you like them, but because you built your stuff with them in mind.
Monopoly.
For better or for worse.
And that's the thing about locking in these major enterprise accounts is typically companies don't see a massive turnover with some of these contracts that are like years long. So there is an element of stability there. And I mean, hey, I always said if you're a believer in AI, you have to be a believer in cybersecurity because we're going to see, I think, further spend into boosting these security offerings to be then compatible with the advancements in AI that we're very much seeing rapidly transform. I mean, just like the internet across the board. So this is definitely a story to watch.
Well, and real quick, this is more philosophical. I don't know there's an answer on this, but can you be a leader in cybersecurity in an AI world if you're not a leading AI company? Like, isn't the AI, if it gets there and is working on that project, going to get further than any human-based research is going to get? So you start wondering, like, who's going to emerge as these winners, and is it the same names that we're looking at right now? I don't know.
I don't know either, because frankly, like as far as say 5 years ago, NVIDIA was not the dominant force that it is now. So it's possible to see that rotation at all times. I mean, no one has ever saved from their dominance of various markets, and then of course AI has been no exception. We've seen the very much winning part of AI this year and very much losing, but all these names have been solid performers, some of course better than others like Palantir, CrowdStrike, and all the concern with these names is frankly these elevated now valuations. But we'll leave it there for the top of our show today. A really great note on all things really just Dan Ives and some of his top picks now into 2026. But coming up next, we will dive into the charts. We'll be looking at the technicals and some example trades in two of our big box retail names. One a bit more winner than the other. Target has been a bit of a loser this year, while Walmart continues to be a stable performer in this market.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest in trade on your own.
Anyone they can even manage it for you.
Not to mention Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for the chart master. And joining us, of course, is our chart master himself, Rick Ducat, to help us look at two names in the big box world. And I know we compare them very often. They have shown us really the true nature of how different these business models have become. Those, of course, being Target versus Walmart. And so we will start off with the lesser of the two, being Target, based on performance activity. But this name, I will say, as far as retail is concerned, it hasn't been, I mean, the bloodbath that sometimes I think the headlines make it seem like. And I know we're in our second year of this underperformance, but just walk us through your thoughts on the technical picture, because right now, I've looked at so many retailers over the last year. It wasn't so bad for Target.
Yeah, really, I think more sideways than anything else, really. I mean, we did have a decline initially, but if you were to backtrack and start looking all the way back here in April or so, pretty much since then we've had a fairly consistent floor at our green line here near 87. We had some lows around that area here and here once again after earnings, but quickly we righted the ship in terms of closing prices. We mostly stayed above that level, but also you could say perhaps more like 110 was the absolute high of the range here. We also had a notable gap, 99 to 105 or so, right about here. So that was another area that really stands out as potential resistance. We've gotten stuck repeatedly at this 99 level. Once again, this is where the bulls have hit something of a stumbling block here. So to the downside in the shorter term, our recent low point comes in here near 94. We are still within the boundaries of this upward sloping channel type shape. For now, that began with our 52-week lows at 83.44. Now, if we look at our moving averages, we can see that our moving averages are clustered together here, 93 to about 98 or so. That's where our weekly, monthly, and quarterly moving averages converge here around that general area. We have our yearly 251 EMA near about 104 to the upside as well. RSI compressing in a triangular shape here. You can see we've got some bearish divergence that has developed here where price made a very marginally higher close, but RSI actually trended downward rather notably. So we are still above that 50 midline, signifying that things are a bit more toward the bullish side, but beware of a crossover below that level and any potential trend shift. Finally, when we look at our volume profile study, our point of control comes in right about here near 97. That's our heavy trading area. The only real other notable volume area is up here near 105. So that seems like another noteworthy area to the upside that matches up with the bulk of our trading from when we were at the highs from our range previously.
Yeah, and I will say that this name, seeing some loss, we could stay around about 0.7%, but I agree. A better assessment, I think, is range bound. Of course, perhaps not the range the bulls were hoping for, but better than, I mean, seeing further deterioration of the trends. That's been at least encouraging. Now, though, as we think through trading Target here for example purposes, as far as, I mean, guessing what 2026 will bring, who knows, but say leaning into perhaps some more continuation of this trend.
Yeah, and say you're waiting for more to really be all in or bullish on the stock like this, and you want to see something, you want to wait, but you want to have that lean, neutral bullish strategy, short put vertical, collecting a credit, going out to the February 20th expiration. That's the monthly cycle in February. So you got about 1.5 months till that date. Looking to sell the 95.90 put vertical for $1.75 credit. That would be close to a third the width of the strikes here, Jenny, so it creates a little bit better than 2-to-1 risk reward. As you see there, the 325 max loss, 175 is the max profit, with the 93.25 break even. So you get a little bit of a cushion to the downside. The stock does falter here, but if it just stays where it is, goes higher, goes sideways, etc., over the next month and a half, chance to make $175 on that 325 in risk. So neutral to bullish strategy, elongated Z risk profile here, Jenny, one that we'll look at a couple more times throughout the show.
And hey, maybe that should have just benefited from the surge in spending we saw as a result of the holiday season. So we'll have to see how that plays out into, of course, their next quarterly report. But now to look at Walmart, and I think that we're seeing such a distinct, really trend emerge from this year, and that's seeking value. Consumers not necessarily spending less, but just reallocating some of that money to say these names where they feel like they're getting a better deal. And so Walmart's really benefited from that hugely. I will say though, in typical Walmart performance, it hasn't been a huge winner, but hey, a 20% plus gain this year does feel like a win in retail.
Yes, especially when you consider that Walmart is really part of that consumer staples group here, so a more defensive sector to begin with. When we look at our price activity, though, we can see that for much of the past year, we fit within these two boundaries of our blue lines. We did have a notable upside breakout here, as well as after earnings where we hit our new highs. Interestingly, too, we have held on to our old supportive area here, so we can see our old trend line that was once resistance after the decline. We held on to that point pretty closely there. We did not even actually test these old highs here near 109. So a sign of perhaps strength here from the bullish crowd from this retail name. When we look at our horizontal levels here, 100 and 105 and about 109 stand out. 100 back here because of a gap. 105 back here because it was our best close, and then you can see many times they've been support and resistance respectively here going forward. So this would be a very important supportive range to consider as well if we do start to break back below that 110 level. When we look at our moving averages, our shorter term ones, our weekly and monthly EMAs come in right around 112. That lines up with our short term downward sloping trend line. So this could be a potential breakout area. It's like the point where you might get that tipping point where many sets of potential resistance are lining up. So there's more eyes watching that point for a breakout here, and it triggers the cascade of orders. So that's what you could be looking for here. RSI was trending lower. We are still above the 50 midline, but marginally now we'll look for some further directional clues, one way or the other, from this momentum indicator. Finally,
up, down, up, down, up, down, up, down, up, down.
The heavy volume area.
Higher high, lower high.
Here. But we also have this area right here near about 107, 108, where things start to pick up again. Then 102, this area right here is the next very notable point to the downside.
That's correct.
Also with some modest pressure today, but again, a stable name, and we've seen that defensive nature, which has not played out in a lot of the other staples. So
That is correct.
Watch that resiliency theme throughout this year, but appreciate it.
Listen to her.
For that technical help, and now as we do think through trading Walmart here
Woo!
for purposes, again, speaking to its resiliency, walk us through your thoughts.
Yeah, this is a consumer staple name, but has AI sort of, exposure in terms of efficiencies and technology investments that it's made. So has also barbell-like performance. That's
good.
Probably a similar strategy going after that February expiration, looking at selling a put vertical once again. In this case, though, 110, 105, looking to collect $1.50. So in the last trade was closer to a third the width of the strikes. This one more in line with that 30 cents on the dollar.
These people get me.
What you'll see is how that subtly makes a change to that risk-reward relationship. Where before it was closer to 2 to 1, where it was favoring the reward, this is closer to 2 to 1 but favoring the risk in the sense of where that relationship is. Risk 350, chance to make 150, break even is at 108.50. Same general shape here, Jenny, it's just where this break even falls, it's a little bit closer towards a little bit closer towards that strike, and you have a little bit more risk below. So does cap out below 105, and that's limited to 350.
Yeah, and a neutral, of course, the bullish strategy here in Walmart, as well as Target, leaning into perhaps more continuation of the recent trends we've seen. So Walmart, I know it's pulled back about 4.5% from highs, but still has looked pretty strong throughout this year. We'll leave it there, though, for Chartmaster today. Coming up next,
They're
and
now at
talk one of our winners
$2.60.
of the next 7 today, and that is Meta Platforms, with a $2 billion acquisition of Manus. The shares are up now, modestly, but still outperforming the market today, up about 1.2%.
Magnus. Well, Madness. We have a new high on SPX.
Me on X at NPedalides.
I'm with you, baby.
Connect with me, Nicole Pedalides, on LinkedIn, Facebook, and Instagram.
Trading Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this
We
is
just had a breakout. Yay, yay.
We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Sure.
No.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. We really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey.
You're disgusting.
The two grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time for FOMO, and we are discussing one of our best performing Mag 7 stocks of the session today, although modestly, but still at least leading out in front, and that is Meta Platforms with its $2 billion acquisition of Manus. So here now to tell us more about this acquisition and some further consolidation trends we're seeing in the broader tech world is Sam Bottas, of course, host for the Schwab Network. So Sam, walk us through this news. I know that we're not making a huge move to the upside, but at least higher today, and that's the win.
Yeah, exactly. You're right, Jenny. I mean, the stock is getting rewarded today off the back of this announcement. I think, a lot of people woke up stateside today thinking, who on earth is Manus? Because unless you were probably out in Asia and you were familiar with the scene, you didn't know much about this company. That's certainly what I'm getting from a lot of the guests that I've been speaking to, as to, the fact that this wasn't really a known household name. It was founded in China. It's now based in Singapore. There's been a lot of conversations around why it actually chose to do that. I won't get into it, but it did make headlines in March as to whether this would be China's sort of second DeepSeek moment. And in fact, I saw that TechCrunch had a headline at that time talking about how this had been generating more hype than a Taylor Swift concert. So I'll leave that one there as well. But what we do know about this, as far as some of the reports are concerned, $125 million in annualized revenue to December, more than 20% growth month on month. Now, what does Manus have to say about this? Well, according to its blog, it's validation of its work with AI agents. So basically, what it does, and I'll read it from the press release, is it helps users tackle research, automation, and complex tasks. They've been working hard to make these capabilities more reliable, they say, and useful across a growing range of real-world use cases. They just say that in a few months, their agent has actually processed more than 147 trillion tokens and powered the creation of over 80 million virtual computers. So if you're in the know with this, then obviously you would understand, what that means as far as the grand scheme of things, where it sort of fits in the picture. But as far as what Meta's saying about this, it's saying it's basically bringing a leading agent to billions of people to unlock opportunities for its businesses across its own products. And this is really what some of the analysts have been getting at. Rosenblatt, for instance, are talking about how this is a rocket ship growing SMB-focused agentic AI. Maybe this will help as far as WhatsApp is concerned, as far as small business footprint as well. It's also been talking about how they plan to scale this service to many more businesses, and also that it's exceptional talent, that is Manus's, will join Meta's team to deliver its services now. The Wall Street Journal originally reported on this, and I think there were some really interesting lines that are worth highlighting here. I mean, particularly around the valuation, because there's not been a lot of price tags being thrown around, at least from the two companies, but they're talking about how the deal is closing at more than $2 billion. Now, there's been a lot of focus on that figure today. Some saying that it's not a huge amount of money in the grand scheme of things, but of course the story with Meta is this AI journey has been very expensive, and investors really want to see the return on the ROI, or people have been calling it the ROAI, return on AI, and that's really been, the story for Meta all year, particularly given the capex indigestion as we've been talking about since the latest report card that we got. There has been some margin concern at Meta, and that's because there's this view out there that,
companies like Google, Microsoft have better spending discipline, they have better AI partnerships, even Amazon could be considered in that camp as well. And so this company very much needs to prove itself. And Zuckerberg, I've seen reports, spending about $13 billion this year on hiring. We've covered that extensively. I think it's interesting the fact that the Wall Street Journal also points out that, this is one of the highest profile examples of a US tech company buying an AI product developed in Asia's AI ecosystem. And that's been some of the conversations I've seen out from some of the Asian banks as well this morning, that there's a view in the market that this actually could be very good as far as validation for some of these AI tech stocks over in Asia. In fact, we did see some nice rallies in some of the tech stocks over in Hong Kong overnight, and also importantly with regards to AI valuations in Asia, which are seen as sort of inexpensive relative to US peers. The other thing that I think is really interesting is the fact that Manus uses AI models developed by companies such as Anthropic and also China's Alibaba. And so there is a bit of a Chinese, relationship to this company, obviously having been founded in China, so it has very much those ties. And I was actually speaking to Ed Ptaszki about this earlier. He says that while this is a brilliant and very smart move by Meta, the ties to China could be scrutinized down the road by the US government. So this is something obviously to keep an eye on as well. Not to mention this avocado that Meta is coming up with, obviously the AI tool, not actually an avocado, is also being trained on Qwen, which is Alibaba's LLM model. So there is certainly some Chinese ties with Meta now, and that could be under scrutiny down the road, as I say. But Ed Ptaszki was also pointing out that he's impressed by this because of the fact that they're taking money away, hopefully from the metaverse, which he called a ridiculous experiment, and moving money into AI is definitely the future. So obviously, as I said, this is really the story with Meta right now, that they have just been throwing a huge amount of money at artificial intelligence, and basically, it is getting rewarded today, which is very encouraging, but obviously the next installment of all of this, guys, is going to be show me proof of all this spend. Particularly with the eye-watering, eye-popping sums that they've been throwing at some of these people that they've plucked from other companies to bring on to their team as well, to really build up their super intelligence and their AI capabilities.
Yeah, I totally agree. I think the next leg of the story is going to be then showing the way it's monetizable. Frankly, I think that's the huge question right now for a lot of these big tech names, not just Meta, but they are the front runner of a lot of this spend, and frankly, the talent search, which has been pretty transparent from Zuckerberg this year. But I appreciate that really great insight on what we're seeing in Meta today, and I think great points about the fact that this is an overseas company, so perhaps never heard of it before today. Sam Bottas, of course, host of the Schwab Network. But now, as we do think through trading Meta here, Alex, and I don't think that this changes the narrative. I think it just further boosts the overall conversation that, yes, Meta has cash right now it's willing to spend to build into AI.
Yeah, don't look now, too. I mean, it's jostling between, but 666 the last trade. So ominous print out there for market bulls. But no, jokes aside, same strategy, Jenny, but a couple key differences. One is pulling that expiration date to the middle of January. These tech names tend to have an earlier in the earnings season reporting date, and so just to make sure that a trade established today, for example purposes, would be ahead of that event date, we went to the middle of January monthly cycle. That's January 16th in 2026, so just a couple weeks from now. Looking at the 650, 645 short put vertical, so same strategy again, a little bit of an accelerated timeline, but what you'll notice is $1.25 credit, so less than the $1.75 collected on Target, less than the $1.50 looking to collect on Walmart. In this case, $1.25 would create a 3-to-1 risk reward, risking $3.75, chance to make $125, and then that break even would be $648.75. So a little bit shorter time frame, but also a little bit worse risk reward. So this goes to show it can be the same strategy. We looked at 3 different stocks. Same strategy, but some trade-offs and how subtle adjustments change that risk reward and also influence the potential probability of success.
Yeah, and I will say that I know Meta has pulled back from its highs, but at least right now, as far as analyst and conditional statement, still remains very strong as we approach, of course, 2026. We'll leave it there for FOMO though today. Coming up next, I'm going to talk another name in the Mag 7, and of course the sort of most important name of the Mag 7 I'd call it, and that's NVIDIA. As we're seeing all of this scrutiny, all of these thoughts following some of that announcement last week with Grok. So we'll discuss more of the broader tech outlook, get into 2026 coming up next.
Flat on the red side. We're flat. The market's flat. It's not oversold, so it just might hold here. Dip for more.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out there.
It's okay.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Well, shoot.
Welcome back to Next Gen Investing. It's now time to talk some broader themes in tech, as well as, of course, all the headlines that have emerged from NVIDIA with, of course, that deal with Grok. Joining us now for some more insight on that story is Hatem Diab, managing partner of Gerber Kawasaki Wealth and Investment Management. So, Hatem, we always appreciate your time and, of course, joining us on Next Gen Investing. And let's start with the headline. NVIDIA buys Grok, and that it's not a traditional acquisition. And I'm curious your thoughts on what makes this different, why perhaps that didn't resonate so well with the street, at least based on yesterday, some of the pressure we saw on NVIDIA.
Hey, Jenny, good to be on, and yeah, it's good to see you. Yeah, the headline is, NVIDIA buys the competitor, right? But the reality, this is the new playbook for big tech, which is it's an acqui-hire type of transaction where you license the technology, you get the IP, you do a non-exclusive agreement with them, so you can say that's an exclusive purchase, and then you get the talent to work for NVIDIA. So we've seen Meta do it with Google did it with Character.ai. We've seen Meta do it with Alexander Wang. So there's a lot of people doing this, and NVIDIA actually, lost the ARM deal last year in the UK because of multi-competitive pressures. So they don't want to do that mistake again.
And the reason that I'm guessing, Hatem, is that they would probably have had some pushback as they have in the past. ARM comes to mind with a potential acquisition here, so they can say, hey, no, we didn't buy the company, we did this other thing, and look, it's a totally different thing. Is that the idea?
100%. I mean, it's an easy alibi to have with like, hey, listen, yeah, they had a competitor, but we actually did not buy them. We just licensed the technology. And the anti-competitive pressures, as you mentioned, are not just here in the States; they're also in China, in Europe. So doing a deal like this really allows them to kind of circumvent that.
Okay, so we do know that we're seeing Jonathan Ross, who's of course Grok's founder, now come into the ring, and he has some pretty major credentials as far as chip design. But how significant is that for NVIDIA to now compete with, say, the likes of like Alphabet, I know, for some of these various TPU offerings?
very significant, right? He was actually one of the lead engineers at Google developing the GPU, so he's got extremely amazing credentials around neural networks and ASICs, custom ASICs, especially in inference per se. So I think it's a big win for NVIDIA to have him under the umbrella. And I think also, there was a narrative out there in the street that NVIDIA was behind in inference, and having Grok's team within NVIDIA and bringing the technology that Grok developed in inference, which is faster and cheaper, allows for NVIDIA to kind of change that narrative.
Okay, so this will kind of tie into, I know you have a statement in your notes that calls inference that next big battleground. But in a way, does this validate the projects that we've been hearing about coming out of Alphabet, that NVIDIA was willing to make such a big move to kind of shore up a gap?
I mean, yes, I think Alphabet has really done a great job this year, really defying all the skeptics and coming up with Gemini, which is really crushing it, and really building it within their own products. I think what happened with NVIDIA is, they were seen as, they're definitely the biggest players in training, right? They have the best GPUs, they have everything, but with inference, they're just not there. And I think this purchase really changes that narrative for them, and I think going forward, NVIDIA, which is currently does almost 90% of its revenue from selling GPUs, will also have more software to offer to help with running these AI processes. Because as you said, the next frontier is the cost per token, are agents working, what's the ROI, or as your previous guest said, ROAI.
Okay, so as far as now looking ahead to 2026, I mean, where does NVIDIA stand as perhaps one of your favorite stocks or top picks, or how do you see it playing out in a more difficult to compete in environment, but also just after several years of such growth, I feel like it's going to be very difficult to maintain this consistency as far as the hyper growth expectations?
They're great.
Well, I think we know for the next 2 years, right, they have almost $300 million in sales already booked. And I think all the announcements over the last year or so for all the data centers are going towards the GPU build out or the data center build out, which will require NVIDIA GPUs, right? So I'm not really worried about NVIDIA's prospects for the next 2 or 3 years. And obviously, if they keep making acquisitions like this, or at least with this acquisition, they almost reinforcing their offering, right? But I think more importantly, this kind of goes back to the Grok purchase, right? Grok wasn't doing as great. Like, they had to cut their revenues for the year, because the reality is, if you're building $5 or $10 billion data centers, you want to go with the biggest player. You want to go with the player that actually is going to be there and provide the full stack. And NVIDIA is doing that right now because of CUDA, their software. Now with the purchase of Grok, they're going to more inference. So you're seeing that I think NVIDIA will continue to be the nervous system of AI going
Totally
forward.
wrong.
And it's currently trading at a 0.7 PAT ratio. So actually they're cheaper than their growth rate, which is, for me, it's a great place to be.
As someone who's looking at investments professionally and managing money, my question for you in 2026 and beyond, given you have companies like NVIDIA and Meta and plenty of others just buying companies 2, 3, 4, 5 billion, 20 billion, on a daily basis, how small are you willing to go when looking for sort of those under the radar growth opportunities? Do we know most of the players in this space from an investment standpoint by name already?
I don't think so. I think there's going to be a lot of exciting new names coming in, especially on the application layer, right? When you think about agentic, when you think about new use cases for AI, right? The big names, the Googles, the NVIDIA, the Amazons, will continue to win, right? And I think that's really the bifurcation is both can win, right? You can own the big names, and those will continue to grow because we need to do all this build out, but also going to be a lot of new exciting ideas or businesses created on these layers, on the NVIDIAs, on the Googles, and those would be the exciting opportunities going into 2026 and beyond, really.
And I always say that's the best part about a year resetting is finding some of these new winners. And perhaps we're wrong, we'll all make our best picks, but I do think that a year reset does give good opportunity to reassess some of the AI and tech trade. But we so appreciate it. Thank you so much for coming on and having a wonderful new year. Hatem Diab, managing partner at Gerber Kawasaki Wealth and Investment Management. Now coming up next, it's time for Under 30. We're discussing Applied Digital. With some news today, it will be spinning out its cloud business, and we're seeing some mixed price activity as a result.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the CBOE, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day, 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Pedalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for Under 30, and today we are talking Applied Digital, which first and foremost, what a year it has been for Applied Digital, but also with some news today, it's spinning out its cloud business and also some analyst coverage. So here now for some more insight is George Tillis, Senior Markets Correspondent on the network. And George, we discussed this name earlier, so to really recap it, what we're seeing as far as price performance, I believe now it's a bit lower than where we talked about things earlier, but as far as some of this news and its broader push, I mean, we've seen some interesting consolidation emerge from tech as of late.
Yeah, I think that's what we're probably going to be expecting a lot of this coming up. Just basically how the market has been developing across the entire AI ecosystem. You're seeing a lot of deals being made. You know, obviously there's a huge deal with Oracle and OpenAI. We saw SoftBank essentially, you know, taking a lot of stakes and deals in OpenAI. So it's going to be a natural progression. We're starting to see some of these developing names, companies like Applied Digital, which, you know, for all intents and purposes has been an exceptional performer over the last 5 years. If you look at this last year, it's up over 200%. And essentially, there's going to be deals being made with smaller companies. And in fact, today, it looks like they're spinning off their cloud business in lieu of, in Canada with another company. They actually used a company called Bionics, which essentially is a healthcare equipment company. They're using them essentially as a host to spin off their cloud business into a separate company, which is going to be called Chronoscale. And Applied Digital will be owning approximately 97% of this new spin-off company. And this is essentially one way to improve the scalability, unlock some value across its core infrastructure, which includes high-performance computing, alongside its traditional business, which includes Bitcoin mining. The deal actually was quite accretive for Exo shareholders because the stock right now is trading up about $5, up 94%. It's coming off the highs from today. And I think the reason being is that this company, Exo, was a much smaller name. Based on yesterday's close, around $18 million in market capitalization. It's very small. And in a market like this,
Okay. Yes. Power Hour. Voice. George.
It didn't seem to worry investor pretty much throughout today's session. I know now we're slightly lower, but all that to be said, I mean, you see some of these delivery numbers that were expecting another year of annual declines for their again, just yearly deliveries. Street doesn't seem to pay much regard to that as far as all of these analyst notes, which have felt very much skewing to the optimist side.
Yep, so Baird and one of the Ives 5. That's a fun little kind of alliteration, I guess you would say, for that. But Tesla, nice year all in all, although it took a little bit for it to get back, you know, in terms of where it started. Let's talk SoftBank. This wasn't new news, but it's done now. In these massive money deals, there's especially with Oracle, which is kind of tied to this in a way through the Stargate stuff. Just shakiness around how rock solid is some of this financing. Well, seems like the news is SoftBank $40 billion investment into OpenAI. Well, hey, that money's moved now. It's complete. Financing secured and sent over.
It is. So $40 billion investment from SoftBank to OpenAI. I think what's so amazing is like it's worded. They're like, you know, the company just sent over the final $22.5 billion. I mean, I would love to even know how that process works. And it's just so mind-boggling. I mean, yeah, and it's just such a huge. I mean, that's companies like we're talking GDP. I mean, at that point, they're huge. These are huge numbers, but according to, again, reports we saw first reported by CNBC, that SoftBank had previously invested roughly $8 billion in OpenAI and had syndicated another $10 billion with co-investors.
Anybody hear me?
The investment does take their stake to just above 10%. And so back in February, we saw reports they were finalizing that $40 billion investment.
Go.
Billion pre-money valuation, but the funding was expected to be paid out over 12 to 24 months. So some money was slated to OpenAI's AI infrastructure, as well as the Stargate venture with, of course, Oracle and SoftBank. Well, companies, of course, have been funding pretty substantially in the recent months. I do think that what's huge is the conclusion of this financing, and just being able to put this to rest, as I do think OpenAI, and again, not publicly,
oh, they can hear.
Will be more and more a really front runner of the AI conversation into the new year.
Yeah, I think this explains now, which we knew, but look, there was a plan behind those SoftBank liquidations that we were reading about not that long ago. They need to raise money for other things. We talked about that Digital Bridge acquisition.
Yes, we did.
Now we have this huge sum of money moving over to OpenAI as part of this deal that they had already inked. Money doesn't grow on trees, and OpenAI or SoftBank had to find the money from some of those other sources. Last thing though, this one's there's not a ton new here, but this Warner Brothers saga. This is going to be like the next thing on Netflix, like how this played out, because it's back and forth. You think it's over, and then it just keeps coming back.
It does, and I like the way it's become, sort of petty at the level of the back and forth commentary, but Warner Brothers Discovery is now expected to reject Paramount's guidance's latest offer to buy the company's assets. That was reported first by CNBC, but Paramount had, of course, amended that $30 per share offer to include the personal guarantee for equity financing of more than $40 billion from Oracle's founder Larry Ellison, as well as a higher termination fee, among other things. So now the David Ellison-led media company wants to buy Warner Brothers for more than around $108 billion, including its debt. Now, Netflix is still currently seen as the front runner of the overall bidding war, with a $72 billion deal excluding debt. But we have also seen Warner Brothers, has been on a pretty nice run over the last year or so, but the stock's now trading more like a deal arbitrage play, with investors, I think, trying to price the odds of what these rival bids look like and what the timing of this looks like as far as like forward-looking expectations. So in the deal calendar, the next hard date to keep on your radar is right now, January 21st. Reuters reported that the extended deadline for this deal. Any further changes though to the terms or new regulatory signals could likely show up, and again, this is expected to take roughly 12 to 18 months. Don't expect the saga to be over anytime soon, but the news update I just saw was that they're rejecting this offer and expecting to see some of this come out next week. But again, not confirmed by either company, so we'll continue to watch the latest drama between the three.
Yeah, this was Bloomberg's Lucas Shaw, who echoed earlier reporting from CNBC's David Faber, suggesting that this latest attempt from Paramount was going to be rejected, but according to the Bloomberg report, the Warner Brothers board has not made a final determination just yet, but will meet next week. So maybe, just maybe, we'll be closer to the final saga in this never-ending attempt to take over Warner Brothers sometime next week.
I hope so.
Jenny, always appreciated. Good stuff. We send it back to New York and St. Boniface.
Thanks so much for that, Alex. And Jenny, well, coming up, we will get the S&P 500 targets for 2026 and discuss where the Fed policy could go when a new Fed chair takes over. Market on Close. We'll be right back.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets, with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Pose. I'm Sam Barnes alongside Alex Coffey. Let's welcome in our next guest. Very pleased to say we are joined by Jay Hatfield, CEO and CIO at Infrastructure Capital Advisors. Hello to you, Jay. Thanks so much for joining us. Look, we got the big event of the week, which was the FOMC minutes, but it didn't move markets. In fact, we did see the odds of January falling by 15%, the odds of March rising about 40%. According to the Fed Watch large language model, the sentiment was a mildly dovish tilt. What did you make of it?
Thanks, Sam, and it's great to be on. Well, we continue to think that the Fed is going to be cautious until they get better inflation data, and that probably holds with the next chair. But we are forecasting 3 rate cuts next year because we are extremely optimistic about inflation. We think everybody ignored the fact that shelter inflation finally rolled down to just 0.1 on average over the last 2 months. That's critical. We publish our own CPI and PCE using real-time data for shelter. Those are already below 2. So all we need is that for that shelter to correct next year. We'll get to 2, and we believe we'll get 3 rate cuts, and we'll be at the 275 to 3, and that should set us up for a great year in the stock market.
Jay, what are your thoughts on something that I've been kind of saying and exploring in my mind over the last couple months, where the Fed seems to have moved to a point now, and you could argue that it's been there for a little while, where it's no longer really in the way necessarily, but it's sort of on this quarterly
nice little bounce back.
Rate cuts, sort of the adjustments, and things keep going well.
I sat there and kind of watched it.
Would potentially step in if things started to falter. If that's true, which you may, of course, have some differing thoughts, is the story in 2026 really about the Fed?
Spy back to the VWAP.
I think it is. Year-over-year growth and investment. And by the way, recessions are only created by declines in investment, not by consumption. So you got to be laser focused on investment. So we do think there'll be some recovery at these lower 10-year rates, but we really would be much better off with the 10-year below 4, which requires a 275 on the Fed funds. So I wouldn't ignore the Fed, and we do think it's critical to get at least to get to our target next year of 8,000, which is a pretty aggressive target. That's 23 times 27 earnings.
Yeah, I mean, how much of that is going to be driven by the Fed and everything else going on? I mean, particularly when it comes to earnings, particularly with regards to the whole AI narrative.
Well, absolutely. That's part of our bull case is that you're seeing really strong earnings growth, not just from the AI companies. But you were talking about these agents, like there's a lot of productivity happening. We use AI agents when we do our research on stocks. So there's a big productivity increase that's showing up in this 13% year-over-year earnings growth. Because we're not projecting, we have a 7,000 target, have one all year on the S&P. That's 23 times. We're only projecting that we hold that multiple, but we do get that earnings growth. But we have to have it coming from AI, not just with the pure AI companies, but we need to see some pretty good productivity from the old economy as well.
All right, so people who are listening along, Jay, they hear, hey, his target coming into the year was 7,000. We're close enough to that to say you were pretty spot on. And in my mind, Jay, you said 8,000 2020.
rises, housing and construction continue to cushion, we get sluggish growth. That could stall us below the target, but we still think we'll get most of that earnings growth, and most of it comes from reinvestment. So it wouldn't be the end of the world. So it's a really low risk environment, but we're confident we will get to the 8,000.
Jay, I know this is a really tough question, but as we look ahead, the first half of this year was such a tariff and policy out of Washington-driven market story. What's your thought on what the story might be in the first half of next year? Are we still talking tariffs and inflation, or we left that earlier this year?
Well, we don't think we'll be as focused on tariffs because that policy has been narrowed, that bandwidth has been narrowed, so we pretty much understand what's going on with that, except for China. And so we do think the critical driver is going to be inflation. We can't have huge inflation prints, that's going to be negative. So I would stick to this ongoing decline in inflation, which would then set us up for really a 3 to 5 year bull market, because really recessions are only created by the Fed, and the Fed only tightens when inflation is rising significantly. So I would say stick to the inflation reports. We're super optimistic about it, but they do get mismeasured, so the actual reporting is critical.
Jay, we appreciate it as always. Thanks for helping us out today and joining us on the program. Happy New Year to you. We'll see you in 2026. Jay Hatfield there, Infrastructure Capital Advisors. Coming up next, we will turn our attention to ETFs as flows hit a record high in 2025. Can we see a repeat performance next year? We'll discuss that coming up next on Market on Close.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall, on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Coffee alongside Sam Voss. It's now my pleasure to welcome in our next guest. That's Garrett Stevens, the CEO of Exchange Traded Concepts, to talk about a pretty important topic within financial markets, which is the ever-changing nature of these exchange-traded products. Garrett, thanks for joining us here on this Tuesday. So we close up 2025. Why don't you help us look back at 2025 for a second and all the things that really started to catch fire this year with the leverage stuff within single stocks. I mean, we have derivatives within some of these ETF products now. Talk to us some of those big changes.
Yeah, good afternoon. Thanks for having me. It was a busy year in the ETF world out there. We had
kind of this explosion of these single name ETFs, leveraged single name products out there. Active ETFs, were one of the big stories of the year. Something like 84% of the 1,100 ETFs launched this year were considered active ETFs. But they active funds still only make up about 10% of the overall ETF world out there. So, lots of room to run there going into next year, but certainly made a big impact starting this year.
Garrett, is what we saw this year likely to just continue into 2026, or does it sort of need something else, or does it morph into another type of story?
I think you're going to see a continuation. It's really just in the early innings of these products sitting out there. We're seeing this trend of ETFs being launched, really specifically to be used by advisors and their clients. They may not be trying to raise assets in these ETFs from outside investors. They're launching a product based on exactly what they need for their client. Maybe they're seeding these new products with something called a 351 exchange to be able to make a more tax-friendly, tax-efficient vehicle out of something they're already doing. That trend really got started kind of in the second half of this year, and I think you're going to see a lot more of that going into next year.
Garrett, is there going to be a situation where we've oversaturated some of these products, where there's too many doing similar things, and it becomes a situation where all the liquidity finds itself in one or two of these? We're already seeing that.
Yeah, you're going to have some products that don't work, right? We don't necessarily need 3 or 4 of the same product out there. There's going to be some that launch and don't find their footing and end up having to close after a while. But I think the innovation isn't going to slow down. New ideas aren't slowing down. In our business, we have investors and advisors, asset managers, mutual fund companies from all over the world reach out to us about launching product, and the pace of that is absolutely increasing every single day. So, we continue to think that more products are going to come out, but obviously not all of them are going to be successful. But I think choice for the investors is always a good thing.
As far as some of the changes that we've seen in the industry, Garrett, particularly in the second half of the year, the last time you and I spoke, we were talking about these conversions from mutual funds to ETFs, saying that it was very busy. But then the new part, of course, being the share class relief there, firms not really able to do that. As you and I spoke a couple of months ago, you said that there's also the plumbing work that's needed. Where are we up to with respect to that?
Well, it's all still in process. The SEC continues to approve new definitive relief applications for the dual class structure from many mutual fund companies out there. You're going to see more and more of those continue to come through as the SEC works through the backlog of those filings that are out there. The pipes and plumbing product limit remains. It's going to be a little bit before the technology catches up to where the ideas are in the space, to be able to actually do those conversions and the various share classes, how you account for that. ETFs don't trade in fractions of a share the way mutual funds do. So that's one thing that's going to have to be worked out, but it's coming. Best guess is later in the second half of 26 is when we might see the first batch of these dual share class structures in the market.
All right, Garrett, so similar to what I think we've already asked, but maybe more directly, what's the next big story here? We know the recent development has been this pretty rapid expansion once the approval started to hit on single stock things, whether it was covered call strategies, leverage strategies, short strategies, endless opportunities. What's the next big innovation, or is the story the rapid proliferation of this and the adoption of it from the end client?
Well, you're going to see more nuances on that, right? So the ability to do single stock in these ETFs is, behind the scenes are all via swap contract. And so, you're able to take that infrastructure and use that for single name 2 or 3 stocks. You have 97 ETFs, for instance, that just hold those 7 stocks. So I think you're going to continue to see a lot more iteration of those. There will be covered calls written on many different sectors. You may see tighter themes, for instance, like 97, maybe there's technology or infrastructure or AI focused, but there are a very small number of securities that are actually in the funds to give investors kind of a more targeted exposure to something. I think that's, you're going to see a lot more of that, frankly. Like I said, it's really just getting started.
Yeah, it's something that you and I talked about also a couple of months ago was, just the education part. That's half the
not the battle, but part of the process, I suppose, of getting people on board with this, particularly as it's just undergone so much change and become very popular. I mean, how do you manage to sort of navigate, people out there who, want to get on board but don't really understand it, and then, obviously all these misconceptions out there about being a tax swindle, etc.
Yeah, it really is up to investors and their advisors to really think these products through. Not all of them are good for everybody, right? Some of these are specifically treated as trading vehicles, not necessarily long-term investment vehicles. The exposure that you're given is some of the daily products, for instance, is just daily. It doesn't compound to an annual type of return that an investor might think it is. So there's definitely an education component when they understand some of the kind of research in these products as they look to make investments into them. The tax piece of the ETF wrapper is certainly what it's most famous for, and it continues to obviously be a big benefit to investors and the market at large. You can keep more of what you make. You're not having to pay those taxes in every time you make a change inside of the ETF. There's no capital gains generated if all goes well. That's not going anywhere. That's an important piece of the ETF story, and has been since the beginning. And so, investors realizing that active asset managers being able to run their strategies inside the ETF wrapper and get those to the tax advantages is really going to explode the active ETF market coming in the next year.
Is this something, these products, these more tradable vehicles, or let's say these actively managed vehicles, particularly the ones with derivative overlays, are they being more widely adopted amongst professional investors, like advisors, or is this still dramatically more of a retail story?
No, they're definitely being adopted by advisors, institutional investors, in mass at this point. Advisors are using them to get certain exposures for their clients, to offer them, various thematic type ETFs, whether it's, environmental products, whether it's AI-focused products, whether it's defense-focused products, these larger geopolitical and global issues, being able to tap into those, thematic ETFs or an active manager who's picking the stocks in those various sectors. Doing it in an ETF wrapper is a great way to do it, and so advisors are really starting, to make sure that their clients have access to this, talk to them about them, educate them, and really continue to use it.
Garrett Stevens, CEO of Exchange Traded Concepts, we appreciate your time, and thanks for the update as we go into the new year. A lot of changes, a lot of things happening in the last couple of years within that exchange traded product world. We're taking a short break. When we get back, Rick Ducat's going to stop by as the lead market technician, takes us through options activity in Intel. You won't want to miss it. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risks. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, how it's going to impact markets. Watch live on Schwab Network at schwabnetwork.com.
Trading in Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time burning. Trade brilliantly with Schwab.
Welcome back. Time for Options Corner. I'm joined here in studio by Rick Ducat, the lead market technician for the Schwab Network. She's joined us here on the Market on Close. Rick, it's Options Corner. We'll get to that in a second. Intel, you can see this behind us, which we'll get to as well. And in many ways, this is one of the stocks of the year in my mind, but made some news this week as well. So let's get that out of the way. I'm going to go through some of these different tacticals and things.
Yeah, as you can see, Intel, quite the comeback here. Now outpacing not only the SMH semiconductor ETF here in red, 48.6%, but also just the broader tech sector up 24%. Intel, meanwhile, up almost 89%. But you can see as well that how it stacks up against some of these other chip makers. Micron, the storage space, is the strongest of all of them, but Intel is number 2 for the most part here, outpacing the likes of NVIDIA, Broadcom, AMD, etc. here. The news really it doesn't involve NVIDIA. Its rival here, NVIDIA completed its $5 billion purchase of Intel shares for $23.28 each. Shares are up in Intel about 45% since that deal recently. The plan is for the Intel CPU chips to be paired with NVIDIA AI accelerators in the NVIDIA AI server. So just seeming to be a continuation, greater intermingling among these big tech companies that we're seeing here. So the space gets increasingly interconnected and more confusing, I guess.
Yeah. Jensen channeling his inner Warren Buffett saw some value, I guess, in Intel. So quite the stock purchase. Big time trade for
SPY moving up a little bit.
Let's talk some specifics in terms of the technicals for Intel, because it's really been a second half of the year story. It was a lot of the same earlier on in the year.
Yeah, this is one of those moments where you see a very sharp divide in this point. It was the deal with NVIDIA, obviously, that was right here. So a huge gap to the upside. From there, when you do have a significant fundamental change, often that's where you start looking at a new trend. You kind of start redrawing the lines. In this case, the post-gap up lows, you can connect these lows here and here, extrapolate it, put it across the highs, it gives you this channel type shape. For now, it looks like perhaps we've bounced off of that supportive area. We can also see that the 36 level, our dark green line, a frequent supportive area, and then subsequently frequently a resistance area, has once again become supportive. So old support becomes new resistance, vice versa here. Below that 33, low point once more. So those are the downside areas that stand out. To the upside then, 41.53 was our old best close. We did push above that level, so that would be one area to consider to the upside further. Our moving averages, while our shorter ones are weekly, monthly, and quarterly, all quite close together here, between about a 36 to 38 or so. So that lines up pretty closely with our trend line. If we do start to break below that confluence, look for potential breakdown activity then to the downside here. But RSI, moving to the upside, on the verge of crossing above our 50 midline, downward sloping red trend line is broken, so perhaps the bulls will be thinking this is more of a supportive bounce that we're seeing before the next phase of the rally. Finally, when we look at our volume profile study, the heavy volume area that's most relevant to current price activity, right about where we are now, near 38, things drop off significantly. There's another small pocket here near about 30.
Yeah, well, it definitely looks like if you kind of take into account all of those factors, that this new range, who knows if it's going to continue higher, but it does feel like there's been price acceptance. You see that volume starting to build. You see a lot of these technical indicators like the moving averages start to be in more this level now. Definitely seems like you said, it's almost like you have to close the book on that previous regime of price and open a new one when it comes to that gap up on that big fundamental update. But options trading, I know it's not been the busiest of weeks when it comes to these individual stock trades. when it comes to the options, but I'm sure there's still something we can discern from what's going on underneath the surface.
Certainly, and that being said, the sizzle for Intel in particular, 2.3, so it is a relatively heavier day, 2.3 times the 5-day moving average of options volume for this particular name here. The call activity far outpacing the put activity of the 470,000 contracts traded, about 80% were calls today, so kind of interesting there. The most active volume date is our Friday expiration, and the most active open interest date is our monthly January 16th expiration. It's about 1.9 million contracts, so a substantial level of open interest there. It's about a third of the total open interest for this symbol. In terms of the top strikes for open interest in our January expiration, on the call side it's 60. On the put side, it's the 18 level, so quite far away, but the 35 strike was the closest to current price levels here. Looking for about a 8.8% expected move during that time.
Yeah, and some of the reasons why maybe some of those January ones seem so far is it's a very popular leap cycle as well. Who knows when some of those positions may have been established. But what really sticks out to me is you have sort of those one standard deviation ranges plotted out versus the time. You really see how the math in many ways supports some of these tactical resistance and support levels, targeting out to that February monthly, really close to the all-time highs, but also you can see this January range really kind of those recent moves as well. So it's fun to see how it all kind of comes together. Any big trades stand out?
Yeah, there were two of them. They seem quite similar, but they weren't done as a spread and they weren't done at the same time. So who knows, maybe it's just a coincidence, but the trades are minus 4,000 June 18th 37 puts, and minus 2,500 January 15th 2027 37 strike puts. So both at the 37 puts. The first is about $1.8 million. The second is about $1.7 million. Both of them seem to be opening trades that are both neutral to bullish if they are indeed just standalone opening trades.
Yeah, collecting some premium, maybe looking to establish a position if the stock does go sideways or even lower going forward. Rick Ducat really appreciated lead market technician for the Schwab Network. So we sent it back to New York and Sam Bottas.
Thanks, Rick and Alex. Well, coming up, it's time for Overlooked Stocks, and now George Tillers has his eye on AXT. Heading into the close, he'll break down news about that company and what you need to know about it. Coming up next on Market on Close.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping markets in real time. This is the Schwab Network. Subscribe at schwabnetwork.com.
How's it going? First is, sometimes,
Next.
try again. You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
How embarrassing, Carl.
Markets in the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com
And on all your favorite streaming services.
Schwab Network. Available anytime, anywhere, on any device for free.
Welcome back to Market on Close. I'm sent by this live from the floor of the New York Stock Exchange. So it's time now for overlooked stocks. We're watching AST Inc., which has rallied to a new 52-week high today. So George Tillis is joining us now, senior markets correspondent, to get us across this one. So it's up, as I said, 52-week high, rallying about 10%. It's in the business of, I see, wafers, as far as substrates, gallium, germanium, things that were under an export ban coming out of China, that's now being reversed. Talk us through the significance of this story, why stock is rallying so much today.
Yeah, I mean, it's up today. This is, I think, a remarkable story in the context of what's happening with DRAM technologies.
The XTI.
Western Digital, Seagate are all performed exceptionally well in the past 6 months, and companies like AST Incorporated have also participated in that. And right, this is a semiconductor materials science company. They develop, manufacture, and distribute many of those compounds that you mentioned, which are essentially phosphate substrates. So the substrate is basically taking raw materials and it's the next step in the value chain. And their products are actually quite in high demand in mainland China. That's where most of the production facilities are located. It is a California-based company, by the way. But at the same time, it's playing out in terms of what's going on with demand for semiconductors as well as optoelectronic equipment across multiple industries, data centers, connectivity, AI computing, 5G infrastructure, but also LED lighting, which again is a smaller component of their business. But one of the catalysts I suggest with AXT Incorporated, or a couple, are first off the aspects of the AI demands. The company denoted when they reported their Q3 earnings, which were higher year over year by 250%. So it's a remarkable move year over year, but they also demonstrated 50% sequential quarter-over-quarter growth with a $49 million backlog just in the AI data center space. And that's important considering that the 4 quarters prior to that, the company only generated $90 million total. So top-line sales have been growing for this, what we would consider a smaller cap company. It's below $1 billion, around $650 million. But the catalyst obviously are the technologies and the materials, but the other secondary catalyst that you mentioned, Sam, is what's going on with China. Because most of their production is in China, and for what it's worth, most of that production was stranded and confined to mainland China because of export regulations. So it looks like some of these export controls are becoming a little bit more favorable to begin selling to overseas competitors and to, of course, markets overseas. SK Hynix and Samsung are the other 2 DRAM manufacturers in Korea. They actually may be part of this backlog that AXT did report when they reported their last quarterly earnings. So I think the improvement in export conditions are one of the primary catalysts alongside the demand for their products. And those 2 things alone, with the sentiment in the small cap space that the company's operating in, has really pushed the stock quite a bit higher. Just over the last year, the stock is over 600% higher. In the last 3 years, up 270%.
Performance, I mean, just look at that chart. It is just on the way up. I mean, higher and higher and higher. You mentioned a subsidiary in China known as Tongmei. Interesting, as you mentioned, with the reversal of some of the bans on the export controls of gallium and also germanium, which is in the business of. You highlighted the story about SK Hynix and Samsung. They've actually just been given the green light by the US to continue to bring their manufacturing equipment back into China to their facilities after there have been some difficulties actually being able to do that. So I guess that's the link here as well. How much of this has also perhaps got to do with the fact that there are new manufacturing rules in China now? According to a report, China's going to make chip makers to use at least half of domestic chip-making equipment if they want to expand capacity, given that it has this subsidiary there in mainland.
Yeah, so that's another great point, too. I think if you look at the larger context of what's happening in the semiconductor stack, and so I'm just going to use the lead architect NVIDIA, they produce the best chips, but China is really not that far behind producing second-order chips that are maybe not as good, but sufficient enough. China has a history of providing domestic subsidies to support nation industries, and those infant industries. Again, that's a catalyst for this business as well, alongside what they did with EV companies in China over the last 5 years has been tremendously successful. So I think that's a huge catalyst. Again, the export control restrictions are there to support domestic industry, then of course, providing some favorable conditions to re-export those products to overseas competitors, which again might bring back more capital into China. So there's a reciprocity element to, I think, what's going on in the
reciprocity.
Also in the semiconductor space in China. So
A reciprocity.
the move in this stock has been overwhelming. It's a very large move. It's moved parabolic. One could make the case that it is justified, assuming all else equal, that they hit their numbers coming up in the next year and a half. And they say it's important because this year's estimated EPS for the fiscal year 25 is a loss of 38 cents, break even next year, and then of course going into 2027, based on consensus estimates, they're estimated to earn 39 cents. So, break even points in stocks, maybe 6 quarters before that, or where you see big moves.
George.
This is my experience. I think that move has been had because we have such a strong move in the last 6 months. Because next year in 2026 we're expected to break even. So again, the company is expected to be profitable. They're generating quite a bit of sales, but again, regulatory export control conditions and maybe some customer concentration risks.
Tesla pulled back.
Consideration when looking at this thing.
Okay, noted. All right, thanks so much for breaking that down.
Noted.
AXTI rallying 10%.
She say noted?
Right now, $15 and change. Thanks so much for all that, George Silvers. I'll send things back over to Alex.
You're so cute.
Thanks to George, thanks to Sam, as always. We're just about 5 or so minutes away. We're going to take a short break. We're going to bring in Kevin Green. He's going to break down today's market action, give us some of his key levels on the S&P 500.
Yeah, Kevin. Let's get it. Come on, brother.
Real-time access, data-driven analysis from U.S. equities to global macro
Yeah.
Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
It is. I agree.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers.
You are right.
on Schwab Network. Stay connected to what moves
Boy,
markets.
RGTI.
Download the Schwab Network app.
That had a big
Stream
drop.
live coverage wherever you are. Here at Florida, the New York Stock Exchange, alongside Alex Coffey in our Chicago headquarters. So we've got a few minutes left now in today's session, the second last of 2025. Let's welcome in Kevin Green, senior markets correspondent, to help us close out the day. A holiday market, low volume market, muted sell-off, yin and yang. We've had lots of descriptions. Right?
Santa Claus.
But what are you seeing in the final minutes, KG?
Yeah.
I'll add one more. Boring. This is a boring market. We want to see volatility move a little bit
Very
higher.
boring.
Trader here. Obviously, we've seen a lot of consolidation over the last couple of trading sessions today. We saw more of the same.
It's the most boringest market of today.
Support. We're pretty much trading at that level right now. Given the some numbers that's going to be there. But we do actually see this kind of red pattern. Also taking a little bit of a higher lows. we will come to the apex of this triangle tomorrow, where you expect either to see a breakout or a breakdown in the S&P 500 if the technicals are really going to hold up. Going into the close, though, obviously it's not a really big surprise. You're seeing a very tight range. Looking to the upside, major area of resistance just based on the options flow, 69.10 to the downside, 68.90. You have Penrith sitting at around 69.05. 6,900 technically. There's a significant position there. You look at the puts. If you're going to get slightly out of the money there, you would look at 69.05, 69.03 or so. So a lot of range bound action here. And it makes me look at the composition of sectors that are outperforming here. You actually have communication services along with energy, as well as utilities actually leading the way here today. And the volume actually has been net negative if you're looking at the S&P 500 total composite volume. Up versus decline volume actually is on the negative side here. So not a great day. Once again, range bound, kind of boring.
KG, I see about a 20-point range, high to low. I don't know that accurately reflects today. Really, since about lunchtime, we've been in an under 10-point range in the S&P 500. Sometimes, I'm not saying to turn the screen off, I'm certainly not telling you to turn off the network, but you don't need to try to trade every move, right? This isn't a trader's market today.
Not on the index level. You do see maybe some movers when you're looking at individual stocks that are catching a little bit of a bid or even breaking down for that matter. But on the index level, there's a lot of premium selling, both on the call side as well as the put side, which is once again why we see an aggressive amount of volume on the 0DTE options. We're looking at just the SPX as well as the NDX. Where there's several different contracts that have over 100,000 that have been traded for today's session. And the top tick last time that I saw over 165,000, so it could actually hit very close to 200,000 contracts just for one strike. That just kind of symbolizes the fact that we have compression in this market. You sell the rips, you buy the dips, you try to keep it within range, and hopefully implied volatility comes in, as well as time value kind of wears out, and that's where those premium sellers really do make some money. So there's still an opportunity here, Alex, but at the end of the day, it's more of a premium seller's market than a buyer's market when you're looking at buying calls or buying puts. And unfortunately, that does get a little bit dangerous for the premium sellers out there, too.
Well, he wasn't making any sense either. Drag on. They keep saying wait and see, and we wait and see, and nothing changes. So, we'll wait and see. I haven't been trading as much, which I'm thankful for. I think I got 3 trades in today, maybe 4. So, yeah. I will catch you all later. Y'all have a great day. And again, thank you, retail traders.